Exciting time. It's 11 o'clock a.m. Eastern Standard Time. Thank you to everyone who has been able to make it this morning. Sorry, I heard my echo there, as you probably did as well. For those who are speakers, I apologize. Some of you are coming on to the So before I get started, thank you again. We're getting started for the KoreSummit RegA 2020. So it's an exciting time for everyone. So what is the RegA KoreConnex event? So at its core, most of you today are going to have an experience of a lifetime, an end-to-end day from 11 a.m. till 7 p.m. Eastern Standard Time. Yes, we are recording the event in different panels for you as well. That will be only available to those who register. And this event is about education, providing you the tools that you necessarily need in order to be successful in doing your Reg A. You're going to hear from the lawyers, investor acquisition, the media partners. You're going to hear from an array of different types of speakers, broker dealers, secondary market, research, ratings, and my favorite part, CEOs who've actually gone through it. But it all started in one place, and we'll get to that very soon. But before I get started too far down the line, I want to say thank you to the committee who put this together: Sarah Hanks, Andrew Korn, Eric Fishtank, Nick Messi, Vincent Molinari and his team, Troy and Brianna, and of course the KoreConnex team. Thank you so much, everyone, for putting this event together. Today, we have over 3,500 people registered from 43 different countries around the world. So you know the Jobs Act is getting, the word is getting out. And I am so excited today to have a discussion to get the day rolling for all of us regarding this momentum. David and I have known each other for quite some time. If you're not aware who Mr. David Weil is, he is the former vice chairman of NASDAQ. He is currently the chairman and CEO of Weild & Co., one of the fastest growing broker-dealer firms in the United States. And he is the father of the Jobs Act. So what does that mean? What does it mean to be the father of the Jobs Act? And I like to tell the story of who every of you have been in a presentation. It all starts with a little thing. So when people say one little thing doesn't make a difference, it does. And this is the person that triggered that. There were many other people involved. Don't get me wrong. It wasn't just one person, but here's where it started. And today, David, it's, as always, it's great to have this conversation with you regarding this momentum of, the Jobs Act.
Thanks, Oscar. I mean, look, I'm really kind of overjoyed. It takes a long time. There's a great expression that I heard down at the Securities and Exchange Commission once, which is that people are always surprised at how long it takes for new regulation to kind of take hold in securities markets and then actually grow into something. I think the Jobs Act is a prime example, but there's a little reticence on the part of securities lawyers to have their clients be first. People have to figure out there are ecosystems that need to develop to make it really fulfill its whole potential. And I think that what you'll see is that the Jobs Act over the long run will be much more transformative to the economy in a good way than maybe people thought it was right from the beginning.
No, it is true to that. I mean, one of the things that I often deal with, I look at my calendar and I go, wow, it's already been 10 plus years. And yeah. It's amazing how time flies. And today I have the same enthusiasm towards what we started, following this back then. But I see something different here. I don't know if you see it as well. COVID-19 has been a horrible thing globally. But at the same time, as they say, sometimes you need to look at everything to see what impact it could have on the market. And I see it as one of the biggest catalysts for the Jobs Act because the evidence is already there. There are more companies now raising their capital through the very exemptions that the Jobs Act was intended for. But But let me get back to the basics of something that you and I have spoken a lot about. Regulators put up regulations all the time. That's not new. Everybody does it for different reasons. But the essence of the Jobs Act, in your view, what do you foresee it as? What was it really intended for? And is that the reason for the momentum that we're seeing?
Well, I'll tell you what kind of happened and went through my head when we started writing papers on market structure, and there were a number of them. They were, entitled things like "Market Structure is Causing the IPO Crisis," and then we did another version and more. There was a wake-up call for America, where we made a lot of recommendations, and some of them were lifted directly from there, like 506C, which was the repeal of the prohibition against general solicitation in private placements. We weren't smart enough. Look, I'm a molecular geneticist by training. I mean, that's really my background. And then I came to Wall Street, and then I became kind of a market structure expert. I priced over 500 IPOs, raised the first money for BlackRock. So I had a very good sense. And then when I went over to NASDAQ and I ran the listings business, I had one foot in the regulatory pond, because the NASD, which is the precursor to FINRA, actually controlled NASDAQ when I was there. And we were trying to get our SRO designation from the SEC. We were in process on that, but we were still controlled. So I got to meet, Mary Shapiro. She later became an SEC chair. Mary Jo White was on our board of directors at NASDAQ, another SEC chair. And so, these people were sort of, if you will, colleagues and people that I had relationships with. And so we understood the intersect of markets and regulation. And then I was there when they were making some of these changes, including decimalization, and so we were dealing with our economists and looking at sort of what the changes were. And look, I having priced and supported so many IPOs in the past, I had a pretty good sense of why they worked and why they didn't work. And I had also been at Prudential Securities, which before that was a top 10 investment bank. And we had, when they implemented Reg ATS and the order handling rules, we had to get rid of a lot of human capital that was supporting trading desks, and sales capital that was, making aftermarket sales calls and equity research analysts in support of microcap securities. So it was very clear to me that there was a cause and effect in terms of market structure changes and capital formation, because we couldn't take the companies public and support them any longer, and nobody seemed to know that. And that was in the middle of the dot-com bubble, when everybody thought everything was great because there were so many IPOs. But if you went below the cover and you started pulling the data, you would have seen, and we had lots of little cuts at this data, but it was very, very dramatic when you looked at the sub $50 million IPOs back all the way to 1994. And on today, it'd probably be a $90-95 million IPO, but they dropped off a cliff. They used to represent 80% of the initial public offering market. And then with the wave of a magic wand, which was Reg ATS, all of a sudden they were representing 20%, and they kind of never recovered. They recovered a little bit because we've created some, toolkit changes with the Jobs Act, but nowhere near where we need to get to, which is, I say the punchline is that we have to figure out the aftermarket support model, because microcap securities are asymmetrical order book securities, big seller, no buyer. Somebody needs to be able to go out and create buyers and remarket shares that are not otherwise known. And that used to be the function of the telephone quoted quarter point trading spread markets. And it doesn't exist any longer, because we've created a one size fits all stock market, which is penny tick sizes for everybody and low cost trading. The problem is it creates a massive cost to the issuers, because it's steadily eroding distribution broadly in the United States. So we have a lot more work to do. I would say, we got some great things. We changed the conversation is what we did with these papers. They were dramatic. You saw that big drop off in the small IPO. I mean, fascinatingly, to me at any rate, we also cataloged the loss or the decline in the number of listings, right? Which they're related, right? You don't do as many initial public offerings, then you're not going to have as many listings. They drop off a cliff, and sure enough, nobody knew that, because the listings data from the New York Stock Exchange and the NASDAQ included exchange traded funds and closed end funds and REITs, things that were non-operating companies. And so nobody had thought to kind of separate that stuff out and to start to look at the operating company sample. We did that, and lo and behold, you could document that we went from 9,000 publicly listed companies in the United States down to 5,000, and nobody knew that. And of course, we were lagging the Chinese. And so when we got into Congress, I remember being in the House Financial Services, committee, and one of the congressmen put up these charts and said, Mr. Weild, which one is China? And I said, sir, it's the one on the top. Mr. Weild, which one is the United States? Sir, we're the one on the bottom. There were about 10, 12 countries in this sample set. And he said, Mr. Weild, which one would you prefer to be? And then he said, don't answer that question. But I mean, the point was made. And I think that what people don't recognize is that there's, look, everybody that's in this community now is playing a role. And it's your job to kind of bring back capital markets. We have a flyover state problem now in the United States. Our numbers of, if you look, there's US Census Bureau data on this, the number of startups has declined precipitously. So the real proper functioning of these toolkits and these markets that we're creating, whether it's through Regulation A plus 506C, the testing the waters provisions, which Jay Clayton, SEC Chair Jay Clayton, and the commission made available to the entire market. I kind of think that may be because when you see WeWorks try and go public at a $40 billion market value, and then all of a sudden get recapped in the private market at $8 billion, it shows you that Wall Street's no longer talking to the buy side because they missed the broad side of the barn on valuation. How could you possibly do it? Well, it's because there's no money and no economic model any longer for the sell side to be talking to the buy side. I mean, they just don't. And in fact, we've done for top tier venture capitalists studies on or reviews when they wanted to go out and pick research analysts to support companies. And we asked the buy side, which of these 20 top, sell side research analysts do they have high regard for? And we'll get a list of, everybody from Goldman to Morgan Stanley, and in the software as a services space, for instance. And it turns out that the institutional investors don't know any one of them by name. They know that, Goldman's got a good reputation in tech. That shows you that the discussions go on because of Reg FD. There's no value in talking to an analyst any longer. And so our distribution has really atrophied dramatically. We've taken the retail brokers at firms like Morgan Stanley are now allocating assets into funds. They're not actually broking stocks and getting on the phone. And I would say that because we're not talking companies, our entrepreneurial IQ goes down because investors need to have those conversations about individual companies as opposed to baskets. So what we've done to some degree is we've created a new set of interested parties in earlier stage growth capital through Regulation A plus. We've created a community. You're all a part of that community. You all have a voice in that community, and your job is to make sure that access to capital for entrepreneurship becomes a movement in the United States, that we're able to fund businesses because these businesses are the ones that create social impact, create jobs, create a tax base, pay for a stronger military, and it's absolutely essential to the long-term health and well-being of the free world. I firmly believe that. And what we did with our electronic stock market structure is we actually nuked the greatest new industry birthing mechanism, which was the small IPO that the world had ever seen. And so
yeah, I was just going to say, look, with so many triggers created this, right? And when you and I were talking just a few days back, we recognized that all the people here today, every single one of the speakers have been on that journey with you, who recognize the problems and the change. And maybe I summarize that in three categories, because if you're an investor, what does all that mean to me? If I'm a company, what does it mean to me? And if I'm a provider, what does this all mean? To me, the Jobs Act is three things. And you can correct me if I've summarized it incorrectly. Number one, it's to democratize capital, to give everyday Americans, the 18 or older, to be able to participate. And of course, we have a lot of work to do there. Education goes without saying. Number two, to bring back ownership back to owners. To your point, we look at 2008. Who walked out with the money? It wasn't the owners and it wasn't the shareholders. It was the bankers. And then, of course, liquidity. I mean, aftermarket, the secondary market, in order to get the participants of the non-accredited, the general market, you need to be able to also provide some sort of mechanism to allow them to do that. But that comes with a big responsibility, and that doesn't happen overnight. Maybe I was naive at the beginning when I first got involved in this journey 10 years ago, that yes, overnight it's just going to trigger on, but it does require a lot of building. There's trust required to be built. There's education that needs to be built on the mechanism of even the providers, how they will work together collectively, cohesively, so they can help. And then, of course, now we're getting to the final stage of educating the market to make sure they are aware of this asset class and its value, and then everybody making sure that we do it in such a way that we don't harm the market. Because that's the problem with anything, right? We're not even at the cusp yet here. We're still at I call it the evangelical. When you build a product, they always say there's the evangelicals, here's everybody who supports you. And then you start seeing this massive curve and woo, the peak. We haven't even gone there yet, and we're getting close. COVID-19 has been the catalyst. Would you agree with that kind of view that I have towards the Jobs Act?
Well, yeah, I democratizing capital is a way of saying, I look at it a little bit different. I look at, the wonderful thing about capitalism is that if you can enable people to go out and build things, create things, innovate things, they will, right? Yeah. So that's a form of democratization, right? You can't just constrain capital to, places like Silicon Valley, which is really largely one of the distortions that's occurred since we dropped the bottom out of the small, cap market. And we need armies of people, giving it a shot. We teach more entrepreneurship in the United States than we ever did at universities. And yet the numbers of startups has plummeted if you look at the US Census Bureau data. And so, that's a problem. And, I look at SPACs, for instance, and SPACs are a symptom of a broader disease, which is that people are, looking to go public, but the predictability of doing an IPO and getting it supported is very low. And the cost then of trying to take a company public, it doesn't lie in the 7% gross spread. It lies in the fact that Wall Street, has taken to underpricing securities to top commission paying institutions, generating alpha. I mean, they're telling people the success is a 40% pop in the share price. Well, that you just took 40% of your damn share value and you journaled it over to the institutions. And what's going on is the institutions are then journaling half of it back to Wall Street, right? And paying for that alpha because it's the only alpha that's left in the system. Well, that's a sign of a system that's got some problems from a capital formation perspective. And, I think, I believe that capital markets are there first and foremost to serve the economy. We respect investors, and this is a little different than the SEC's take, I think, and is that that investors have a primary role. But I always look at investors, and the SEC historically has really protected new investors coming into a situation as opposed to thinking about the incumbent investors that got you there, that in many times are the most important investors, right? You got the guys that took the early stage risk, and there needs to be a balance there. And I think if they had sort of equal billing in terms of how you think about investor protection, I think we'd be a lot better off, because then we would create market structures that really support, stocks and allow, continued access to capital, as opposed to what we have right now, which is we've taken the aftermarket support model and we foisted it on the backs of the issuers who don't know how to do it, or only two people. And Wall Street no longer provides that service because there's no money in redistributing securities in the aftermarket when you have a penny tick size and commission models like, Acorn, Robinhood, or zero commissions and things. And so, we've got a market that no longer serves adequately capital formation. And so it's moving in more and more into the private markets, you know, with these new toolkits that we've created. You know, personally, I'd like to see it better in private markets and better in public markets. You know, I applaud some of the direction that the SEC has taken by taking, testing the waters and making it generally available to the market, which, you know, came from the Jobs Act. I think that, you know, trying to take up the size of Reg A to 75 million or higher, taking up Reg CF to $5 million, which was the original size that Patrick McHenry, who was the congressman that sponsored the original bill that got rolled into the Jobs Act, you know, that was where we started, right? You know, as I like to say, I've never known these investor limitations, the numbers of investors never made a lot of sense to me, because if you're not a member of a protected class and you're accredited investor, why do we care if it's 2,000 investors? But there's a legislative sort of reason for that to have happened. But I think I think that you can in Reg CF, you know, if you're limiting people's risk to say $5,000 invested, why do you care how big it is, right? I mean, at the end of the day, you've limited the individual's risk. We don't need two limits. And for me, I think that the ability of the United States to compete and people to compete for capital, we need to take the gloves off and make it easier for people to compete. And we have to take a little bit more risk. I said, you know, we're a nation that settled. We had our forefathers came here and traveled to the West in covered wagons. We had the Dust Bowl. We had no cell phones, no hospitals along the way. I had on my wife's side of the family, one of her great grandparents had 5 children, and I think they got, I don't know if it was diphtheria or what, they lost all 5 of their first children up in Minnesota in farm country, and then they had another 5 kids. I mean, and so I think we need to be enabling people to solve problems and to access capital. We need to take the gloves off, increase a little bit of that risk taking, get the numbers of entrepreneurs go higher in this country, the numbers of startups going. We need to, you know, bring back upward mobility, which has been lost to the economy, and really make capitalism do what capitalism does best, which is, you know, outperform every other economic model. But if you don't have the right toolkit in place and the right incentives and disincentives, then it doesn't work particularly well. And that's what this fight is about. It's about, you know, bringing back our capital markets so that they can serve the American people in terms of ultimately funding the tax base, national defense, solving global warming, the things that we all care about, curing cancers, et cetera, et cetera, et cetera. So.
It's, you and I can, and obviously everybody, the attendees that have attended here today, this is a great discussion, and it can continue. But here's one thing that I will tell everyone that I've seen it firsthand. The Jobs Act became it started the domino effect globally. No matter, you're right, we could always make it better, improve it, which we are, and people like yourself, David, and many others here today, we're going to hear about, have started that. It trickled down to the UK, to Canada, Australia, Singapore, Thailand. I know you've been speaking in different countries, myself, Douglas Elanoff, Sarah Hanks, many others who have been brought in, who were part of the creation of the Jobs Act. So thank you for today, getting the day started for all of us. With David began, regulations get created, and who do we need? We need the interpreters who are going to help us make an understanding what the regulations is. Regulation A is it's an exciting regulation. Some people have heard it from years back, call it Regulation A. We're calling it Regulation A Plus now, as an enhanced version. And we have a great group of 4 leading lawyers here in the space that are going to lead you on. We took a bit of their time today, so I do apologize, Mark, Jamie, Marty, Louis. And they're going to get started. They're going to give you all the how-tos on the legals, and remind everybody that if you want to find any information, just go to www.KoreSummit.io, and all the speakers' information is there, so you can reach out to them. So Marty, Mark, Jamie, Louis, you're on.
Okay. Oh boy, I'm getting feedback. Can everyone hear me from my phone connection?
I think you're on twice, so maybe you have to mute one of your lines. It looked like you have phone and video going.
Oh, I think this is going to work. Okay, so first, my name is Mark Roderick. I'm a securities lawyer, and I spend a lot of time in this space. I first want to thank the folks who came just before us. That was a fascinating conversation. Fortunately, this panel has actually invented a cure for cancer, which Jamie is going to announce at the conclusion of our time. So, yeah, as I'm sure all you anticipated, the legal panel will be the most exciting of the day. It's going to get everyone wide awake. So I am joined by 3 other securities lawyers who spend a lot of time in this space. I guess I'll Jamie Ostro, Lou Bevilacqua, and Marty Tate. And I would ordinarily start a panel like this by asking someone to give a broad overview of Regulation A, Tier 1 and Tier 2. But I think we're far enough into this industry, and given the focus of today's event, I think most attendees are already familiar with the basic contours of Regulation A. So I'm going to skip that part. There are lots of resources available if you're interested in learning about the basic contours. I'm sure each of the panelists here have websites with that information. I certainly do. But we're going to dive right in. Instead of talking about overview, we're going to dive right into details. So I'm going to start off asking my friend Marty, what are the advantages from a company's perspective, an issuer's perspective? Why think about Regulation A? Why not stick with Rule 506C or Rule 506B? What is an issuer getting by subjecting itself to the regulatory apparatus of Regulation A?
Well, I appreciate that, and it's nice to see everyone. So, and I think you do say that correctly before subjecting themselves to the regulatory world of Regulation A. So I think there are a lot of a number of advantages, and a Regulation A offering, it just, in fairness, it takes longer, it's more expensive, and requires going through the gauntlet of qualifying with the SEC. So it definitely has its drawbacks.
Right? I mean,
Yeah.
you don't do that just for the heck of it.
No, but the advantages are the low-hanging fruit of advantages are one, it allows you to raise up to $50 million from accredited and non-accredited investors. Now, a 506C or 506B, those don't have any restriction on the amount you can raise, but it does limit the types of investors that can invest. So a lot of people are excited about the fact that you can do a general solicitation, a quasi-public offering that includes accredited and non-accredited investors. So that is one advantage. The second advantage is that you're getting unrestricted securities. So unlike a Reg CF or a Reg D offering, where the securities that are acquired in that offering are restricted and are not able to be freely tradable without another exemption, that the securities that are acquired in a Reg A Plus are unrestricted. So those are the two, I think, main advantages of a Reg A Plus.
Okay, and I'm gonna ask this follow-up question, not to be facetious, but actually I'm gonna ask two follow-up questions. Why raise money from non-accredited investors? It's not a trick question. I mean, it's a serious question. Why you can raise 50 million or 100 million or $1 billion from accredited investors. So why raise money from non-accredited investors?
So I think that, and I'd love to hear what other people have to say, but it kind of is a facetious question, Mark. So, you know, you said not to be facetious, but there's a little bit of facetiousness to that. I think that in raising money from non-accredited investors, if I have a client that says, hey, we want to do a Reg D offering and we want to do 506B because we can get up to 35 non-accredited investors, I will typically ask them why. Because I agree with the same question. Non-accredited investors, there's the potential that they could be, those small dollar investors could be more trouble than they're worth. That being said, it does open it up to an accredited investor. You have to meet certain financial requirements, and that's not everybody. So I think it does allow you to democratize the offering process, to go out to more people, allow people that don't qualify as non-accredited or as accredited investors to invest. It also allows you, if you're a company that has a product or something, it allows you to do pseudo marketing by going out and building a fan base or a core base of customers that have invested in your company.
Well,
those would be the pros.
That's the answer. I think that for many companies, it's because you can market to your customers. You're selling a product or service, and you can market your securities to those same people, and there's a sort of synergy that happens there. I mean, you know, unfortunately, as was touched on in the previous program, we have this situation in this country now where we have fairly extreme wealth inequality. So unfortunately, many companies could raise all the capital they need just from very wealthy folks. So I do think it's important to understand that for companies can use Regulation A to market to their customers. So my second follow-up question is, you said one of the benefits of Regulation A is that you can issue freely tradable stock. Do you know of a company today that has used Regulation A for which there is an active secondary market for their securities?
Define active.
Not pink sheet like. I mean, a truly active secondary market, lots of buyers, lots of sellers.
There's been a bunch that have gone, there have been a few that have gone on NASDAQ and the New York Stock Exchange, some of the earlier ones. Now it's much harder to do a Reg A offering to an exchange. The exchanges seem to want you to do an S1. I think a bunch have gone to different levels of the OTC market, but unfortunately, when you go on the OTC market, it's, as you know, it's very hard for people who buy securities directly from an issuer to deposit them into a brokerage account. And so that, I think, hinders the development of an active market. But I think a good number of companies have, after their Reg A offering, gotten a market maker to file a 211 application and gone on to OTC at a minimum.
All right, Lou, so let me ask you, how long does it take for a Regulation A offering? How long does it take in total? What are the steps that you lead clients through in anticipation to prepare for an offering?
So in my experience, it usually takes anywhere from 3 to 4 weeks to get ready before you file your Reg A offering statement. Then, of course, you file it and the SEC reviews it. It takes them about 30 days to get back to you. I would estimate it's anywhere from 2 to 3 months after filing. So I think you should budget a good 4 months before you could start selling securities. Of course, you can test the waters beforehand, which means even before you file, you could start marketing your offering and get non-binding indications of interest. You know, a lot of the timing depends on the client in our case. So, you know, we have a pretty good system in place. When we onboard a client, we'll immediately set up a data room. We'll include in the data room a due diligence questionnaire and a disclosure questionnaire. The disclosure questionnaire will help elicit from the client all the different types of information we need to create the Reg A offering statement. We'll also get their, you know, their business plan, their investor deck, whatever other disclosure materials they've done in the past. And we'll put together what we call a skeleton draft of the 1A offering statement, which will have a lot of yellow in it, which are the things that we need the client to address. And then, you know, we'll get on a call with them, share our screen, go back and forth. And it's that iterative process that helps get the 1A ready for filing. And the better you do at getting all the right information in that 1A offering statement, in the right format, et cetera, the lower number of comments you'll have at the back end, it'll make the back end of the process, the SEC review, go that much more quickly.
So let me follow up. You mentioned testing the waters. Can you tell us a little bit about how that works? And can you also tell us whether, in your experience, testing the waters has been an effective way to test the waters?
Yeah, sure. So this is one of the real benefits, in my opinion, of Reg A. Not every issuer uses it, but basically, before you start spending money on lawyers and accountants and everybody else, one of the things you can do with Reg A is...
Well, you really want to say before you start spending money on lawyers? I mean, isn't
Yeah,
that really the most important thing?
I want my clients to be happy. If they don't have to spend money on me, that's great. They'll come spend it later. It's fine. But, you know, so before you really start incurring expenses, you can go out, you could put marketing materials together. You can, you know, basically generally solicit your offering. Hey, we're planning on raising capital under Reg A. Really, the only requirement is, or maybe two requirements. One, there's a specific legend that has to go on all advertising materials that basically says you know, we're not able to sell yet. We're going to be filing an offering statement. Offers will be made, you know, under the offering statement. This is a non-binding indication of interest. Don't send us money. If you do, we're going to return it to you. So you put the legend on, and you also need to make sure that whatever you use in your advertising materials is not misleading. So as long as you comply with those two requirements, you can put out information. We're planning on doing a Reg A offering. Let us know how much you think you would invest. Give us your email address. You know, give us your phone number. And then, you know, you could follow up with them later on. Now, one of the things you probably don't want to do is put too much time between testing the waters and getting qualified, because you might create some momentum early on. And then if they can't invest until 2 or 3 months later, you've kind of lost the benefit of that. So at least in my experience, I like to, if you're going to test the waters, I like to do it a little bit closer to the offering statement being qualified. And I think for some offerings, it'll work better than others. When you're really marketing to your customer base, or you have a product like a consumer product that it's great for you to get out there in the market and talk about it, I think it's really helpful to test the waters.
And in your experience, do issuers find that investors who have expressed an interest in that process do actually invest?
Yeah, I couldn't tell you the exact percentage. I think some studies have probably been done on this, but my guess is it's probably about 50%. Maybe it's a little lower.
Yeah, that sounds about right. Okay, Jamie. Company calls you this afternoon, which they probably will, and says, I attended this seminar. You were definitely the best panelist in the legal panel, so I want to talk with you about Regulation A. What should I know? What do you tell issuers in that first call to sort of prepare them for Regulation A?
Well, first, Mark, I should hang out with you more often to build my self-esteem. Second, I mean,
that was the point of me saying that. I'd like to hang out with you more.
Second, there's kind of a whole group of like a list that we go through just to make sure, you know, we also have a memo on it. People understand what considerations you need to do and before embarking on a Reg A. First, you need to understand that the SEC is a disclosure regime, so you're going to be revealing a lot about your company. So do you have material contracts out there? Do you have confidentiality concerns? Some of these become gating issues where at the end of the day, you might decide Reg A is not the appropriate place for you to finance your money. The second is, you know, understanding your budget. How much is this going to cost? There's going to be the legal fees. There's also going to be, you know, things like at the end of it, state notice fees, which can add another like $13,000, $14,000. There's also going to be, you know, besides different fees out there, there's going to be marketing fees. One of the big, you know, adages out there is securities do not sell themselves. So unless you already come in, you're a consumer company, that you already have a large base of people who are already interested in your product, know you, you're probably going to have to spend a lot of your money on marketing dollars and making sure that you can reach potential investors in order to actually, you know, finance your company appropriately. The other things we go through are kind of like, you know, understanding the timeline. I know that Lou discussed it briefly about, you know, how long it takes between when you start and when you qualify. And also you're going to have to prepare your financials and knowing that you're going to need audited financials. I mean, some of our issuers come to us thinking that they can do tier one. And for the most part, with the exception of a few companies, we think tier one is kind of fool's gold because unless you're doing it in a single state, some states actually require audit financials because tier one doesn't preempt state requirements.
Okay, yeah, I think I 120% agree. A question for the issuer is, what makes you think you can sell these securities? Because this is not a build it and they will come situation. Do you typically give estimates to issuers of how much they're going to have to spend marketing?
We do not. I don't know if you do in your practice. We will introduce them to different marketers in the realm, but we won't, like, you know, it really just depends. And it depends who they're using, right? If you're using some of the platforms, they already have a marketing arm built in. So if they come through one of the platforms that already has that, they'll be getting that information directly from the platform.
Okay. So one thing you mentioned that I wanted to touch on in this, our brief time together, is the state requirements under Regulation A, because normally in these panels, you know, we talk about federal rules, which is what we've been talking about so far, but the state securities regulators are out there, and they're generally upset that they don't have more of a role in tier two offerings, but they do still have a role. Can you, I think you're the perfect person to talk about what the states require in connection with a Regulation A offering.
Sure. So as I briefly mentioned, Reg A preempts state law, and you mentioned as well, but it doesn't preempt state notice filings and state, it doesn't preempt state notice filings and other state filings. What's it called? So you will have to, like, you know, for instance, file with, you know, you will, every state basically, or about 40 of the states basically require that you send them a fee and you let them know that you're going to file in that state. Also, as far as, sorry about that. Also, as far as certain states, they don't have a substantive role, but we've been finding out that certain states have been, for instance, running bad boy, I think Alabama or Arkansas, I forget which state does it, checks on certain issuers So they'll actually like, look at the issuer, see what disclosures in the document. And in one instance actually came back to us and said, hey, we think you need this additional disclosure. There is a question about whether that's overstating the boundaries. However, like, the easiest thing is obviously just to follow like, the rules and like make sure, because they still have anti-fraud provisions within the state that they want to protect their issuers from.
Yeah, and I'm glad to hear I'm not the only one who has had that experience. And how about broker-dealer, state broker-dealer rules? Have you guys had issues with that?
Thank you for raising that as well. Most states, I think there are about 7 problem states, as we like to call them, that have certain, well, probably a little bit more than that, but certain issuer dealer requirements. Most states basically allow for companies themselves to, sell in their states without any registration requirements. Most states, like, there are a couple of states that have salesperson requirements, like Washington and New York, Washington, New York, New Jersey, that, have kind of easy requirements for issuers to register. And then there are basically, we call them mainly 4 problem states: Texas, Arizona, North Dakota, and Florida, where you actually have to go through a mini registration process and basically register as a broker dealer almost in those states in order to sell your securities in those states if you do not use an issuer, if you do not use a separate broker dealer.
Yeah, and that is a pain in the neck. So the state regulation, I think, is a real, a serious issue. Okay, Marty, I'm going to turn to you and ask you 2 related questions about so-called foreigners, which of course in our heliocentric view means anyone who's not in the United States. But one, can a Regulation A issuer sell securities to a non-US investor? And 2, what about non-US companies raising money using Regulation A?
So, easy answer. So with respect to the latter question, Regulation A is only available to US and Canadian issuers. So that is not an option. There, potentially you could structure a subsidiary or something to do that type of capital raise. With respect to non-US persons investing, or as you call them, foreigners, that's not a problem. There's no limitation on that. So that does allow you to expand that offering.
Now, you still have to comply with the securities laws of foreign countries, right?
Absolutely. So, and that's something to be, that's something that we have to deal with in all of these, in this new world of internet based offerings, is if you're making a concerted effort to sell securities in a particular foreign jurisdiction, then you would have to comply with those rules. I don't know. This is probably Lou and Jamie and Mark. You guys can tell me if I'm wrong on this, but generally I'll say if as long as there's not a concerted effort, you're just offering and somebody from Spain or something ends up investing, you're probably okay. But if you have a concerted effort, you have a number of investors in a particular foreign jurisdiction, then you want to make sure that you're compliant there. I don't know. Is that good advice, bad advice?
Well, I think Lou is an expert on Spanish securities laws, so let's get the answer from him.
I would retain local counsel if they really want to sell to Spaniards and see what local counsel says. But, I mean, we all put language in the Reg A offering statement saying, hey, investor, this is a US offering. And if you're not from the US, you're responsible for making sure you comply with the securities laws of your home jurisdiction. I'm not sure if that actually works. I haven't had the issue yet where a foreign agency has come after one of my clients for selling, but you know, I think certain countries, if you think you're going to be selling a lot of securities in those countries, or if you're going to be marketing to those countries, it's worth getting local counsel and figuring out what you have to do. You might have to put a legend in the offering statement that refers to the laws of that jurisdiction or something like that.
Well, if you ever do have a problem and a foreign SEC comes after you, tell them you were told it was okay by Marty Tate. But I do want to follow up this non-US issuer, because the rule, the regulation is, it's different than Reg CF. Reg CF talks about US, you know, issuers formed in the US. Reg A talks about issuers that are managed in the US or Canada.
Principal office.
Now, one thing I've never understood is why Canada? You know, just because they're nice, I've never understood that. If you can shed any light on that, that would be great. But otherwise, what does it mean to be managed in the US?
Yeah, like Lou said, it's the principal office, right? Which,
And
yeah.
what is that? I mean, there was an Indian company that got into trouble in that regard. But I mean, I do get these calls. What does it mean to, I mean, who has to be in the US? Is Zoom okay?
Yeah.
You know, what does it mean? It's a serious question. Can anyone here shed light on what that means?
I don't know if, I think this is correct. This is what I tell people. I think if you have, obviously you have to have an address in the US, and a majority of your officers and directors should be in the US. And I think if that's true, even if your operations are outside of the US, your principal office would still be in the US, and you could do a Regulation A offering. So you might even have a foreign entity that has a US subsidiary with a separate CEO, you know, and separate management team, and maybe a separate board, majority of whom are in the US, and that subsidiary might qualify to do a Reg A offering.
Mm-hmm.
Yeah. We had this issue come up with one of my clients where they were actually based out of Cyprus and tried to open a, you know, satellite office here. They formed a subsidiary. They hired a guy to be their U.S., you know, the head of their U.S. Operations, which really wasn't much of anything. And we kind of quickly abandoned the idea because we were getting pushback from the SEC on that because they really weren't doing anything in the U.S.
Yeah, it's definitely a facts and circumstances analysis, right? I mean, if it's just a puppet in the US, then it's probably not going to work.
Yeah, I mean, what is clearly legal is you have, for example, one of the big US mining companies, and it doesn't have a single mine in the United States because there's nothing left to mine here. But its headquarters are in Wyoming. That is clearly okay, it seems to me, because that's where its headquarters are.
Right.
So anyway, okay, let me throw this question out to you folks. What has your experience been with the SEC in terms of Regulation A? Have you found the process easy, difficult? Do you have to take Xanax after you get comments from the SEC? I'm very interested in taking the temperature. So, Jamie, you guys do a lot of this work. Do you take a lot of Xanax as a result?
No, but I think I probably should in the COVID era. So I think our experience with the SEC definitely used to take a lighter touch a few years ago as far as like comments, and now have been given more comments, but that's actually a good thing from my point of view because it actually makes better disclosure. I think for the most part, like, you know, most of the comments that we receive are really fair and actually help improve our clients and help improve the disclosure, and are not necessarily ones trying to be gotcha comments. And I also think, you know, as far as the examiners are concerned, my experience has been extremely positive, where they just want to, they understand they're dealing with small companies and it's an opportunity for them to help the companies reach their goals.
Now, I know that response was for the SEC's consumption. No, I'm sort of half kidding, but yeah, that's terrific. Marty, what has your experience been?
Yeah, I would agree with Jamie. I feel as though, you know, one of the advantages that people would say of doing a Reg A plus, you know, I have some exchange app companies, and they'll ask, you know, should we, that's been a question that's come up, is saying, hey, could we do a Reg A plus? And the theory is that it's going to be lighter touch and less of a headache. That's not necessarily true. You know, if you're comparing it to like an S1, the disclosures are less, so it's that it could be it could theoretically be easier. But yeah, I've found that the process is pretty similar to doing a public offering. But I think that's a good thing too. I agree with Jamie that the SEC, and maybe this is really catered towards them, but I found that the examiners we've worked with have been pretty helpful in the process. It's typically not an adversarial, unless you're trying to do something insane. We're not doing too many token offerings anymore, but I found that they're helpful. So, you know, Xanax consumption is minimal.
So I think
Marty.
what Marty just said is that the SEC is much, much easier to work with than FINRA is.
I got my fingers
Lou,
up, Mark.
oh, we got to stop?
No. I figure if what do you?
Or are you just
You know,
cheering on my comment about FINRA?
Oh, I was going to cheer on the comment about Canada, but you know, I lost my timing on that one. There was a shoe-in on that one, but I lost it. No, we got about 3 questions are really good questions, and I think it covers. I think if I can put it on to the panel, and Mark, if you can lead that on. So one of the questions that I think, if it's okay with all of you, they're asking, you know, it's an interesting one. If they're doing a Reg S, can that be done alongside a Reg A?
I'd be happy to answer, but Lou, do you want to answer that question?
It's an interesting question. So the thing you have to worry about in a Reg S offering is whether there's directed marketing efforts in the US, which of course you're generally soliciting in the Reg A offering. So you'd have to, in the Reg S offering, kind of have totally separate set of documents. If you're using a website, maybe a different web page for that. Make sure you're marketing only outside of the US for the Reg S offering to non-US people. But if you meet the requirements of the exemption, both the Reg A and the Reg S independently, then you could make it happen concurrently.
Yeah, it's you have to be careful, but you can definitely do it. You can do a Reg S offering with any other kind of offering, as long as you follow the rules Lou mentioned. Okay, great question. What's the next question, Oscar?
Well, a lot of the other questions are related to Canada. So what I'm going to tell that those questions, there's a panel, good speakers, both Kendall Americo with Sarah Hanks. They're going to discuss really, this is more related to US, but this is an interesting one because I don't understand the question. Is a company in a US territory considered a US company?
Yes.
Well, that is a good question.
I think so.
Raise your hand if you would like to answer that question.
I know like Puerto Rico and other territories are listed on the cover of the Form 1A, so I think it does work. I haven't done one yet for a US territory, but I think it works.
Like Guam, is that an example?
Yeah, I haven't gotten the Guam one yet, but I think it should work.
Yeah, Puerto Rico. Well.
So the next question, and I'm not going to put any of you on the spot on this because it would be unfair, but the question is, people, what should they be budgeting for legals? I think fairness to everybody. It's not just budgeting for legals, it's budgeting for your Reg A offering. In your experience, just rough numbers, what have you been telling everybody from a high level, Mark?
I think, judging from the market, not just myself, but I think you're probably looking at $50,000 to $125,000, and I'm not revealing any secrets. And then there was a very well-known Reg A company that did a bunch of them, and I think they paid over $300,000 for each, and that's all that the emotion that makes arise in me is envy. But I do always tell people that the cost of the marketing, so this is a mistake people make. How much does it cost? They mean, what are the legal and accounting fees? The marketing budgets are typically multiples of the legal and accounting cost. That's really the cost, people. But anyway, Lou, do you want to add to that?
For our firm, we're a smaller firm. To do a Reg A offering, we'll typically cap our fee at 65, and we'll get the deal done anywhere between 40 and 65. So it depends on how organized the issuer is, what materials they have, how much work we have to do, how much work they're going to do. But anywhere from 40 to 65, I would say.
Marty, is that about your range?
Yeah, yep. And we're a smaller firm as well, so we're within that range as well. I think that in some deals are easier. Some are operating companies, and they're not trying to pull in prior performance tables and different things. So some deals are easier, and some deals are more complicated. But I think that's Lou's hit the nail on the head.
Oscar, any more questions?
Well, we forgot Jamie, the star of the show. You forgot to ask. I want to make sure everybody get.
And I was just going to say, we have a flat fee, so our fees are normally around, on that part of the range as well. And then I'm going to echo Mark. The marketing budget is going to, depending on what you're going to do, probably dwarf all the legal and accounting fees that you really need to talk with people and figure out what your marketing budget is. And the marketing budget is probably going to be a factor of how much you're intending to raise. Obviously, the marketing budget is going to be different for a $50 million raise than a $10 million raise, where all the legal and accounting fees will probably be static for both of those.
I would just add one more thing. It also depends on whether an underwriter's involved, acting as placement agent for the offering or not, because a lot of times the issuer will do it themselves, maybe with a broker dealer of record, like a Dalmore Group. If that's the case, then it's definitely within the 40 to 65. And then, in most cases, even if an underwriter's involved, it could be within that range, but sometimes that increases the cost just because you have another party going through due diligence and they may require an opinion or this or that. So issuers should keep that in mind as well.
Well, ladies and gentlemen, that was look, for everybody listening in today, it's just an overview of these experts. You can find them at KoreSummit.io. You can click on speakers, their contact details are there. You can reach out to them individually. I know there's a lot of questions regarding Marty, thank you for answering one of the questions there already. So regarding whether I have a sub, whether I'm a European company, there's an array of questions. This is just getting it started. The conversation's begun. And I want to thank Mark Roderick. Thank you once again, Mark, for leading this panel along with Louis Villacqua, Marty Tate, and of course, Jamie Ostro. Thank you so much for coming in today. We really appreciate it. And the next panel that we are bringing on for everyone today is really an exciting one, because as Mark and Louis and Marty began the process of bringing the discussion of what can you use Reg A for, this is really going to stimulate your mind as to the verticals. We're calling them the verticals. So what does that mean? The verticals are the item, the types of opportunities that you may have that you want to make sure that you have a clear insight. How does that work with everyone? And so today, this panel is going to be led by Andrew Korn and Louis Villagua. There you go. You're back. How did that happen? I don't. Kendall Americo and Andrew Stevenson. So these are individuals who have been doing this, and there's some really interesting verticals. I know there's going to be a lot of chit chat in there. So Andrew, I'll ping just about 5 minutes before your time just to come in if there's any interesting questions related. If not, I'll just let you keep going. And have fun. Thank you, everyone.
Thanks, Oscar. Good morning, everyone, and thanks for being here. So verticals are a really interesting topic, and I want to thank all the lawyers for saying that they are the inexpensive part of doing a Reg A plus, and that marketing is the very expensive part, being that marketing is the area in which myself and my firm participates. So we'll get into that. Also later today on another panel, we're going to try to change everyone's vocabulary from marketing to investor acquisition. Anyway, we're here now to talk about verticals. In the agenda, it talks about fan-based, real assets, real estate, cannabis, how things are turning into fractional shares of just about anything. And actually, a bunch of us are working on something with a stable coin. So I am, again, Andrew Korn. I'm the CEO of E5 Rated Marketing. So why was I asked to moderate this panel? I've worked on hundreds of deals and basically work on the math, meaning what's the probability that something will work or not work, what can be sold or not work. Today, I'm joined by 3 top attorneys. Their firms are among the deepest experience in Reg A plus between them, and they see everything. And of course, their perspectives include not just what is legal, but what will the SEC qualify. So I'm going to jump in and ask some questions and then see if additional panelists want to opine as well. I'm going to start with Lou, and each person, when I ask the first question, if you can just state your name and company would be great. So Lou, a recent trend has been selling fractional shares in different assets such as art and collectibles, which include everything from race cars to paintings to racehorses, real estate, et cetera. How does this work from a Reg A plus offering perspective?
Sure. I think this is really a super interesting trend that's happening now. And it's basically issuers are using series limited liability companies. So they're very popular in Delaware. Most states accept them. There's a few that don't. But it's basically one limited liability company, but you have the ability to create different series. So you only file one articles of organization with the Secretary of State, let's say in Delaware, and it'll have language that says you can create additional series. And then the manager of the LLC, whether it's a board or an external manager, can just create those series by signing what's called a series designation. It's basically an internal document that doesn't get filed anywhere. And so you could have series 1 that has, XYZ asset and has its own members, series 2 that has a totally different asset with totally different members, and so on. So, basically it's like having many different LLCs, but it's really only one LLC technically. And what's really cool about it is the way that the way it works from a Reg A perspective is it's one Regulation A offering. So basically, let's say you have a series LLC.
Let me interrupt you for 1 second. I apologize. Let's just take a step back and talk about what fractionalized shares means and pick any one of the things like a car, a painting, a racehorse, and explain what that means for a second. Thank you.
One of our clients is a company called Otis Gallery, and they sell arts and collectibles. And so their first series, they acquired a Kehinde Wiley painting, and they sold fractionalized interest in the Kehinde Wiley painting. So you can own $10,000 worth of, I don't know if it's a $200,000 painting, I forget the amount. So, you have many different investors who are participating in that series 1, and each of them owns their own percentage interest of that series which owns only the painting, and that's all it's ever going to own, right? So it might generate income from the painting by showing it at galleries or whatever, or it might eventually sell the painting, you know, at a profit or a loss, and those investors would participate in the economics of owning that painting. And so they have really, really cool things that they're putting in their series, like, you know, sneakers that cost upwards of $200,000 and skateboards and all kinds of neat art and collectibles. And so you can participate in that, right? You know, you may not be able to buy a $200,000 pair of sneakers that you think is going to appreciate, but you can buy maybe $10,000 worth of a pair of sneakers and still participate in that alternative asset. So I think it's a really, really cool thing that's going on. And there's a lot of different companies doing this. So it's happening in real estate. You know, we have a Compound Projects as a client of ours, and Arrived Homes, and they're selling either fractionalized interests in a single family house, so you can participate in the rental income of that single family house, or maybe it's a condo in Miami. And so it just allows investors to participate in an asset class that they might not otherwise be able to participate in because they only have a limited amount of funds to invest. And it's all done through this Series LLC. And what I was getting into, which I think is really interesting, is from the Reg A perspective, it's one offering. So for example, you might have, you know, the company set up with Series 1 and 2 with two different assets. You file the Reg A offering, it gets qualified, you sell the securities, the interest in those two series. And then when you want to add Series 3 and 4, you don't file a new Reg A offering statement. You do a post-qualification amendment to your existing Reg A offering statement. And what seems to happen is that after the SEC has reviewed, you know, the base filing and then maybe 2 or 3 amendments, they really understand the company. And so they either don't review the additional series, or if they do, they're already familiar with it. So there are fewer questions. And so it's a very efficient way for these companies to keep raising capital in different series.
Great, thank you. So, you know, sticking with these different verticals, Kendall, you have the honor of having worked on the very first US-based cannabis cultivator for Reg A. And, you know, being that there's, you know, banking issues and it's not nationally legal, it's legal in states, can you tell us what your experience was with that and what are some of the special challenges there?
Sure, and let me also add something to what Lou said. I think that before I get to the cannabis, the fractional interest, these series LLCs are fascinating, primarily because, you know, like the racehorses, for example, I've always wanted to own just a hoof of a horse. And so I can actually go in and invest, you know, $100 or $200 and just own a little piece of a racehorse. It opens up the door to multiple things. I have a client, for example, that we will be filing very soon that is going to, their goal, it's you know, very admirable goal. They want to create 100,000 people of color who become millionaires in the next 10 years by allowing them to invest in real estate. How could you possibly do that without going through Regulation A, where you have the ability to do these series of multiple different real estate projects and let people invest a small amount? So it's really it's a great equalizer for people. And one thing to keep in mind, though, is at least right now under the law, you are limited in that company to only raising $50 million per year. So if you have enough of these series to where the total amount that you're raising is over $50 million, you have to do another company within that year. Obviously, the SEC is planning to raise that to 75 million. That'll help, but it is something to keep in mind. It's not an unlimited series of where you can just keep adding another racehorse or adding another piece of real estate. You got to stay within that cap. Real quickly about cannabis, I did have the pleasure of having the first U.S. cultivator. They touch the plant, they grow cannabis, they sell cannabis all legally in California. The first one to ever be qualified by the SEC. And what I thought was funny about it was when we started finally talking about this publicly before it was qualified, there was a couple of newspaper articles where lawyers said Kendall's going to go to jail. He's going to get arrested at his house in DC. This is illegal. Of course, the SEC did not take that attitude, thank God. The SEC, you know, we discussed this with them before we ever filed. They were well aware that there are other federal agencies that deal with cannabis companies, even though there's banking issues, obviously, the post office, the IRS, I could go on and on, that deal with cannabis companies on a daily basis, that are federal agencies and have no problem dealing with cannabis companies. So the SEC took the attitude of, honestly, it went through as smoothly as any other filing I've ever had. There was no questions or comments that were related to the federal illegality because we had cleared that up beforehand. It's really remarkable that, the bigger issue for me was what's going to happen at the state level. As was talked about on the last panel, cannabis is illegal in many states. And so we took the added step of actually going to, even though we weren't required to do this, we took the extra step of going to every state regulator and asking them if they had a problem with us selling a stock of a company that sells and cultivates cannabis legally in their state, but that would be illegal in the state where we are now selling the stock. And interestingly, we had no problems, no complaints from any state regulators except one. And it was a very interesting conversation. In Louisiana, we got an email from the state regulators that basically said, we're not going to tell you not to do this, but we're not 100% sure we're comfortable with it. There could be criminal penalties. When the word criminal comes up, we immediately all run away. And the company decided to not offer the, and by the way, had a very, very nice conversation with the regulators there who had no problem with it on a personal level, but they had obviously run into some issues in the past with cannabis, particularly at LSU University, where they were trying to do some studies and some scientific things, and somebody didn't like that. So it was really interesting to go through that process on a state-by-state level, which you normally don't do, and frankly isn't required. But the lack of pushback was really remarkable, and the company now has sold stock in all 49 states and also 38 foreign countries, many of which cannabis is illegal in. So the SEC was not an issue at all. They were wonderful to work with on it, and it's the door's open now.
That's great to hear. So I want to move on to Andrew for a first question, but I know that you wanted to say something to add some of your thoughts on the fractional shares. If you could share, please.
Oh, sure. So yeah, so this was so information I tried to put into the chat, but I guess it didn't make it out to all attendees. But just in response to a few questions that came in there. But first, for a kind of brief introduction. So I'm Andrew Stevenson with CrowdCheck. So we're a law firm as well as a service provider for compliance so focused on online securities offerings that were made possible as a result of the Jobs Act. And so we've seen, we've worked with, been around since 2012 and seen, every manner of company that's kind of coming through and trying to explore how they can take advantage of sort of online sales of securities and reaching a broader audience without using a traditional financing structure of investment bank intermediaries. And as Lou brought up, the fractional ownership and using series LLCs is really interesting because it allows for, and it's something that really is only possible because of Reg A and because of the ability to reach investors through online mass communications. And so just a couple just notes that I put into the chat that I didn't go out, I think I just did it incorrectly, so it didn't go out to everybody. It was really just that whenever, so using the series LLC, the asset is owned by the series acts as a separate entity, even though it is a kind of a series of a master LLC. So the series owns the asset, investors own part of the series, and each series is segregated from every other series. So if a creditor comes after one asset, they will not be able to touch any of the other assets. And that's something that's really important, why series LLCs are so useful in this way. But then it's just a matter of the practicality for that company using the series LLCs, just to make sure they do maintain their separate books and records, because that's one of the reasons why other states some states aren't as favorable to series LLCs as Delaware is. They don't like how companies can sort of, they think it's sort of kind of a sham in the way that they're sort of, but you're really one company, right? No, we're a master LLC and we have each series that operates as a separate entity. And so it's important to actually operate those series as separate entities with separate books and records and bank accounts and the like.
Great. So I'm going to break in and ask you specifically about another vertical, which is fan-based or affinity groups. I know your team has a bunch of experience there, and we're actually working on one together. So if you could talk to us about that.
Yeah, and again, and this is again something that becomes possible as a result of the Jobs Act and Regulation A as it's currently written. So with with the standard registered offering, your companies are very limited in how they can market, how they can reach a wider audience. It's sort of everything is just limited by what's in your offering prospectus that went through the registration process with the SEC. With Regulation A, you've got ability to do massive testing the waters to reach everybody, even after you filed but not yet qualified the offering. You can still go out and do that testing the waters. And then once qualified, you still have wide ability to communicate through digital means. So you're also meeting the requirement to deliver a copy of the offering circular. And so what we've seen is a lot of companies that have that have existing networks or have networks that they can tap into, either sort of whether it's fan-based. So if a sort of music artist or a sports team wants to reach their community, reach their fans, make those fans into owners. They can do that because they have that marketing data available from their existing operations, so they're able to reach out and have it and get those people interested, or they can just be using kind of communication channels that they normally use for marketing. Marketing what they do, able to get those people interested and become investors who will be so it's kind of taking a little next step in being committed to to that team or that artist. It's making a person owner, having some sort of financial interest in the success of that person or team.
So I'm going to jump in on that and say fan base is very interesting. Also, if it's music and they mostly appeal to tweens, as if, for instance, they're not really an investor class.
That's gonna be a little challenging because it's they have to have parents to buy for them. But,
so new music versus classic music, classic rock might be a little bit better depending upon who it is, and that again is from an investor acquisition perspective. So I'd love to change the topic to real estate for a second, and I know that Lou had some ideas on that, and I know that both Kendall and Andrew have worked on that as well. So Lou, can you talk to us about new trends going on in real estate?
Yeah, sure. I think Reg A has been great for real estate. I mean, there's tons of REIT offerings. You look like a REIT sponsor like Cottonwood has done 4 or 5 different REITs where they've raised lots of capital and have been able to develop multifamily properties. So I think people understand real estate, and retail investors want to get involved in real estate. So it's a great industry for Reg A. And then we spoke about, fractionalizing interest in real estate, whether it's a single family home where, you invest 10,000, maybe the home's only worth 50,000 or the purchase price is only 50,000, but the sponsor will get a property manager to manage the home. They'll find the tenant. It'll be income producing. And so you invest 10 out of the 50 and you have, 1/5 of the income from that property. And of course, if the property's not making money, you're not going to get that income, but it's a real estate investment that you can make with lower funds, a lower amount of money than you otherwise would have to invest.
Great. And Kendall, you had mentioned something about social causes earlier, and I know it's something that your firm has gotten pretty deeply involved with. Is there another example you'd like to share?
Well, I think it's a dangerous world to get into. If you want to piss off 1/2 of the United States, pick a side and start promoting an offering to it. On the other hand, there's plenty of people on both sides of the aisle that will invest in various social causes. So I mean, I've seen the gamut of this, but one of the things as lawyers we have to do is to advise people that, you know, and Andrew, you know this as well as anyone, what you're basically doing in a Regulation A offering is you're marketing your company. You're not just marketing selling stock, you're marketing your company. You're spending the money to get more awareness of your company. So if your company is on one side or the other, you're going to be very openly pronouncing that to the world through digital ads, through interviews, through social media posts. And if you, as I look behind me, I see Joe Biden up there. If I were doing something on the right now, you would certainly not want to see Joe Biden behind me. Flip side is the same. If your cause is something on the other side, you don't want to see the other party, but you run into these situations all the time because when you're marketing to raise capital, you're also marketing your company at the same time. And all of Regulation A, I mean, I'd love to say this as a lawyer. I'm a lawyer to get you to the point where you market, and then I take off my lawyer hat and I become your marketing partner and help run your offering and make sure that the marketing is being done correctly. But the first thing you have to tell people is you're going to be marketing your company. You're going to be going out and talking about it, and that's going to have consequences to your company, not just raising capital, but the company in general. So it's a very, very touchy fine line, and I've managed to walk it very carefully with companies on both sides of the aisle, and we'll continue to do that. But it's something, Andrew, you're very well aware of, and everyone is that does this. You just have to, in today's world, be very careful.
And I will state for the record, we're involved in political marketing as well. But besides the social stuff, we've talked about real estate. Andrew, do you want to talk about innovation? Because that's another big area. And real estate, I look at yield, social, innovation. Those are some of the three hottest areas in Reg A.
Yeah, so I think absolutely. And I think in a lot of times, in a way you can kind of boil down different types of Reg A or crowdfunding offerings. It's for friends, family, and fans, which is sort of your affinity groups and fans investing. Sort of alternative asset classes, which is sort of the fractionalizing what we can deliver through that, and then also public venture rounds, which to describe the types of sort of innovative startup companies that are utilizing Regulation A. In there, it's and we've seen worked with a number of companies that have done this, and it's sort of following. It will typically be they have some cash in the bank. It's following on from a seed round. Or a previous A round, and then it's providing terms that do account for the risk for that early stage investment, but maybe they're just a little bit different, so not quite as favorable as what would be given to sort of venture capital firm or some type of institutional investor. And the companies are able to do very well with that, raising $5–10 million. As a kind of a bridge to the next thing, becoming a sort of the semi-public reporting company under the Reg A regime. But a lot of it goes to what Kendall was talking about. It's a good strategy for companies that believe that they will have some sort of kind of consumer face of their operations in order to be, because to be that marketing, have that marketing aspect to it as well. There's some risk to it because you're going out publicly to investors. It's not before the company is fully matured. Many of these companies they're clearly not ready yet for an IPO, but maybe they are. But they are ready to raise a few $1 million from the public through an offering under Regulation A. And so there's some risk to that because you do need to start putting together audited financial statements. You need to make sure that that you fully understand what the risks are to the company. So what is and willing to put down on paper, what is it that keeps you up at night? And that's can be a challenge for a lot of early stage companies they just don't really want to fully admit what could potentially hold them back from being successful. But that's a very important thing to do in a public securities offering, because actually it's there to protect protect the company from liability to investors.
Agreed. And not only
Hey,
does the company need to state that to their attorneys, they also need to tell that to their investor acquisition or their marketing firm as well. And far be it from me to end late. We only have one more minute.
Hey.
Oscar, were there any questions that you want to pose from the queue?
No, I think you guys covered most of the questions. Most of you were participating with some of the panelists.
So just one other thing is that we do have a panel of companies who are in the process of doing Reg A. And I think a bunch of them actually cover some of what we talked about in this panel. And that's at 1 o'clock. So 1 o'clock Eastern. So that'll be really interesting.
Yeah, I think Lou wanted to get one thing in on the last
thanks,
topic.
Andrew.
Sorry.
Appreciate it. I was just going to add, Andrew mentioned yield deals, and I neglected to mention it before. There are a lot of really interesting yield deals in Reg A. If you look at the myipo.com platform, which is run by Cambria Capital and Digital Offering, we have a couple of our clients on there. One is in the funeral industry, and they're selling preferred units or preferred shares that have, I think it's a 5 or 6% annual dividend, but after a number of years, you get 150% of your money back. So over the time, it's like a 16 or 17% return. They're a Remembrance Group, and we have another client that's in the mobile home development. They run and operate mobile homes or manufactured housing. They're called manufactured housing properties, and same kind of deal. So there are a lot of these really good yield deals out there that you can take a look at, and they could be great investment opportunities for those looking for yield.
Yeah, and there's tons within hard asset and within soft assets doing that, and a bunch that we've worked on, a bunch that are coming to market soon. So thank you very much, Kendall, Andrew, Lou, and Oscar. I guess it's time for our next panel.
Great. Thank you, everyone. I really appreciate it. That was a great discussion. It's giving people more ways to think about how to use the regulation. It's not just simple vanilla. It's got a lot of different exotic flavors to it. So the next panel is going to be hopefully answer some of the other questions that are arising and by the people that are attending. Thank you, everyone. That you're here today. We really appreciate it. It's early in the morning in the West Coast and some parts of the world as well. We are on YouTube as well, YouTube Live. So appreciate that you sharing that with everybody. So today I am joined by, you've already met Kendall Americo and having some discussions about some of the verticals. And these two particular lawyers, the next one, Sarah Hanks, have been really actively involved with issuers from other countries. And this is really, so companies that are coming either from Canada, the UK, Australia, India, and so on. And it does, so there's the regulations used in the US, and now we got to apply the rules in that applies related to where you're coming from. So today we're going to get that discussion started regarding that. And because Kendall and Sarah both have great experience with particular companies without actually disclosing them, I'll leave that to you. So let's start with this. So let's start north of the border, because north is the closest one to the Canadian border. I mean, to the US border. Sorry, did I say the border moved? No, I'm sorry, it didn't. It's there. So obviously, Kendall, you've had some experience with the Canadian side. And tell us how that's been. Tell us what the companies had to deal with in order to meet those regulatory obligations in that jurisdiction.
Sure. Well, I mean, from the basic standpoint, you have to be a US or a Canadian company to use Regulation A. What does that mean? I know Sarah and I both have a lot of thoughts on that, because there's not a little book you pull off the shelf back here that you open up and go, this is what it means. We have to base it on what the SEC has told us over the years. We have to base it on precedent from enforcement actions and things like that. But one of the key elements that everyone needs to be aware of is that being a US or a Canadian company means that you have to have your principal place of business in one of those two areas, either the US or in Canada. And if you don't have your principal place of business there, then you can't use Regulation A. So that brings up the magic question of what is the principal place of business? And this, again, you can't just pull a book off the shelf. There's a lot of different interpretations about it. I've been through this battle many times with clients. Obviously, one of my clients that had no trouble with it is Brewdog. They had done the same thing as Regulation A in the UK over several offerings before they moved to the United States. All in all, the company has raised over $130 million from over 100,000 individual investors all over the world. But when they came to the US to do a Regulation A offering, they needed to be able to legitimately have a company that could do it in the United States. Well, it wasn't hard for them. They built a $30 million brewery with full offices, there's its own CEO, it's its own US subsidiary of the parent company. That's an easy one. That's a legitimate company with legitimate offices, with legitimate plant that creates a product, and all of those people are here in the United States. That's not a hard one. A hard one is something where someone comes to you and says, hey, all of my operations are in Italy. I happen to live in the United States. I'm the CEO. I'd like to open an office here over at the WeWork. Is that going to work? And my answer to them is no. It's going to take a lot more than that. But I'm interested to hear Sarah's experience too, because obviously she's dealt with this many, many times also. And it's always fascinating to me because I really can't find a bright line test that says this makes your principal place in the United States. It's always just a combination of factors. And I try to throw as many of those into the fray as possible to not have the problem.
Perfect. And I'm going to throw this one at you, Sarah, because this is so north of the border of the US is Canada. You're right, and Kendall, as you said, the Regulation A is intended for companies in those two jurisdictions. But even from when you're from Canada, there's some little intricacies that are involved that depending where in Canada you are, meaning what province, there might be some additional undertaking. And Sarah, I know you've been dealing with that with Canadian companies. What could you share to Canadian companies who are looking at this at the moment?
Yeah, I mean, the starting point has always got to be, if you are coming from Canada, talk to your Canadian lawyers, because one of the big differences between the two jurisdictions is that Reg A that we're dealing with is a federal law, and there is no federal securities law in Canada. So there is no authority to say, whichever province you're in, if you do X, you get to not have to go through the registration or qualification or approval process, whichever it is in the jurisdiction. Excuse me. And so the starting point has always got to be when you are coming from a province. And when I say coming from, you're incorporated in British Columbia. You need to talk to the lawyers that you deal with in British Columbia about what you need to do at home, because offerings from those jurisdictions, even if you're not offering in Canada, you have got to comply with the regulations in the jurisdiction that you're coming from. And then on top of that, as well as complying with the federal laws of Regulation A, if you want to be doing an offering in Canada at the same time, you're going to have to go through the sort of piecemeal of Canadian legislation and regulatory issues to make sure that you comply with each jurisdiction, each province that you're offering in. So in some cases, you're selling to accredited type offering investors only, and sometimes you're using a private placement memorandum. In some places, they actually have crowdfunding, and that might fit. So this is one area where, sometimes you can criticize the US for being so damn complicated. Now, it's more complicated in Canada right now. With respect to, I just wanted to loop back to one of the questions that I see in the chat here, and I saw it raised earlier. Why Canada? It's not just because Canadians are nice. We love Canada and you're so polite and everything, and that's great. But there is a long-standing relationship between the US and a long history in which US securities laws have treated Canada differently. For example, the multi-jurisdictional disclosure system that I worked on when I was back at the SEC a million years ago. The general idea was that there would be some way that you could register with the SEC and with the local authorities in your own jurisdiction. And we started with Canada because Canada has always been treated differently because it's closer, because there have been memoranda of understanding with respect to enforcement of securities laws between the two. There is, they are members of the North American, Canada as well, securities administrators. There's always been a tight relationship. And to give a bit of really weird history, you know who else used to be treated the same way as Canada? Was Cuba. That was a while ago. A bit of weird history, but that's the reason why Canada's always the one that it's sort of easiest to loop into, because the rules are the same, the attitudes are the same. There's multi-jurisdiction, that there is some memorandum of understanding with respect to the relationship. And so that's why Canada, but if you do come from Canada, if you don't make an offering in Canada, it's super easy. If you do make an offering in Canada, super complicated because you've got to go through each jurisdiction. There's no state preemption as there is in the United States. And just
it just does make it great to have that comprehension, because whether you come from Alberta or Ontario, it's not just an automatic shoe-in to use the regulation. There's a way to get in, but you need to deal with your Canadian side first. So for those who go, hey, I just need an American lawyer, I need to be very clear to everybody here that Sarah, Kendall, and the many others need to speak to your legal party on the other side, because they need clear direction as to what exemption are you going to use in Canada if you're going to sell securities, or you're going to bypass them. Now, this is really important. This is if you are a Canadian company. It's quite the opposite, as Kendall has discovered, when you're an American company coming into Canada. Kendall.
Well, I just want to echo, both of you said this, but it's incredibly important that people don't forget this. You need to get advice from other country lawyers in other countries where you're going to be dealing with their securities laws. Obviously, I'm licensed here in the United States. I'm not a Canadian lawyer. I'm not a UK lawyer. And yet my biggest client is a UK company at the parent level. But I bring this up because something really interesting just happened in the last, literally in the last month, that it's the first time I've had to deal with this. BrewDog decided that they were going to launch a marketing campaign for the Regulation A that's going on here in the United States right now, with their offering that they just launched in the UK at the same time. And they just built a brewery in Melbourne, Australia. So now they have 4 breweries, one in Germany, one in the UK, one in the United States, and one in Australia. And Australia has a equity crowdfunding law. The UK has an equity crowdfunding law, and obviously we're dealing with Reg A here. So there's some very interesting byproducts of getting together with an Australian attorney, securities attorney, a UK securities attorney, and the US counsel sitting together and talking about they're marketing this in many cases all the same way. You're investing in BrewDog. Well, we have to be super careful that when people come to the US, they understand they're investing in BrewDog USA. They're not investing in BrewDog in the UK or BrewDog in Australia. So companies that have these types of international scope, where they are raising capital across borders and doing these things, which almost every Regulation A company is raising money across borders. You need to be very smart about getting advice from counsel in the countries where the offering is being promoted to make sure that you're doing things the right way and following those laws also.
Yeah. And I'd like to add to what Kendall just said with respect to offerings into the other jurisdictions, because this comes up again and again and again. I mean, most of these offerings are online. People all over the world, I mean, the internet goes everywhere. And so you've got people emailing from Bulgaria or Rwanda or somewhere saying, can I invest? And we've sort of worked out the whole world in sort of a series of risk analysis, because there are some countries which will only bother about whether you're selling into their country if you do what I think it was Mark Roderick on the previous panel, if you actually actively solicit. And that includes like most of Eastern Europe, some parts of Western Europe. There are some countries who really don't care one way or the other. That includes some Asian countries. And then at the top of the list of, you know, do you really want to do this, is to use an intelligence term, the 5 Eyes. You know, US, Canada, New Zealand, Australia, UK. Those guys are really fussy about what you do with investors in their jurisdiction. And at the top of that is Canada, because we have been in the very early days of Regulation A. One of the companies we were working with did an offering and took money from people in Ontario, did not solicit, did not market, did not send anything, neither they nor the broker they were working with sent a thing into Canada, especially Ontario. Ontario said, you took money from investors in our jurisdiction. We count that as selling into our jurisdiction. Where's your exemption under Ontario law? And we're like, huh? The upshot was the issuer had to give the money back to everybody who invested from Ontario. Now, we have heard, and I know we've had this conversation, Oscar, that maybe the Ontario authorities are not so bothered when there is a FINRA registered broker-dealer in the loop. We haven't seen anything official about that, and I would note that the guys who had this experience did have a FINRA registered broker-dealer in the loop. And so a lot of the, you know, do you need to do something in a foreign jurisdiction is going to depend on, are you taking money from people in risky countries? And the risky countries are the ones who are super enforcing their investor protection laws. So, you know, it includes the 5 I just mentioned. So one of the things that I was also mentioned on the panel was the slogan that everybody uses, all of the platforms, all of the issuers using at least our base subscription agreement says, by investing in our company, you are representing to us that it's legal for you to do this. Now, does that help? 2%?
Just 2%.
It doesn't hurt, but you cannot put the burden of regulation on the person who is the protected entity under securities law. Yeah, I mean, it doesn't hurt, but it's going to help you like yay much.
You know, it's been interesting. So just for everybody who's listening in, one thing about that this discussion kind of goes back and forth. So there's one, you being the entity itself and where you come from. That's one part. And then part number 2, where the investors come from, is part 2. Yep. And sometimes people get them confused with the other. But the one question that always comes up, and I know that you brought up an example, Kendall, regarding BrewDog, who have been exemplary. I mean, they are the shiny light that everybody looks forward to for Reg A, because they're private, they're staying private, and they're growing their business. And I love their name for their shareholders, equity punks, right? But the question I get often asked, oh, all I need to do is set up a company in Delaware, Arizona, Wyoming, and all that. And obviously it's not just about that. And I know in the past we've asked this question that are you going to expand into the United States and that's why you should be here? Or are you going to operate in the United States? So can we talk a little bit about, because there are a lot of people, I mean, look, we have 47 different countries, 43 different countries here. So they're looking to, what do they need to do? Do they need to immigrate? Do they need to apply for an EB-5? Or do they just need to simply find people, set up a shop, and start operating in the United States?
If I had a dime for every company that's contacted me that said, I just want to access the 300 million people who are investors in the United States, but I don't want to do anything else, I'd have a lot of dimes. But the reality is, if you're going to use Regulation A and you're a foreign company, you're going to have a legitimate business purpose that's going to make some kind of sense to the entity you're going to have to set up. And sorry, I'm talking like a lawyer. Let me give you a more realistic, let's say you're a manufacturer of some product and you're based out of Bulgaria and you want to access the US market. Maybe you're not selling any of your products here in the United States, but you want to expand into the United States and get your products into the stores here and have consumers buy your products online. It may make sense for that company to set up a subsidiary here in the United States. They set up a wholly owned subsidiary of the Bulgarian company, and that's the entity that goes to the SEC and says, we're going to raise money. Now, when you do that, you're going to have to explain to investors here in the United States what they're investing in. You're investing in a subsidiary of a company that may or may not be doing the kind of business that you're thinking of when you see the big parent company name. And the bottom line is, one of the ways that that's done is that you say, well, if we do any sales in the United States or in North America, or if we have any type of revenues that come from those areas, that's going to go into this subsidiary. That's why we're setting this subsidiary up. So a lot of this really isn't securities law. It's basic corporate law. There's a lot of accounting involved. There's a lot of tax law involved. These are very heady things that need to be decided by a company before they say, I'm just going to go raise money from the 300 million people in the United States using Reg A. You've got to have those people get a legitimate chance at a return on their investment through something that's going into that company. It can't just be a shell that you set up and all the money is just going up to the parent company for them to do whatever they want to do. Now, I say that if you do that, you got to tell the investors that's what you're doing. But the reality is you want investors to have some reason to invest and some possibility of a return on the investment, and defining that before you get in front of the SEC is critical, because if you don't, I can assure you, you're going to get comments about it.
I was just going to say that, Kendall. I mean, the first roadblock you're going to deal with, not so much a roadblock, you're going to get the guidance from yourself, people like Sarah, you're going to guide them, but they're going to insist, okay, put it through. The SEC will pick it up and say, okay, where's this money going to? If it's just simply going back to another country, I'm sorry, this thing is a no deal, no starter right there. And that's a good point. We get those questions all the time. Do I just need to set up in Wyoming? I'm ready to go? No. I mean, if it, obviously this is a phenomenal exemption. We have to take care of it. And it is available to foreigners. We have great examples like Kendall said, Brewdog Breweries. We have Elegant brand. Sarah, you have Sagoon, which is an Indian-based company, right?
It's a US-based company.
A US-based company. My apologies. Okay, but there's an example of he does his development offshore. My apologies.
Yes. Yeah, that's an important point. I mean, there's 2 points about the sort of the foreign connections that I'd like to make. I mean, one is, to the extent you're going to be, you want to form a subsidiary, as Kendall was saying, not only does it have to have something real behind it. If you are just doing it to access the investors here, the SEC is going to see that money's going straight up. The SEC is going to say the parent is actually a co-issuer. And they are going to say, nope, as a co-issuer, it's a foreign issuer can't do it. And so that piece is important. There has to be a legitimate business here, which, and I see in the comments here, is different from Reg CF. Reg CF, we have seen this. You can just form a company here and everything can be offshore. That is not the case in Reg A. The SEC is going to expect the primary place of business to be here. And to loop back to something that Kendall had said earlier, one of the things that I've always found very useful is the SEC's definition of foreign private issuer and the role that executives play. So, when you're looking at the definition of what is a foreign company, it includes if you have more than half of the executive directors, and there's a lot of definition about what executive directors are. If they're offshore, you can be a foreign private issuer. So you reverse that and say, well, if that's the case, you need at least half of your executive officers to be onshore. And we have had that conversation with the SEC. It's like, where is your CFO? he looks like he's all over the place. And we were able to say, well, actually, he's just down the road in Arlington. And he's legitimately there working out of his garage. But those are two very important points, is you really do have to have the management here.
Hey, Oscar,
and-
can I add one thing?
Please,
Because I
please.
think
I'll come up to the comment.
it's interesting that when you actually go through this process, you know, obviously Sarah and I, we advise people as to what to do, but there's other professionals that are involved along the way. You know, in many cases, there's a broker dealer. In many cases, the broker dealer or a third party is doing due diligence, much like what CrowdCheck does. And then there's an auditor, someone who's actually auditing the financials. And somewhere along the line, one of those three people is going to raise a red flag if you have a company that is complete BS, that is just a shell, and the money is going to the other parent company. Someone will be raising their hand going, there's a problem here. You're going to catch it in that process generally. At least know before you file with the SEC there may be a problem. So I only say that as a cautionary note to people. Don't think you can BS your way through this and that you're going to manage to somehow get it through the SEC because they're asleep at the wheel. There are literally going to be so many checkpoints along the way that it's just not going to happen. Just do it the right way. Do it the right way. It's well worth it. I think, Oscar, your microphone's off.
Oscar.
Oh, sorry. Sorry, my little baby. I don't want you guys to hear it. But you know what? It is COVID-19, so you're going to hear the sounds of my 5-year-old coming in and saying hello to everyone around the world. What I was going to say is, Sarah said it best. Just because in Reg CF it allowed you, and I ran into this, is that I'm already here. I was able to do it, so I should be able to. It's a slam dunk for Reg A. No, it's not. It's not even in the same bucket. It's a totally different experience. And back to your point, Kendall, that this is something companies need to take serious in their journey in doing a proper offering. And it starts with bringing everyone together, bringing the lawyers, bringing the broker dealers, bringing these critical regulated parties who are going to guide you, help you structure this properly so you can be fully compliant, not legal, fully compliant. I mean, legal is one thing, compliance is another. And, you know, so corporate law is in one side, securities law is alongside of it, but securities law is the one that you don't want to get yourself into any problems with any of the regulators. So I'll start with you, Sarah. Did you have any closing comments that you wanted to share with us today regarding, you know, for anybody who is a foreign company, what checklist they should have ready in preparation to speaking to lawyers like yourselves and Kendall?
Once you've gone past the initial, you know, do you have a legit business here, managed from the US? Then it's very much like a regular US company. And the closing point that I just wanted to make on this, because Regulation S was raised in one of the previous panels, so I've had this question so many times, and it doesn't make any sense, which is, can't we use, for those foreigners, can't we use Reg S? And I'm like, really? You think that Regulation S means that the United States is saying, we are regulating in France, and if you comply with this, you know, you comply with French laws. Does not work. I do not ever, ever, ever recommend using Reg S alongside with Reg A. It is too difficult, and I wrote Reg S, and it's my baby, and it is not recommended to use alongside Regulation S. I'm just going to leave you with that.
Thank you. I totally forgot to mention that earlier. Somebody had indicated that you could, but you educated me on that. She is one of the writers, so if anybody has any questions regarding Reg S, how it's been misused and misinterpreted, maybe that's
misinterpreted.
Misinterpreted. And keep in mind that if I'm correct on this one, Sarah, this was brought in before Reg A, correct?
Oh yeah, it's been around. I mean, giving my age away, it was adopted in 1990.
So that explains the reason. So Kendall, back to you, my friend. Obviously you've been a pioneer alongside with Sarah. So what do you? I mean, you've been dealing with a lot of foreign issues. You're never afraid of them, which is great because it's always good to have friendly lawyers who will take them on. What kind of things can we tell this audience right now to be prepared, to be ready, so when they come on to you to have that discussion, it can be a fruitful one for everyone?
Sure. Well, first of all, I was born in 1990, so I don't know anything about what Sarah's talking about. I'm just kidding. Just joking. One thing that I think is important is, and Sarah brought this up, and I think it's been in the comments, and I'm going to get very basic here for a very short period of time because I think it's important for people to understand. Regulation CF and Regulation A are two completely different animals. They look to the consumer out there who's investing to be almost identical. You go to a page, you watch a video, you click a button, you pay with your credit card, blah, 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 blah. It almost looks the same. Behind the scenes, when you do a Regulation CF offering, you're filing documents with the SEC, but they aren't being reviewed or commented on by the SEC. You're just filing, and then you go and start raising capital. So having, this is one of the things, and I work with every CF platform out there. One of the things that bothers me that they do a lot of times is they'll tell people you don't need to have a lawyer involved. And believe me, I'm all for not having a lawyer involved if you don't need a lawyer involved. But you're filing a document with the SEC that the SEC isn't commenting on. They're not telling you you're doing something wrong. They're not saying we don't like the way you have this structured. They're not giving you any of that feedback. You're literally relying on either the platform who helped you create that document or the lawyers you have to make sure that what you're doing is compliant. Whereas with Regulation A, if there's something you're not sure about, you file it with the SEC and they're going to comment on it, or if they don't comment on it, there's sort of in your mind, at least, it's not a legal presumption. It won't stand up in court. You can't say, well, the SEC didn't tell us not to do this. But there's sort of a presumption that, they're okay with it. Otherwise, they wouldn't have qualified the offering, meaning went through a review process. They asked you questions. You answered the questions. Then they said, you are okay to take this out to the general public and to the market and sell it. No one does that with Regulation CF, whether you're a foreign company, a US company, or what have you. So keep in mind, there is a big difference between saying, well, I did it with Reg CF and it was okay. It was only okay because nobody's complained, or maybe you didn't do anything wrong. Maybe you did and no one's caught it yet. So the danger of just saying, well, it happened in Reg CF, so it's okay, I'm going to do it in Reg A, they're completely different animals, and you can't have that kind of attitude. You have to think through everything on both of these before you file them.
That's perfect. And in closing, I'm going to add to a comment you made that I think is important because I've seen it firsthand, and it's very clear to the audience. Yes, the regulators were kind enough to say the following: no, you do not need a lawyer to prepare the document. 2, you do not need a broker-dealer to sell the securities. You're right, that's what they gave you. But here is the realities. The realities is there's been no successful or an offering that's gone through this path that hasn't had problems. And today, they're likely for you to even execute, meaning getting an escrow provider, credit card, ACH, any of those services without a broker-dealer is now becoming ownable. So the role of a lawyer and a broker-dealer is to protect you. It's the best insurance policy as a CEO, board of directors you will ever have in your company. And it's such a small fee when you consider that you can raise up to $50 million. Seriously, I mean, look, I don't know any other country in the world right now that allows that. Every country is 5 million max, 5 million. I come from Canada. There is none. $250,000. That's your max in crowdfunding, depending. Yes, there's other exemptions. You can use a credit unlimited. No exemption exists like this today that allows you to raise up to $50 million from the general public within the United States and obviously other regions, depending you've done your work. And it's a free trading security, and you remain a private company. All you need to do is do it right. So Kendall, Sarah, thank you again. If you want to reach them, go to www.KoreSummit.io, click on speakers. You can find their profiles, their contact details, reach out and begin the engagement. So I want to say thank you for them. We're bringing our next group in today. This is the main event to some. Some call it that. This is where we start getting the next part of the event where, or part of your Reg A offering, where you now start doing something really exciting. What is that? You now need to market it. Yes, you need to market that offering. And to market an offering is not that simple. Some people say that it's simply getting a marketing agency and let's get on with it. I was at fault too. When I first got involved with equity crowdfunding or raising capital through the crowd, or what is a crowd? We'll talk about that. Andrew's got great examples of that, and so does Chris Burke and Paul here. But what is interesting is that you can't put it in the same category you're doing there. There's some principles that are the same. There are a lot of different tactics to be used. And today you're going to hear from 3 of the leading firms working with either active opportunities, such as Brewdog Breweries, Evolution, Elegance, City Zenith, Co-Peace. Obviously, Andrew, I can't remember all of them because I only have 2 hands. But it's exciting to hear from people who are doing it, not hypothetically, not, I think we would do this. No, people who actually understand it. And I want to be clear to everybody listening here. What does that clarity mean? These are people that work with the broker dealers alongside Sarah Hanks, Kendall America, Louis Vellacqua, Marty Tate, Andrew Stevenson, Jamie Nostro. They work alongside and are working alongside the broker dealers. See, this is a team sport, So see, as you slowly start the day, you start with a journey with a lawyer. Great, you got your lawyer, you picked them. Now you start slowly bringing in the other part, and they all work together, because in order to do a Reg A offering successfully, it is a team sport, everybody on the same page, protecting you to ensure that it's a fully compliant. So without any further ado, I am really excited to bring you this next panel of the leading experts, led by Andrew Korn, which you've met before, Paul Stannard, all the way from UK. It's great to have you here, buddy. I really appreciate it. Chris Burke, a leading media award-winning videographer. I hope I said that correctly, Chris. They're going to have a great discussion with you. They're going to share their experiences with you, what you need to do in order to get you seen and be successful in your Reg A offering. Andrew, the floor is yours.
Thank you. Thanks, Oscar. And hello again, everyone. So this panel is about investor acquisition. If that is a new expression or a new term to people, it's one that was only coined in the spring of this year. I will take some of the credit for that.
It's got a good ring to it. Nice one. Yeah.
And I'm hoping that you have co-opted completely, Chris. So
yeah, I mean, we share, right?
Exactly. So I am the CEO of a company called E5A Integrated Marketing. We are a systematic, data-driven investor acquisition firm. We actually started in asset management. I'm a former portfolio manager, as well as a former chief marketing officer and agency owner. And we work across asset management for hedge funds, ETF issuers, real estate, Reg D, and of course, Reg A Plus and Reg CF. And Reg A Plus has a lot of complexities. And as Oscar loves to say, it's a team sport. So with that are legal filings, compliance, the broker dealers, accounting, but the single biggest issue is a bunch of the lawyers love to say the biggest expense facing an issuer is investor acquisition. So I'm joined by 2 fellow experts, Paul, who is across the pond in London with World Digital Foundation, and Chris Burke of Redtail Media. We were going to have another panelist, Carl Dawson, who was called away with a personal emergency. He is with American Next, and we wish Carl the best and hope everything works out. So I want to give a quick introduction to some of the daunting tasks that we have in the investor acquisition world. So some of it is just the basics of the math. If you're doing a Reg A plus, one of the great things is that you can have a really low minimum amount for people to invest, so you can attract a lot of investors. It can democratize your raise by letting people of all incomes and wealth in. And that ends up being both the good news and the bad news. So let's do a little bit of math together. If you're raising $20 million and you've got not the lowest minimum, but you've got a minimum, let's say at $500, and everyone only invested the minimum, you would need, for all of the other math geeks out there, 40,000 investors. And if you double that minimum to 1,000, or if you were to get your median investment up to 1,000, that would still be 20,000 investors. So there are a bunch of people out there with invest buttons and to automate these processes, and they automate AML and all the other compliance stuff. That's great, but nothing actually happens until someone learns about the company, learns about the offering, is drawn to an offering page, and learns enough to get them to click that invest button. So what I'm going to do to get the conversation going is ask a lot of questions, and we will go back and forth, and each of us will give a little bit of opinion on these different topics. And I'm going to start with Paul. And Paul, if you can just state a little bit about yourself and your company when you get going. Chris, if you can as well, that would be great when you answer your first question, or add on to what Paul's answer is here. Paul, can you tell us a little bit about first what a marketing funnel is, and then how it works in investor acquisition?
Yeah, I mean, a marketing funnel, I mean, if you type in Google, I think there's over 3 million references to it on Google. So it's a pretty important thing to understand if you're trying to acquire any kind of business, whether it's investment or general business. And you know, I think one of the other people that spoke earlier, you know, at the end of the day, this is all about people marketing their business and positioning their business, so that they get people leaning towards them. And my background was in media, so I did some things in media that changed how people consumed media. So developed the very first applications for news online, you know, 15, 20 years ago. And subsequently, I've gone into the investment field around sort of technologies in nanotechnology, biotech, AI, and was fascinated with what's going on in America with the whole Reg A plus and the Jobs Act. So threw my hat in the ring. So in terms of the marketing funnel, you know, what a lot of people don't realize is, you know, they'll go at it with, well, you know, we're going to get a review from this crowdfunding expert who's going to say great things about us, and we're going to do that, but they don't have an overall strategy that takes in all of the channels, because the marketing funnel basically is, to start with, you have to build awareness, then you have to basically get people forming opinions about you, and then they start to build up their preferences, and they go through the consideration stage, and then eventually they act. And if you are not communicating across all of the channels all of the time, then you can't, you know, you might reach out to one channel that these days only represents 20% of the audience, and we all live in this over communicated world. So you've got to reach many channels, and then when people get that level of awareness in terms of what your business is all about and what your brand is all about and the mission, then they can then go and do their research on you and form those opinions and start to build up those preferences.
Great. Chris, do you want to talk about the funnel for a moment?
Well, Paul's pretty much covered it, so I think I'm going to just go grab a drink. No, that was really good. I appreciate that intro, Paul, and it's actually interesting because I got into this world, I guess indirectly from Paul's side of the pond. My initial foray into equity crowdfunding was working with a company called Brewdog, who are Scotsmen, obviously. Now they have operations in America and Australia, as well as, you know, in addition to bars all around the world and dozens of different countries, I think. But yeah, we were working on equity crowdfunding campaigns with Brewdog. I looked it up. It was over 10 years ago when they were doing it in the UK. So, you know, you guys over there, Paul, were maybe a little bit ahead of the curve. Yeah. And so, you know, the Jobs Act hadn't happened yet. Reg A wasn't a thing. And my background is in media production, kind of maybe tangentially similar to you, Paul. And my production company, you know, we make shows for people like Discovery and Food Network and stuff like that. But we've also done client direct marketing content. So everything from commercials to short form documentaries, that kind of thing. Kind of trying to raise the level of corporate video, as has been happening over the last decade or so. And one of the things we got into was doing a lot of work in the craft beer space, and got introduced to BrewDog. And then those guys, you know, reached out to us and asked us to create some videos for this thing they were doing called Equity for Punks. And the rest is history. And they've raised, I think, over $120 million, something, you know, north of that, from tens of thousands of investors worldwide over multiple rounds they've done. But we were also involved with the first Reg A that they did when they were raising funds for BrewDog USA, which is going gangbusters in Columbus, Ohio now. So that was kind of my entree into this world, creating high octane content for BrewDog. Obviously, if you know anything about them, it's a lot of pyrotechnics and helicopter stunts and stuff like that, which is all well and good, but it's not for everybody, and it doesn't need to be, right? I mean, I think, you know, a sophisticated scientific, you know, biotech company wouldn't want to do a helicopter stunt the way BrewDog did. It wouldn't be on brand, it wouldn't work. But what we try to do is bring that sense of storytelling that will catch people at the top of the funnel, and then also start you know, re-engaging, helping with retargeting ads, everything like that, and keep them interested all the way through the investor acquisition journey, which ends with an invest click, hopefully, if they finish their filling out their form. And then, you know, sometimes there's follow-up as well with abandoned carts and like that. You know, so we really come at it from an engaging content standpoint, but that's only one part of it, of course.
Okay, so I'm going to just back up and just talk globally for a minute about essentially a marketing funnel is a structure that's built so that if you have different media outlets, advertising, and the different places you might advertise, or you're going to do emails, or PR is bringing people in, social media is bringing people in, what does that experience and journey look like? And that journey can be structured so that you can actually decide what people are going to see next and do next. And you can structure that behavior through a marketing funnel. Now, people are highly idiosyncratic and they like to do what they like to do, and they also like to do it at a different pace. So a good marketing funnel will be flexible enough to be able to handle that. It's very interesting. Paul is in London. I'm in New York. Chris, I believe, is just outside of LA. So, we're in geographic areas, and we may actually think about things slightly differently, just the way investors do. We may approach them at different speeds. And at least I have a killer dog in the background. So I'm going to ask another question.
You're trying to get top of mind awareness. That's
right.
People will remember the dog.
Standing out from the pack, exactly.
Yeah, she's not a brew dog though, but she is an attack dog. So she's a full 12-pounder. Sorry, I muted there because she was going at it again. So, talking about, there's the top of the funnel, which is all the different ways you can bring people in. Why don't we talk about the top of the funnel for a couple of minutes? And Chris, why don't you start this one?
Yeah, I mean, I think there are, as you say, a lot of different ways to do it. One of the big things that we do, that I know a lot of other firms do as well, is a lot of digital ads. And that is a great way to get initial impressions and then obviously retarget people as well. And when I say digital ads, I'm largely talking about the infamous or famous, however you want to look at it, duopoly of Facebook and Google. And their sort of ecosystems. And when I say Facebook, I also mean Instagram, obviously, and all the different platforms, largely mobile, but desktop is still a factor. And people are on there, and obviously with Google, there's a ton of exposure for branded search and display as well, and also YouTube, which I think everyone knows is a part of Google, but sometimes we don't really remember that. I kind of think of YouTube, at least from an advertising perspective, as an extension of Google. And so it's about getting initial touches with the sort of wide net like that, and then figuring out, being intelligent about the audiences that you're looking for there, and then remarketing. And you mentioned email before. That's a great one. Interacting with PR as well, as you sort of get people down that funnel. I think for me, my personal approach is definitely Google and Facebook as kind of the starting bolo net, if you will. I'm not sure if the dog
Paul, do you
agrees
want
or
to add on
disagrees.
to that?
Yeah, I mean, obviously they're all the from a digital marketing perspective, the ones that everybody goes for. But some of the other ones, targeted display that I know you touched on there, Chris, but also native advertising marketing. I think there's an opportunity there as well to storytell, and on some of these, that you can really drill down in terms of the audiences at a much more granular level. And I think, but the thing is, none of these platforms are a silver bullet. People say, well, I'm just going to spend all my money on Google, or I'm going to spend all my money on Facebook. They've got to look outside the box, because, there are many other things going on, and all of those audiences will only engage you in a certain way or a certain manner.
I think that's a really good point. And when you talk about native advertising and getting more granular with audiences, you're referring to like written pieces, like essentially what we used to maybe call blogs, or I guess you could still call it blogs, but you're talking about written content, right?
Yeah, written, or I mean, it could be audio visual, but it's basically like sponsored content on a news website. So
what I like about that too is one thing that I think we're all being advertised to so much all the time. As I think Andy said at the beginning, there's just so much noise out there. And so sponsored content like that, a lot of times I think consumers or investors in this case are sophisticated. They know it's sponsored. They'll see, this is sponsored, but maybe that's okay. It's still valid information. And that's something that I think is really helpful with these offerings, is all of these companies that are issuers in these cases are doing something really interesting. They have, a piece of technology, an idea, a service that's really cool and is designed to move things forward for humanity in one way or the other. And so talking about that in a way that maybe isn't as salesy and is more of that native content can be, I think can be great, because it gets you away from constantly having to sell, even though you're obviously trying to move people through the marketing funnel, the investor acquisition funnel, as I guess we could call it for our purposes. I think there's inherent value to a lot of that content. And I read that kind of stuff and I learn from it, whether or not I go and invest or buy that product,
Yeah, so
sorry.
Could be done also with what we like to say is, tell me something I don't know. So if the issuer has a product or service, and let's say it happens to be real estate and they're building in primarily Texas and Florida. Well, here you have two states with no state income tax. You've got migration into the states, places where I am, like right now, New York. People are leaving the state over the last couple of years, and California too. There's big migration in and out all the time. So if those statistics can be presented in a very interesting way, where it's like, oh, I didn't know that, that makes it so, gee, there are going to be more people need a place to live, bam, okay, this makes a very solid investment. So that kind of content marketing and almost teaching, we refer to it as trying to get to that aha moment of, oh, I get this, this makes sense, and yes, I'm going to want to invest in that. So the question along the journey is, how many touch points does it take to get there? How many times do they need to see an ad, get to an offering page, et cetera, and what does that take until they say, yes, I've got this and I want to do it? So most people doing, or most, at least the clients that we've encountered in Reg A, are brand new and no one's ever heard them before. So there's no brand awareness. And if they have a unique product or service, no one really understands that either. So that is kind of daunting to start with. Paul, what's like the first thing you do to get that going?
Yeah, we'll break it down. Find out what resonates with who you're trying to communicate, and back to what you were saying about tell, sell, sell. You know, you got to earn to learn. So when people are actually listening or watching or reading those messages, it's really important that they actually really resonate with what you're saying, because there's loads of research out there now that we don't like being sold to. I don't think we ever like being sold to, but the reality of it is we have so much at our fingertips that we want to self-learn. We want to go on and do our own research. We want to go and find out what that business's reputation is like, what its mission is. So if you don't get into their minds and resonate with them from the get-go, then you're never going to get along that 7 points of separation until the word is yes. You know, I mean, one of the best analogies I ever saw of this was back in the 70s. Coca-Cola were trying to look for a new message in the 1970s, and they commissioned somebody to do a focus group. So instead of the company deciding what we need to tell, sell, sell, which is what a lot of these start, they've got such a story to tell, they just want to splurge it out, and actually that's not going to work. You're just going to switch everybody off. So what Coca-Cola did, they asked people to go and do a focus group before focus groups were a thing, and actually went and asked people around America what they thought about root beer and about the different root beers, and then asked them some questions about how they felt about America, and it was in the 70s, so it was Woodstock area, peace, love, and all the rest of it. And they came up with, took all these key words and wrote a song called "If I Could Teach the World to Sing in Perfect Harmony," and put a load of people around a canyon, and it was the most successful campaign that Coca-Cola ran for the previous 20 years. And then they brought it back 20 years later after the Iraq War, the first one, and it was a success again because it resonated with who it was trying to talk to. So having a mission message, you know, people get carried away with the channels of communication. I think, you know, you should be using 6, 7 different channels, and you should be using old media, new media, because they all have a place. But if you don't get the messaging right, then basically you're just going to fall in the trap, and you are going to irritate your audience beyond belief.
Great. So, you know, I had wanted to get into kind of how you kind of coalesce this message and maybe how you might onboard a client or something like that. How do you get to the crux of this? Chris, if you could address that, please.
Yeah, well, I think, you know, my career started in producing on-air promos, actually. So I had to learn that pretty quickly. So we would be, you know, handed either a subject or a plate of footage, and we had to make something out of that and make people understand why Roger Federer was a player to watch on the ATP Tour in 2003. Well, you know, we see where that ended up. You know, you have to basically say, okay, what are we trying to communicate? How do we do it in a short time? And, you know, in on-air promos, that's 30 or 60 seconds or whatever. And nowadays with this, it's even shorter. So, you know, if you are squeezing the amount of time and impressions as somebody's scrolling first past on desktop and now like 90% on mobile as people are being exposed to stuff, you got to be really smart about what you're trying to say. And that can be the hardest thing sometimes, because a lot of these company ideas or any company idea can be a little bit complex, you know, to really get to the meat of what it's about, but you have to figure out how to boil it down. So in terms of onboarding, I mean, for us, it's a lot of conversations at the beginning with the founders and the stakeholders, board members, you know, maybe early investors, people who really have a lot of understanding about the company. And it's sort of like, you know, taking all that and then squeezing it in a way that where you keep the essence of what it's all about and bringing it together from the different threads, but also make it digestible for the common person, you know. And that can be easier or harder depending on the subject matter, you know. but I think it's really important to do. And one thing that we try really hard to do is to keep that essence of passion about the product or service that the founders have, because you don't want, just for clarifying something, you don't want to lose that, because I think that is what makes these special, is that so many people are out there, entrepreneurs who've come up with this idea and they really want to see it through. They've got a ton of commitment to that. And I think that really resonates with potential investors when they can see how deeply committed and passionate the founders are.
Cool. So I'm going to actually answer this question myself as well, since Carl isn't here. I got my start actually very young, and I was asked to write initial public offering roadshows, which I've worked on literally hundreds of, everything from biotech to steel. So, as kind of Chris said, it's really hard to do if it's something completely ethereal, something that you can't see or touch, versus something that you can, or it's a consumer product and people just understand it. So over the years, what we have developed and have borrowed also is an onboarding process that basically looks at what a company has done previously, and even if that's nothing, that's okay. And then we put together a workshop, and we basically go through a series of exercises until we get a lot of stuff out of the client on, really what the essence is, and not only the factual matter, but also aspirational things, so that we can understand vision and where they're going. And then from that, we put together a messaging platform, get that signed off on, and then give that to the creative team. So, each firm has its own approach, and that I think is a very good thing. And I just wanted to comment also on focus groups. I have conducted tons of them when I was younger, and now won't get near one. And the reason is that we can come up with 3 great ideas. 5 of us, 10 of us can decide, 5 or 10 if the client decide, but I'd rather let 1 million ad impressions, which actually is not very many, let prospective investors teach us what is working and what is not working, and that can lead to optimization. So optimization to me then also leads to segmentation, and one of the things we'll see is, oh, this client has 100,000 people on their email list because they've been in pre or beta, or they're live, or they've got 100,000 people have liked their Facebook page, or they're following them on Twitter. So starting with Paul, do you treat them differently than you do investors who have never heard of the company before?
Sorry, could you just repeat that last?
Sure. So, some companies, and you hear this a lot in crowdfunding, hey, if you have a big social media following, that can be a really good thing. So do you treat them differently from a communication standpoint, followers on social media or people who are an in-house mailing list, than you do investors who have never heard of the company before? And if so, how?
Well, my view of that, or our team's view of that, would be once you've segmented and understood what the audiences are, you still need to have one message. It may be you're testing different things. The new focus group is, as you say, 1 million page impressions will tell you a lot very quickly, and different landing pages and all of that good stuff. But ultimately, you need to stand for something. As Jack Welch said, you've got to goddamn stand for something, and have a mission that people can understand and can take hold of. There's a piece of research out recently that basically the average attention span of a human being now is 8 seconds.
That's longer than I would have thought. Yeah.
That must be women as well. Men have to be shorter.
The research actually said a goldfish has more of an attention span than a human being, which I don't know. It just made good PR that anyway. But the reality of it is, different audiences do need to be treated slightly differently. But you shouldn't change what your mission and your message is, because you just might treat it slightly differently.
Yeah, I would agree with that. I mean, you do have to have that consistent message. That's really important. But it's almost like if you have an interest group that already is familiar with your brand, you can shortcut a little bit. You don't have to do the initial brand intro like, "Hey, this is who we are." It's more of like, you already know who we are. Now we're doing this. You know, that's a bit of a ham-fisted version of it, but you get the idea. You don't have to, you can almost skip the awareness part of the funnel with some of these folks, and you can get to hopefully invest faster. Although it's a double-edged sword too, because you may have people with a brand affinity who don't wind up converting really well to investors. So I think you need to, back to the point at the beginning that both Paul and Andy have made, that you can't rely on any one leg. It's not even, 3 legs like a tripod. It's more, whether it's Google, Facebook, it's email, it's all these different touch points. Relying on one thing too much, including an existing social media list or affinity group, is going to be dangerous. But I've definitely seen it work really well. And I think for me, it's just a nice way to sort of like skip a little bit of the beginning part of exposure to the brand.
The other thing that I would recommend people do is, if they're starting from a very low base, which a lot of these companies are, that are going, because they're building their brand through this through this exercise, is to actually spend some time in terms of building your findability and building your reputation, and actually concentrating on those things first before you go with your go-to-market strategy. Because if people can't find anything about you, and they can't hear good and bad things being written about you on social media or all the rest of it, how are they ever going to start to feel affinity with you when you actually have your go-to-market message?
So I'm going to address that also from a segmentation standpoint, but I want to get back to that whole affinity thing in a moment. So we had a client, they had a 200,000 person mailing list, and we looked at the list and basically said, okay, we're going to take the offering page and we're going to duplicate it, because I don't believe any of these people will turn into investors. Thankfully, I was wrong, and several of them did, but it was a tiny, tiny percentage. Part of it is because of what they do for a living, where their natural affinity group wouldn't really be investors. And, a lot of times we're asking people to not only invest, but invest in an idea, a concept, a product that isn't completely proven. And even if it is, it may not be something where that group of people are normally investors. Plus, you're asking them frequently to put money into an illiquid investment. It's a private company.
That's a
So
tough one,
my
yeah.
firm does a lot of stuff with ETFs, and it'll be, oh yeah, we have that product. We're taking in between $500,000 and $2 million a day on some of those products. But keep in mind, it doesn't translate to Reg A plus like that, because they can't trade out of it 10 seconds later if they feel like it. It's a total commitment. So, also when it comes to segmentation, we'll look at something as simple as real estate and say, gee, the primary reason is that people are investing is current income. Well, we might create actually 3 different landing pages for that. One aimed at people who are 40 and younger, one for people in their 50s who are solely de-risking out of equities, and then people who really want income in their 60s and 70s. So the message, that platform is the same, but the driving force or their dominant buying or investing motive may be slightly different, and understanding those nuances can be really effective. Now, how much more work is it to do 3 different pages? Well, how big is the offering, and is it worth it? And can we be more efficient in buying media like that? So all of those things go along with that. And we had talked about, this is a team sport, and we were gotten a little bit into lists and social media and followers. Chris, how do you see marketing firms working into the larger team in a Reg A plus raise with the lawyers, PR, social media? Does your firm do PR or social media?
We do social media. We do not do PR. So, happy to work with established PR firms who really specialize in this space and understand it. But we really love it when there is a PR firm involved on an offering. And, if there isn't one, we'll often recommend it. Hey, you should really do PR, because that will help a lot with what we've kind of been talking about, that initial discovery, that awareness. And there's something about having other sources of info about a company than its own web pages that really helps, it's kind of the concept of social proof. And in a way, it's part of the larger thing that you want to accomplish with social media as well, because if somebody hears of something, or they say they see an ad, oftentimes what they're going to do, it's not a direct path to clicking through and investing. They'll see something on a Facebook mobile ad and then turn to their laptop and Google it, and then they'll click, and maybe they'll see a PR Newswire release, or maybe they'll get, depending on your SEO, one of your landing pages, or maybe a New York Times article if you're lucky, something like that. So the more of a broad spectrum you can have of coverage and awareness, the better. In terms of social media, we do organic social media, I guess, to distinguish from paid, because a lot of the, sometimes people don't realize, mostly what people are going to see in terms of the way the algorithms work is whatever you're paying for on Facebook and Google and even LinkedIn and stuff like that, in terms of how it bubbles to the top. But it is important to have an organic social presence as well that looks nice, that's consistent, that's a good mix of, photos and reposted articles and thought leadership pieces, maybe links to, some of those native advertising pieces that Paul was talking about, or blogs. It is important to have that, because you don't want somebody to see one of your awesome ads that's really nice and well targeted, but then they click through to your page and there's nothing there. And it doesn't mean that you have to go and get hundreds of thousands of Facebook followers or whatever. But you do, I think it's really important to have a solid presence there and have, some telling and some selling, right? You don't want to just be sell all the time. You want to sort of give an example of what does your firm do? What is your product? What is your service? And why is it something that somebody might be interested in, not only as an investor, but as a potential consumer, in the case of goods or things that people could interact with,
Great. And Paul, I think this is a softball for you based on your background, but if you could talk about the team and adding in PR and social.
Yeah. I mean, I've worked across all the platforms, and we can act as a full service solution. But I also think in any kind of mix, you maybe want a lead partner who's your stand with you through the process. But sometimes it's good to have another speedboat comes in that has a different perspective on the digital marketing, or has a different perspective on the creative, and throw something in the mix that 4 people wouldn't come up with that 5 would. So I don't, we do stuff where we can do everything, but we're working on things quite often where I'm working with other partners and they do that bit, and providing everybody is open and there's no defensiveness, then it can be a beautiful thing. It's when people get all proprietary about it, then nobody wins. So yeah, no, I think collaboration is a byproduct of success. So yeah, I welcome it.
Cool.
Yeah, and I think one thing to note too is, we
I think
talked
Chris
a lot about PR and those aspects, but the deal and broker dealers, super important. You can't ever forget about that, the importance of compliance.
I've lost Chris.
Yeah, so I'm going to jump in here for a second. We're going to have another panel.
Am I back?
Yes, you are.
You're back.
We're going to have a panel later today on earned media. And I love that you have to hire and pay firms to get earned media. Firms like mine mostly focus on paid media. And we do not do any social media, yet we usually do the graphics for it. We also don't do PR. But we sometimes put our thumb on the scale. As a portfolio manager, I was a shameless self-promoter, so I know a lot of reporters and a lot of producers for TV and radio. So we'll occasionally tap people who I have met over the years and worked with the PR firm doing that. I was also the chief marketing officer of thestreet.com, so know a lot of reporters from there. So SEO is another thing that, quote, you pay people to do, even though it's, quote, part of earned media. Chris brought it up for a moment, but is SEO optimization, is that an important part of what you're doing?
See, is my internet?
Yeah, Chris,
working?
yes, it
Okay.
is. If you want to be first on this.
Yeah. Yeah, I think it is important. And it kind of is, it's, you know, sort of there's a base level version of that you can do part and parcel with building landing pages, you know, building the investment website for people. That you can then take it to another level. I mean, there's entire firms out there that only do SEO. And I think for stuff like this, typically, I'm not sure how necessary that is unless you're in a super competitive area, but we have found usually that within the scope of what we do on building the landing pages and, you know, combining it with paid media and blogs and things like that, we can get some pretty.
All right. Paul, do you want to jump in on that while Chris is frozen?
Yeah. I mean, I just think we do SEO as part of what we do, and it's just another thing. It's not a silver bullet like all the other things, but it is an integral part. So we recommend people, you know, pick what their halo keywords are, so the things that they'd like to be found on, and we've seen real success on that, where, you know, within 3 or 4 months we've moved the dial, and they're getting a lot more interaction with their organic content. So I definitely would recommend an SEO strategy, especially as once you get invested, then you want to be top of Google for this, that, and the other, and you want to be in that market, don't you?
Great. Okay. And I would just say we look at SEO as a basic. Your SEO has to be excellent, but it doesn't necessarily have to be a big part of general outreach. But if someone Googles you, they better be able to find you. And if they can't, then that's a big problem, because they see something, hear something, they Google you, they've got to be able to find you.
Yeah.
I think Chris is the one who mentioned something about placement agents working with broker dealers. Have you done a bunch of that? And if so, how do you support them?
All right. Hopefully third time's a charm here with actually being able to talk. Sorry about that.
It's okay. You sound fine.
We're at the whim of the internet here. So yeah, I mean, I think the point I was trying to make earlier before I got cut off was just that legal and compliance, you know, and in the case of broker dealer, you got to make sure that you're doing everything according to the rules. And sometimes, you know, those specialists are going to know things and catch things that as a marketing agency, you might not immediately think, well, why is that a problem? Why can't we say that? But you have to learn to think in forward-looking statements and all those kinds of things, and be okay with the fact that sometimes you're going to have an eye chart of disclaimer language on an ad, because that's just how it is sometimes, you know, depending on the context. So I think that's something where the importance of that compliance can't be overstated. I think everybody considering one of these offerings probably knows that, but I just like to say it anyway. Because it's all too easy to make a mistake if you're not careful, and you just want to make sure that anybody that you're working with understands that, and is really making sure that there's a clear path of communication to run things past the right compliance points.
Great. Paul, do you have anything to add to that?
No, only to reiterate it really, because, you know, if you are going down that sort of multi-channel route, which you should, then there's a lot of content that's going to be mixing between those different messages, and it's very easy to fall foul. So don't put yourself in that position. Make sure that everything is checked.
Yeah, well, so I'm going to address that quickly in two ways. One is compliance. Is, you know, my firm has to write compliant copy all day long, every day. It's what we do. We do it for the ETF world, the hedge fund world, the mutual fund world, and of course the Reg A plus and CF world. So that to me is a given, and we have a lot of compliance jokes that run around our office. People always answer questions with perhaps, or we're aiming to. We never say definitely or absolutely or guaranteed of anything. So that ends up happening. But placement agents is a very interesting thing when you're working with a broker dealer, especially if you're doing a larger raise and they have an opportunity to pitch larger clients where their placement fee is literally worth it for them to invest the time to do that. And we end up doing quite a bit of the messaging for them. We also have the data on almost every institution in America, meaning their name, address, phone number, and email address, how much money they're managing, what they invest in, etc. But it's also the messaging and what that should look like and what that journey, which is a completely different journey than the retail journey, looks like. So I have 3 more topics that I want to get through, and we have 11 minutes left. So the first one is platforms, because all of us, myself, I'm guilty as well, have been talking about essentially companies doing this themselves on their own website. Yet there's an entire industry out there. In CF, there are 53 platforms I'm aware of. In Reg A+,
probably more coming, yeah.
yeah, and in A+, there's 5 or 6 big ones and a bunch of other ones, and then some really close specialty ones. So, Chris, do you like an issuer to be on a platform, be off a platform, do a hybrid? What's your view on that?
Yeah, I mean, I think, you know, my experience, I can kind of only speak to what I've seen and worked on. I've worked with people who have been in CF and then go to A, and so maybe they're on a platform and then they decide not to be in the future. I think, you know, I like building the offering pages. I like having more control, you know, on the issuer's behalf personally. That's not to say that platforms aren't good or can't work for some people, but I think in Reg A in particular, because it is such a long haul and so much goes into it, I feel like it's really important to get as much understanding of all of the data and all of the touch points as you can. And I find that easier to do when the issuer makes their own site. That's kind of where I stand.
Paul, do you have experience and opinion on that?
I've had, yes, direct experience, and I would totally agree with Chris. I think, you know, the platforms, you know, there's a garden wall, and sometimes you can't get over it. And it's your company, it's your business, it's your future, it's your data. Why would you hand all of that over to someone else's control? It doesn't make any sense to me after 30 years of advising people in marketing and communications.
So, yeah, so we've had a light touch on that with Chris, who prefers it on the issuer site. Paul takes it to another level, and then I'll throw a jackhammer in on this. We actually will probably not ever work with an issuer who's on a platform for a Reg A+. There are a bunch of platforms. Some of it is spiritual, some of it is practical, a lot of it is data. You know, basically, if a platform, you're going to pay someone like one of us to then drive an enormous amount of very qualified traffic there. And once they register, they are going to then be captive to that platform and remarketed. The other thing is when they get there, there's a menu of options for them to look at. But my biggest reason for not wanting to work with them is simply data. Some of them will not allow us to put ad and tracking to the journey, in which case we lose control. If we don't have control, we can't be responsible. So if you don't raise money, who are you going to point to? So we want to know that if we can place ad tags everywhere, that we can make sure that all the messaging is correct. So I'm going to get to my last question, which is a 2-part question, is how long should a Reg A+ take and how much should it cost? And let's start with you, Paul. What should an issuer prepare for time and budget wise?
Well, I've just used a couple of analogies. Salesforce, which was a big brand that came to the market, you know, X years ago. And for the first, I think, 5 to 10 years, they spent 50% of their turnover building their brand and marketing. If you go to a gunfight with a feather duster, not a gun, you aren't going to win the battle. So you've got to put enough fuel in that engine to get that plane off the ground. And then you've got to keep it there. And you've got to use all the channels of communications until you deliver the message. So you probably across the whole journey, you know, a minimum of 10 or 15% of what you want to raise. And probably in that first 3 or 4 months, you're going to be putting in big amounts of fuel and expertise and strategy and planning. And if you don't go at it right, then, you know, you're going to be turning into the thing what I call spraying and praying. So then they're relying on, oh, some crowdfunding website is going to say something good at me and I'm going to get a bounce on my investment. You can't, that isn't a strategy. You know, hope isn't a strategy. You've got to have a 3 to 12 month strategy and 3 months of planning and positioning. And then you then got to put the fueling, test it, and then go big or go home.
How long, how much?
If you're raising, well, it depends what you're raising, but if you're raising, say, $20 million, you know, you've got to be prepared to spend 2 or 3 million to acquire that, because you're building in your future. You're gonna own that data. You're gonna build that community. You're gonna have those relationships.
And how long should it take, beginning to end, on that 20 million raise?
I think 12 months on average. If you do the planning part of it right at the beginning, you can go at it more aggressively if you get off to a flying start. But you're still going to have to. The more fuel you put in, the higher you fly, the more you take. If you keep taking fuel, putting it in and out, you crash the plane. That's how it works.
Yeah, time passes a lot more quickly than you think it's going to. 12 months sounds like a lot of time, but you know, I mean, is there a way to do it shorter? Yeah, but if you can go 12, go 12. You know, go that full year, and don't be surprised if you spend 20% of your raise. That would be what I would say.
Okay, so I'm going to offer a very different view. You know, our entire perspective is basically building first-party data, meaning data that is yours and yours alone. It's not acquired from Google or Facebook. That may be tools you use to help get there, and that can take a month or two. And once you have that, predictive analytics tells you basically how long it's going to take and how much it's going to cost to get there. So on a $20 million raise, we say from 4 to 7%, and would not exceed 7%. And the reason for that is the way the data is built. You know, the old expression, half my ads are going to the wrong people, I just don't know which half. That went away a long time ago. And if you're doing truly data-centric, data-driven marketing, you should be able to narrow that down reasonably quickly. And actually, I'm very confident that both Paul's firm and Chris's firm use similar techniques. They may not be as chronic, compulsive about it as my team is, you know, because I left the industry and spent that time as a portfolio manager. The data has gotten very serious with us, but the creative team rules as well. So anyway,
yeah, both really are super important to work together. I agree. I think,
yeah, it's a yin yang.
Yeah.
Yeah, I mean, I totally agree with that. The only thing I would add is, when you're going to do a Reg A plus, you know, I've helped other companies IPO in the UK. I've worked with companies that have done it in the States. You know, I had a conversation with Steve Wozniak 4 years ago when we brought him over to the UK. And I said, was you ever in a garage? Did you ever start from some? And he said, no, we started with marketing dollars and we built a brand that people could identify with. And it's not just about raising capital. People think it's just about raising capital. You're building your whole business's future and positioning your brand while you're raising and acquiring capital.
Right.
That's
so,
a great point.
Yeah, and I want to throw a little cold water on some of the confidence that I just showed, because we were in market in January and February, and then people may or may not know this, but a global pandemic came, and basically that changed everything. And I can tell you, in the financial products that we market beyond Reg A, we changed every single one of our ads and every single one of our landing pages because the messaging needed to adapt. And what works in the fall may not work in the winter, which may not work in the spring. So even if you're going after the same exact audience. So there are a lot of considerations with both time and with budget. But what I do want to say on budget is the number one reason most small businesses fail is that they're underfunded. And I can tell you the number one reason that most Reg A plus raises don't raise all the money is because they're underfunded. So that is a super important piece.
Well, not only a super important piece, but an opportunity, which was asked before. Are there companies that are going to come in that middle piece? Because if there is a good opportunity, like you said, needs a budget to do it properly, to Paul and Chris's point, but you're undercapitalized, and this is the way to go. So I think there's going to be new entrants coming in to assist companies in that route. And I love your message all the way across. All of you have different tactical elements to the approach, but they're all needed. I mean, I see it from the other side where when a company's completed, I talk to the CEO, so how was your journey? Well, I love my video, I love this. So they end up utilizing everyone. So as I've said before, continue for any of the attendees that are here joining on, is that this is a team sport, and you need to work with the investor acquisition partners that are there, that actually understand what's needed. And for the CEOs, you go, okay, you cringe, you go 20%. Well, think about it. If you go to your current business plan right now, you already assigned dollars for marketing. And Paul said it best. This is not just about raising, it's establishing your brand. You're reaching to an audience that is going to resonate both with your brand and investing. So you're getting 2 for 1. That's the best deal you're ever going to get.
And to, you know, to tack on with Andy's point too about the importance of having your own data, that data is going to serve you into the future well beyond your Reg A, you know, in the future as you're providing your products and services, you know, that doesn't diminish in value, assuming that you keep building on that, you know.
It becomes actually a corporate asset. It's not just something that's used to help with the fundraise, with the capital raise.
They can be your advocates as well forever, can't they? Creating a loyalty loop that's perpetual.
Yeah, I mean, let's just to circle back to Brewdog for 1 second. I know we got to wrap up here, but you know, those guys, their army of you know, tens of thousands of investors worldwide. Those people are not just investing once and then forgetting about it. They're also going out and buying the beer. They're telling their friends about it. It becomes, you know, an ongoing sort of snowball effect of talking more about your brand. And there's a version of that for everyone, you know.
And they call themselves the equity punks. I mean,
That's right.
I mean, that is a, you know, at CoreConnect, we're playing with our idea to call them gladiators. So, I mean, you're going out there, exactly.
Everyone gets supplied with a short sword and a shield, and then
a shield, and we're moving and democratizing capital worldwide. That's the movement, right? That was the down of the establishment, if you think about it, right? So equity punks created a theme for themselves, and, you know, Andrew, Chris, Paul, that was phenomenal. You know, for anyone who wanted to understand what is different between this and marketing, and you're talking to 3 companies, 3 executives who are leading that path, who have clients today. You're never going to go wrong with working with all 3 of them. Likely is that you will. And Andrew, you did a great job. Thank you so much today. And looking forward to the next round with you guys. Thank you.
Strength and honor there.
Thank you.
Roman Legion.
All right, so I apologize for the short pause there. So I'm just getting used to all of this. I should have used a better technology, but we're getting better at it. So again, thank you to the last group. And this is going to lead perfectly to where we were before. So that you know, the group that Andrew and Paul and Chris Burke spoke about is about the investor acquisition. And now, I mean, you're going to have a great opportunity to meet some really great individuals who then take that and then boom, broadcast it, as they say. So we're going to demystify as well, you know, the discussion is what is IR, what is PR, how does media fit in, and the social element as well. So, and this panel is led by one of the leading authorities. You've seen his face everywhere. And if you haven't, I encourage you to go to fintech.tv, and that is Vincent Gallimore. So we're really excited.
Oh, Marty, you turned me into a squid.
No, it's you know, it's payback for the other. I'm sorry.
You are getting me back.
Yeah, no, it was not intentional. I apologize. And then of course Eric Fish Tank and Jason Fishman. Okay, wait a minute. There's a lot of seafood here into this. I'm sorry, I had to throw that in. It just seemed it was just too easy not to. So I just want to say that obviously you heard the last panel. You see what it all involved, and you're part of that piece, right? This is part of that team sport, bringing it in. So Vincent's going to lead on this discussion with everyone. Enjoy, have fun, and we'll talk to you guys soon.
Hey, Oscar, sorry. And Vince, sorry to jump in. Nick is struggling with the link. Nick,
I will take care of it.
Perfect. Well, maybe I'll just jump in while Nick is getting rolling. And first of all, Oscar, as always, thank you to CoreConnex, and special thanks to Danielle. Always a joy to participate in the KoreSummit. As you know, you give so generously to expanding the ecosystem, creating that education and awareness, and really building a better environment from collaboration, communication, for all of us to, as you continue to talk about, become a team sport. And I think that's really been so powerful in recent times as it's evolved to those levels of collaboration, as you know, you've been the theme throughout the day and before and after, of the broker dealers working with the IR firms and PR and customer acquisition and the transfer agents, and really how it takes that team to really achieve the success that everybody looks for in the issuance. So really, thank you wholeheartedly, and delighted to participate again. Really excited about our panel. Tough panel to follow with all those great experts, but we'll do our best to transition from that and really give some what I think is wonderful about the panel of experts that we have. Is what I say is everyone here is beyond the aspirational, beyond the talk. Everyone walking the walk, and everything is actionable, the rubber meeting the road. So I think there's so much in the way of great takeaways for the viewership to hear from the experts who are actually doing and who have been there building and have real-time feedback and the actionable results. So with that, I'm just going to briefly introduce the panel, and hopefully Nick will be on by the conclusion of that. So first, Eric Fishgren, who is the founder and CEO of Fish Tank, and that is a New York City-based marketing and public relations firm. Welcome, Eric.
thanks, Vince.
Absolutely. And I'll save Nick to last. Hopefully he's on by then as well. Jason Fishman, who is the Senior Vice President of Digital Niche Agency, also known as DNA, which is a bit easier for me. And Jason is really a premier new media enthusiast who is focused across everything in digital channels. Nick, oh, there, perfect timing, Nick. Welcome. Nick is the founder of Marketing Results, Inc., which is an investor acquisition marketing consulting firm for capital raises. Well, first of all, welcome. And I think maybe just to frame it, if each of you want to go round robin, and maybe we'll start with Eric, you know, give us a minute on what Fish Tank does, and, you know, your approach, and then we'll just do a bit of a round robin and jump in from there.
Sure, absolutely. As Vince said, my name's Eric Fishgren. I'm the founder and CEO of Fish Tank Public Relations, based in New York, 20-person shop. You know, we really got into equity crowdfunding very early in the game, comparatively, I think, to you know, really what we're seeing this last year. Several years ago, 2015, 2016, it was some of the early entrants to the industry. That's certainly where I met Vince. We provide media relations, corporate communications, so that can be writing press releases, shareholder newsletters, blog posts, managing social media feeds, all organic. So we don't do paid media, which I know a couple of other folks on this panel are terrific at, are going to share their experience. Really what we're known for the most is getting our clients in the news and doing it the right way. No spray and pray. We understand equity crowdfunding, obviously, as I mentioned. I think I've just been very encouraged over the last year just to see equity crowdfunding just really taking off. I think that's reflected in the amount of registrants and attendees in this conference, and the leadership of the individuals on this panel, and especially Oscar for pushing the industry forward. So just very excited at the legitimacy of the companies and the individuals that are entering the space. We're fortunate that we're working on several high-profile deals right now, from startups, sure, but also being managed by experienced professionals, and we're just really happy to tell their story.
Great. Thank you, Eric. Jason, may we jump to you?
Yeah, absolutely. So I oversee a marketing agency here that's focused on user and investor acquisition campaigns, over 175 to date that have collectively produced 9 figures of funding. We've been working on Reg D, credit investor raises, since 2014, Reg CF upon activation in May 2016, Reg A plus later that year for some test waters, and heavily in 2017. So have a lot of different insights, case studies that I'm going to be able to bring to the conversation today. We like to start everything with strategy, have 3 core offerings: content marketing, advertising, and direct outreach. So you'll hear that in the background of a lot of my answers, as these are all recommendations I have for groups that are preparing to launch. I love what Andrew Corn said in the last panel about Reg A plus campaigns often being underfunded, and am going to hone into that a bit further in some of my answers, but looking at algorithmic projections. The only way to measure anything is with numbers, so that's a big part of our discussions with issuers, and how to scale campaigns from there. Our whole approach towards everything I summarize with these 3 words: test, optimize, scale. You'll find that to be a common theme as well. And as Vince said, we want to provide the audience with actionable insights. So you'll hear in the different case studies ways that you can integrate that into your own strategies or any groups that are in your portfolio you're currently working with today.
Perfect. Thank you, Jason. Nick, if you wouldn't mind, give us a little background.
Sure. So my background really comes from consumer lead generation. I've been doing that for well over 20 years. Been honing my skills related to those type of deliverables for clients who've been selling products and services, having clients as large as Yellow Book USA and covering all of their books throughout the country, and as small as local lawyers, et cetera. About 3 years ago or so, I started to look at the opportunity to take those skill sets and move them towards investor acquisition, starting in the biotech industry very successfully. And really would like to see coming through these type of sessions, like with the KoreSummit that we're all engaged with right now, is to be able to educate as many people as possible of what it takes to be successful in order to do these types of things. So really, at the end of the day, it's all behavior driven, it's all data driven. There is a tiny bit of art on the marketing side, but at the end of the day, as a business person and you're looking to potentially to raise funds, you want to know what's going to give you the best chance of being successful, what are the best metrics that you can apply to this, and at the end of the day, what is your cost per acquisition in order for you to get an investor and ultimately achieve your investment goals as a Reg CF or as a Reg A. Coming from a point where we have literally driven millions and millions and millions of people into selling of products and services, we were thrilled to find out that many of those same strategies that have been honed over so many years work just perfectly well with this area of Reg CF and Reg A. And at the beginning of the session, David had this just amazing presentation to everyone in the group about what this means for the US economy, what this means for US businesses and the growth of US businesses. And if you're a business owner and you're considering moving forward with these type of things, my thing to you is that you should be working with solid numbers, you should be working with solid data, and you should be working with people like on this panel who are going to be able to give you the best possible outcome.
Great. Well, listen, what I love about this panel already, and Nick, you've gone to the core of it, reaching back into David Weil. Look, this is about job creation, fostering innovation, growth, our democratization of access to capital, and new avenues for wealth creation for our investors on the other side. So when we begin to talk about analytics and algos running in the background and customer acquisition cost or investor acquisition costs being quantified, we've all gotten so much smarter in the last few years in the space. So really looking forward to jump into all of that. And I'm just going to put this slight piece out because I always forget at the end. As FinTech TV, we have two shows, The Impact and the Digital Asset Report, and really looking forward to look to bring forward and amplify stories of entrepreneurs, innovators, disruptors as part of, frankly, earned media. So Troy McGuire, who's our producer, my partner, Troy at FinTech TV, of course, everybody on this panel that we have worked with in the past, but anybody out there listening, great profile organizations, people, we love to hear about them and have them considered for being on the show. So with that, I'm going to jump right in, and maybe foundationally, and if each of you want to touch on this, great. But there is this confusion generally in the market, or I'd say uncertainty when people hear public relations, PR, investor relations, IR, and even now how that moves to investor acquisition. So maybe just starting off with Eric, maybe give us just a short synopsis to you for our audience, the difference between IR, PR.
Sure, absolutely. I get asked this question often, even outside of equity crowdfunding, from public companies and some of our clients. There are certainly some areas where I think public relations and IR overlap. You could certainly make the case that press releases can certainly be IR tools. You can make the case that social media platforms posting to, whether it's LinkedIn, Twitter, or Facebook, utilizing hashtags, that could be a typical communications or PR tool or an investor relations tool. So I think that that's really up for the two sides to work out when working together with a company. I think there are certainly some very contrasting differences. IR firms don't typically work with journalists. That's what public relations firms do. Like I mentioned in my introduction, without being too repetitive or promotional, 70% of what we do is focused on generating media coverage for our clients, and not just media coverage for the sake of media coverage. For anyone that's hired a PR firm, I'm sure that they've had an experience where they're commenting on something that has nothing to do with their business. Every now and then there's a driver for that, maybe like an SEO purpose, but for the most part, objective-driven public relations and media relations, I think, is really how clients are able to effectively raise capital. I'll certainly let someone who's more qualified on the IR side speak to that. The one thing I do want to say is that they should work hand in hand. I can reflect on some experiences that my firm has had with many speakers at this conference, including Nick, but the two should work very closely. So determine your objectives. As I said, objective-driven PR. If the goal is site traffic, then maybe SEO is an important component of that, and securing media opportunities that with backlinks, which obviously improve a URL's domain authority. Or perhaps it's getting a client placed in Forbes or something like that, which everybody recognizes, and then that can be used by an IR or investor acquisition team as a tool, to go out and generate interest with potential and current security holders. So I view the two as working better hand in hand. There's certainly times where my clients will reach out about IR services, and it's not something that that we do in dealing directly with them. Many IR firms also have relationships with family offices, fund managers, things of that sort. And then meanwhile, my firm's doing battle with the journalists out there and trying to compete with national news items, which is no easy feat these days.
Right. Nick or Jason, you want to add to that at all?
Yeah, sure. I like to picture it in a content marketing funnel, and content marketing being the creation of good, engaging content that's designed for social sharing and high authority links, coverage from publishers, from influencers, working with groups like Eric to really leverage relationships and have more of a presence there. But people don't believe what they see online, especially these days, and all types of reports of fake news being shared 6 times, 7 times more than real, authentic journalism. So the same is true with any site the audience is looking at, and they get these validators to have social proof present in the form of PR really strengthens those upper funnel components, the awareness, the consideration aspects of the user journey. As it gets further down, mid funnel, lower funnel, that's where IR can really kick in. And I've seen amazing investor relations teams get in contact with prospective investors or even active, let's call it minimum or entry level participators, speak with them through the process and systematically increase their investment at an exponential rate, even to significant levels to surpass that. For digital marketing, we're able to support in that process. There's all types of documentation on funnel marketing, looking at 7 to 17 touch points as the timeline you should be envisioning for a conversion and investment to occur. But as I mentioned, a lot of the times now with our current clients, we're playing for second investments. We're playing for the real bottom of the funnel, which is peer-to-peer marketing, advocacy, getting an investor to share with their friends. It's a joy to us when we see the same last name of investors to follow in the days afterwards, particularly if we're paying to acquire investors from advertising, but knowing that there's a share rate and more will be coming to the table is powerful. So yes, PR, upper funnel, IR, tapping in from there. PR can be used for that lead nurturing in the process, but that's how we like to envision and recommend.
Well, that's great. And maybe Nick, if I can transition to you, I think that's teed up beautifully. If I think about your background and going from client acquisition to investor acquisition, how is the journey different? Indeed, if it is different, through the conversion funnel from client acquisition to investor acquisition, and share some of your experience there with us, if you wouldn't mind.
So Eric and Jason just brought up some great points, and I agree with everything that they were saying, especially this idea that you can really get into these very exciting opportunities once someone comes into your family as an investor, where you can potentially get them to make a second or third investment or get into a subscription of investments, or get them to turn the investment opportunity viral. These are all really, really exciting things, and a good sign of a healthy Reg CF or a healthy Reg A, and knowing that you have a good team that is behind you that is creating these type of events to occur in your raise. I'd like to maybe take a step back from that and get into a little bit of the details that get you to that starting point, because that is its own starting point. Listen, an IR firm is great, but they can only talk to someone when you have a name. They can only talk to someone when you have an email address. They only can talk to someone when you have a phone number. And there is a whole large process that goes into that to ultimately get to that point. And Jason brings up a good point, which is, how many times does a potential traffic eyeball need to see the opportunity before they ultimately will give you some information where you can start engaging with them? So what I like to see is, I like to see this kind of ecosystem that is creating these very targeted funnels of traffic, targeted for the type of investment opportunity that we're looking at. Working with firms that is going to be able to deliver, 250,000, 1 million emails potentially a week. Dealing with firms that understand that once you have traffic to a page, you then have the opportunity, using social media especially, which is a great value today, to cookie that traffic and actually start creating retargeting ads. So as Jason said, as you're looking for those touch points, now all of a sudden that person is on Facebook, or they're on Twitter, or they're on Instagram, and every now and then they're seeing an ad reminding them of this investment opportunity that they clicked on because they clicked on an email. And what we ultimately need to do is we need to figure out what is the cost to drive really targeted good traffic that has proof of investing. What does it cost to actually get them to that point? What is the return on that investment? And then potentially with an IR firm or another strategy to take that investment to the next level, because now you're asking that person, hey, you believe in this cause, you believe in this investment, tell your families and friends, share it on Facebook, share it on LinkedIn, share it on your own profiles. Or if the company starts achieving the type of goals that it's already pre-stated, having a company like Eric's company in place that can create a press event related to the company hitting a benchmark. And now you can go back to the investor and you can say, hey, we're hitting these benchmarks based on your dollars. Would you consider coming in for more dollars? Because we're getting towards that goal of profitability and ultimately getting a return on your investment. So it's really this, you want to have a real quarterback in there who's kind of got their hands on all these different levers, that is able to report to the client and really dig down into the details, but give them the information they need in order to make good, justifiable decisions on how to move forward.
I want to jump over to Jason here for a second, but Nick, it's really terrific when you start to talk about the level of sophistication, retargeting, pixels, cooking folks in the funnel and creating, again, that repetitive visibility to them. I think what's really important, I'd love to talk to Jason a bit about it, right? The rubber's got to meet the road, right? And so this is all wonderful, but if I'm hearing all of this for the first time, what do I need to know? What do I have to think about a budget? What do I have to think about of, demystifying this whole process? There is this flight to quality, right? And the responsibility to good deal flow, right? Which is going to garner higher conversion rate and more capital running into those investments. What should I think about if I'm a prospective issuer on teeing this up? How long, how much capital, what kind of budgets? Any thoughts on that?
This is the classic CFO, let's get to the point question, and very relevant at that. The calls we're on a daily basis. We're speaking with groups who have already invested heavily into legal, financial audits, all types of different fees, just to get to the point to have a marketing discussion. So what is the right entry point? And with the stage organizations we're working with, we generally find a starting budget. Then utilizing advertising, scale that as performance is there. If an issuer is able to say, hey, here's my acquisition cost, I have this much more available inventory in the advertising targeting, and we can scale it every 3 to 7 days as an example, we could get to much higher level of budget, spending, multiple 6 figures in ads per month even, where that may alarm a founding team to begin. But they're literally asking us, how much of this can I buy at the analytic reporting call discussion around it. And as Nick was mentioning, retargeting, there are some shortcuts to this as well with existing audience pools, because you already have that group to retarget. And when I was first learning about ad tech, I was taught it's all in the retargeting. The larger your retargeting pool, the stronger you can project the performance to be. So there are things like that. I know I'm skirting around a price tag here, but I'll tell you, we see most groups for a Reg CF start somewhere between 25 and 75K, then scale things as they're seeing performance from there. For a Reg A plus, generally substantially higher than that. The real thing to look at here is the timeline. If a group's looking to raise 1.07 million in 60 days, they need to plan for a far more aggressive budget. Where if they're, kind of testing, seeing how it works, maybe have 10 months of their filing left, they can have a test budget and really be more assured on the use of their funds, although there's always inherent variables. So all those things are taken into consideration. Also, to go back to the retargeting one more time, your advertising is going to perform better when there's an actual retargeting pool of critical mass, when there's been 3, 4, 5 touch points. So it may be 3 weeks, it may be 6 weeks in some cases before conversions are really happening on some of these initiatives. And I really like to set the stage in the budgeting conversation around that. Is this isn't a game of checkers. I'm gonna throw it here. Tomorrow there'll be this, outcome. 6 months, 10 months are really the flight dates that we're looking at for Reg A Plus campaign. And regardless of whether we see performance right out of the gate, it's those optimizations that occur at later stages that dictate how much spends are looking like at later points.
So no magic fairy dust that gets sprinkled and it happens overnight. A lot of hard work and some capital to bear to really make it fly. Hey, Eric, if I could jump in, I think, some of the things that you all do so well, I think is perhaps, the foundational elements of issuers that you work with that allow you to get some of that story out into earned media channels that then serves as this wonderful piece of content that I think fills that funnel really nicely as it goes down in those components that get to be used and reused across social. So maybe if you could speak to that process a bit.
Sure, absolutely. I think that a general misconception with media relations is that it's transactional. So, okay, I pay Fish Tank $10,000 a month, choosing a round number, and then they pay CNBC $1,000 for an article, Wall Street Journal $2,000 for an article, someone else a couple thousand, and then they keep the rest, and it's a broker deal. That's not the case. And also just tying into the last point, the scope of work is how, or the last topic, excuse me, that Jason addressed when it comes to budget. We determine budget based on a number of things. What are the announcements, the areas of expertise? If an individual or a company reaches out and they don't have a fully rounded business idea or product or service or messaging, then we obviously have to start at a very different place. However, if a company reaches out to us and they have a working technology or a very strong business model and they know exactly where they want to go and they want us to develop messaging and help take them there, then that's on us to do. Obviously, there's companies that reach out to us, including in the equity crowdfunding space, who are already revenue producing. They're using equity crowdfunding as a mechanism to create brand ambassadors or to help take their brand to the next level. So for them, it's okay, tell us about some of your current partnerships, your sales, your actual sales funnel when it comes to producing revenue for your company. I think, when for issuers that are looking to sort of evaluate what their budget should be, they shouldn't look at it as like, how much does it cost for me to get into Forbes or something like that? It's, what are my objectives? Who am I trying to reach? What's the story I'm trying to tell? And then that's where a firm, hopefully like Fish Tank, comes in and can say like, okay, I understand, we understand these are your strong points. This is the messaging that you've already defined. Let's fully, flesh out that messaging and then get you there to the next level. Just my last piece, and this, probably sounds a little bit preachy, but I think that for us, the best clients to work with are the ones that understand the process. They understand thought leadership. They understand making sure that there's a message. I'm not saying wait 6 months for your first piece of media coverage. That should never happen. But understanding that a good journalist, whether it's a TV producer and a blogger, an online reporter, newspaper reporter, whoever it is, they want to get an understanding of not just why a company wants media coverage, because that's not their job, but why it's very important to their audience. And then, because their job is to inform and educate their audience. And I think viewing it a little bit as a process, that's helped a lot of our clients. We try to emphasize that from day one and lay out, okay, this is what we want the next 90 to 120 days to look like. And then everyone should sign off on that, and away we go.
Great. Nick, if we could, I'd love to have you kick off a little thoughts on data, right? This importance really where clients, consumers are becoming stakeholders, consumers and organizations that they're comfortable with and believe in. So Oscar touched on a bit of this earlier, right? This value enhancement where perhaps this a client acquisition or investor acquisition has multiple layers of value, both in the overall branding, the value of the repeat ability and that deep connectivity to that individual. Could you speak to some of that, and who actually owns that data for retargeting and re-engagement and the life cycle of that individual?
Right. So I'm really happy you asked that question. It's an area that I spend a lot of time focusing on with my clients to make sure that they understand what this actually is and what the value is. So I'm going to first start out by stating that it's all about the privacy policy and the terms of service. Companies have a legal requirement as it relates to publishing a legal privacy policy in terms of service that says how a company is utilizing data. And you need to make sure that that is done well, and your SEC attorney can potentially give you a review of that really quickly just to make sure you're okay. But just really simple so everyone understands, if you're only just using Google Analytics as a way of understanding data coming to your website or to the deal page, you are required by law to have that information published in your privacy policy. And if you are not putting that into your privacy policy, it could be very problematic for you if you get a lawsuit against your company. So you got to start out with the terms of service and privacy policy. Our company helps clients in moving down the right direction with that. We're not attorneys, but we work with these policies all the time, and we know where we can get them at a really cost-effective way. They include all the things that you need to include. Then you as the client should make sure that you actually own as much of the data as possible, that it is not being data that I am acquiring on your behalf, and then it's my data. It's not your data, even though you paid for it. So you want to work with good, solid, reputable companies like Jason, like Eric, like myself, like Vincent, who understand that and understand that we're working for you as the client. And we are going to make sure that that data is brought into your world, that you own it. And then once you own that data, you can do lots of different things. You're spending a lot of money acquiring it. Let's just take pay-per-click advertising, and it's a whole separate conversation if it's a value or not, but it gives a good example of the math. Let's say Google is charging us $10 every time someone clicks on an ad for your investment. And it takes us 10 clicks before we start achieving any data that we can actually respond to. That means that you've paid $100 for that set of information, the name, the email address, the phone number, that you can continue to push them through your lead generation funnel. Now, let's say you need 1,000, 2,000, 3,000 of those potential investors to get you across the goal line. You can now imagine the large capital you've expended as a company in order to move this funnel down. And I'm using very rough numbers, and listen, it could be $1 a click, it could not be $10 a click, it just depends on the area. But I want to get the point across, is that you as the issuer, as the client here, need to understand the value of what you have. If you are using maybe a platform, maybe you're doing a Reg CF and not a Reg A, you should make sure that that platform, when they're getting data about your issue, that you are getting that data back to you, because in many cases, you're responsible for bringing that data over to the platform. And there are great platforms out there, and they're very ethical platforms out there. But you should have a checklist as a issuer, as my potential client, or Eric's potential client, or Jason's potential client. You should have a checklist that says, hey, I need to make sure that this is happening, that my privacy policy is covered, my terms of service is covered, that I own the data, that I can utilize the data in all these different ways. Another law update that just happened related to data that people should be aware of. We talk about democratizing investment opportunities, about how Reg CF and Reg A removes the requirement for accredited investors for these startup opportunities. It's an amazing, amazing evolution in the capitalist world and the capital raising world. But there is now a legal requirement that, hey, if we are democratizing these opportunities, your website, your offering online needs to be accessible by those who are potentially disabled. And there's programs out there. We support, Marketing Results Inc. supports these types of efforts in order to make sure that this is being delivered. Why is it in your interest besides the legal requirement? Because potentially it's the right thing to do. Significant majority of the people that I find are interested in Reg CF and Reg A are senior citizens. It's the same people who are in AARP. And if you're following the rules according to accessibility, if you're having issues with audio, if you're disabled in some way, if you're having issues with vision, as I'm putting on my reading glasses so I can read now that I'm getting up into that AARP age, these are the types of things that you want to be built into your system. It's the right thing to do. You have a legal requirement to do it. And also, these are the types of things that are going to get you the most investors and fulfill what we're trying to do in Reg A and Reg CF.
Hey, Nick, that's awesome. Wonderful pieces of wisdom and nuggets within that. Hey, Jason, if I could jump over to you, we've got a few minutes left and we'll do a little bit of a round robin again. With the wealth of experience that you have here, give us some of your best takeaways, your best actionable results, things that people could benefit from hearing about.
Yeah, definitely starting with strategy. Any recommendation would be there. We have a model we use called the 8-point plan, but it's all about getting that pulse of what's occurring in the industry today. We've seen month over month growth since March, looking at the equity crowdfunding numbers here in 2020. That's great. It gives all types of examples of what to do. Success leaves clues. You could see what any of the portals are running for marketing to promote their own offerings. You could look what some of the agencies are running from the pages that they provide to clients to run ads from. The publishers, the influencers, you can literally do a competitor marketing audit to determine exactly how investors are being acquired. And I didn't get to dive further enough into PR in my pricing example. Good PR can dramatically lower costs of your overall marketing spend. We've worked with groups that saw 10, 20x return on ad spend, spent very little on the ads because of how it was being amplified with the PR, because of how all of that organic traffic was being retargeted with ads. So start those press relation conversations early. Don't wait until it's time. They take a while to develop, and leverage experts like Eric and other groups in the industry who can, get you on the phone, have you go through the right consideration. Being able to tap into those existing warm audiences has been a very present thing in the vertical over the past few months. And with some of these larger email list providers and platforms that people turn to see the best investment opportunities around the corner. And most of all, approaching this test optimized scale, look to get things to a good point. Put a weekly report together where you're watching the analytics go up and down, and come to the table with new ideas for audiences, messaging, or funnels. And the funnels gets into the IR aspect of it, and re-engaging, bringing people back, using the data that Nick is talking about to really be able to get hold of those individuals and get them over the finish line. I define good marketing as good problem solving, where it's beyond just setting up a campaign. It's what do you do when it's not working? And that's been some of the talent that I've witnessed in the marketing side of the vertical over the past 4 years. That's what I would recommend to anyone who's preparing to do a marketing launch today.
Great, very helpful. Eric, give us a piece of wisdom that you think is a great takeaway for the audience.
Sure. Jason took mine when he said strategy and process, which I wholeheartedly agree with. I'll make mine a little bit more specific to media relations and content marketing. Focus on quality content. People can get individuals and organizations can get so caught up in putting out a press release every other day, buying, purchasing pay-for-play articles with low quality websites. You're only hurting yourself. You're only hurting your own URL in the long run. It might be helpful from a quick social media perspective for a day or two, but the long-term prize and successful capital raising in our experience has been people who put a lot of thought into their messaging, put a lot of time into speaking with journalists, not just for the purpose of getting media coverage, but for the purpose of informing their audience. If you inform a journalist's audience, you're going to get media coverage. If you write, or you have a firm write thoughtful blog content, you're going to get eyeballs on your website. If you post compelling information and you're not overly promotional on social media, more people are going to engage with you, and they're going to consider you an industry or thought leader, exciting company, market potential, all of those great things. Focus on quality. Most of the folks, if not the vast majority of the folks that we speak with, they've got really cool companies and really great ideas, and they're innovating. And I know Vince used that word at the top of the call. If you're able to impart wisdom on your various audiences with what you're trying to do and why it's important and who it impacts, I think you're going to be successful.
Great. Well, with that, gentlemen, amazing panel. Thank you for all the insights and wisdom. Oscar, I have to applaud you. I love the very polite. We don't get music letting us know that we're coming to an end. We get a few new faces popping up as our polite signal. And maybe accidentally, I think we are right on point here at 45 minutes in. So
don't want to took my joke away. I was really going to go in for the, the fishman, the calamari, and I had a joke and you killed it for me. And now I can't even think of it.
We didn't even boil the ocean.
Oh. Great work, guys. That was really, really well done. More importantly, I mean, for the audience to get a great understanding of the role of IR, PR, and of course, Jason Fishman with, marketing media. Where we're going to now is really going to put everything you've just heard in the last 2 hours, which is critically important for the success of your company. And in this case, I'm just trying to get our colleagues here on for you. And sorry, Nick, I kept you here long enough. You look pretty. I know. There you go. Wave. I love your painting, man. It's really good.
Thank you.
So we have a great panel here that first time ever. I mean, this is a first. So for the people that are online right now, this is a first. It's never been discussed before in this kind of forum. And it is going to have, some interruptions. I may come in just to put let's put a cork in it, not just joking. There are some people here you're going to meet today. So I'm going to give you kind of the overarching rule book on this. He is a great person, Chris Lustrino. If you are a CEO or any officer director of a company that's going to do a Reg A plus or Reg D offering or Reg CF, do not contact him. And you'll learn why very soon. Do not contact him, please. Believe me, you want to. You're itching away, just like, oh, I need to go and tell him my story. He'll find you. Don't worry. Let him do what he does best, and he'll explain to you. So you're going to hear a lot about that today. So this new panel is one that the committee really went all out to make sure that we could do this for the very first time. And we have 3 great speakers here who have a lot of input, and we're just starting the discussion. So you're going to hear from Chris, who's already started. You're going to hear from Sherry from Rialto Markets as to why it's important. And you're going to also hear from my good friend, and I think he's in Texas right now. But no, you're in South Dakota, right? South Dakota. No, he's in Texas. He's back in Texas. Okay, good. James Rowe from both Entoro, who is a FINRA broker dealer, but also Clear Rating. And I hope I got that correctly, which is a rating service. But he can describe that more perfectly, the name and all that. I don't want to take away from what the objective here. So we're going to talk about ratings and research. And again, I know the temptation is there to reach out to this other gentleman. By doing that, you become, what is that? Crypto, you become off limits to them, and you'll soon find out why. And I'm gonna hand it off to Sherry. I hope you're ready. It's great to see you again, all of you. Thank you so much, and let's have some fun this afternoon. Okay?
Great. Thank you so much, Oscar. So my name's Sherry Noonan. I'm the CEO and co-founder of Rialto Markets, which is a FINRA registered broker-dealer and alternative trading system. I'm so excited to moderate this panel today. It's on ratings and research. And as Oscar mentioned, I'm joined by Jim and Chris, and we have a lot to cover today. So why don't I kick it over to Jim to do a brief introduction of himself and eToro.
Thanks, Sherry. Appreciate it. Actually, I'm in this section. I'm representing Clear Rating. Clear Rating is one of our affiliated entities under our holding company. It's not directly under the broker dealer or the investment bank or the RIA. So it's a separate entity. So we do deal with Chinese wall issues from our side of the equation. But Clear Rating is an entity we started about 10 years ago with the concept to be able to value and rate private companies using a 3D dimensional model. And it is now expanded a little bit to bespoke valuations on companies, portfolio analysis, VC, PE shops, that type of thing, as well as ESG ratings. And we have a proprietary model on digital assets. So just a high level overview of that, but it is affiliated with our, through the whole financial organization as well. So I'll turn it over to Chris.
Sure. Thank you so much, guys, for having me here today. As mentioned, my name is Chris Lustrino, and I am the founder and CEO of Kingscrowd. In one line, we're really working to build kind of that first Bloomberg/Morningstar rating and analytics service for the online private markets. We're an independent, financial publisher that goes out and automatically rates all Reg CF, all Reg A plus deals. And we work solely on behalf of investors with the hope of providing them with context for this market, taking all of that disaggregation of the marketplaces that exist today, bringing it into one universe, and making it simple for investors to be able to conduct diligence, conduct analysis on the market, and find the investment opportunities they're interested in. And we believe really strongly that if we make the public markets look and feel, if we make the new online private markets look and feel like the public markets that we have today with the level of research and ratings that are out there for public companies, that will make this a much more accessible market and help educate and inform investors on what they need to know before they click invest.
Thank you so much, Chris. So I could not echo that greater, as Rialto Markets is an alternative trading system or a secondary trading platform for Regulation A companies. I was so excited to meet the two of you and really talk about ratings and research, because we really do feel it's a critical component to the price discovery, to really understanding the markets, to getting data about the different companies that are listed on the platform. So, perhaps Jim, back over to you. If you can walk through a broad overview of ratings and research and why it's important for issuers and for investors.
Well, for me, it should be for every issuer as well. Having a third-party review, be it a valuation or a rating, builds credibility, provides transparency into your operations. So much of the issuer's materials are self-serving, right? They're marketing materials. This is a third-party view of your operations, your value proposition, and it can give an investor an incredible amount of comfort and knowledge, and hopefully motivate them to invest in your operation. So to me, the first and foremost is credibility. There's other factors as well. You have just the whole concept of independence, which I think is critical. And then if you're an issuer, depending on which exemption you're using, if you're arguing a valuation, it's always better to have the facts in front of you. And I always like to say it's better to argue from the top of the mountain versus being at the bottom and having to argue up. And I will always maintain it's easier to discuss assumptions than it is to try to build a value. Probably one of the first three questions in any capital raise is, what is your valuation? It'll come out, if it's not the first question, it'll come out number 2 or 3. So it's important to have transparency, and it just builds credibility.
Excellent. And can you talk about some of the valuation drivers for a Regulation A transaction and how those differ from Reg D?
Well, for us in our models, the number one thing is always management teams. You can take it's that old adage, you can take a bad product and a good management team and make it work, but you can't take a bad management team and a good project to make it work. So that's heavily weighted in our metrics and the way we do things. So we're talking that could be a weighting of 40 to 60% on a particular project, depending on what it is. We also, I mean, it's pretty obvious revenue where you are. Do you have an MVP? Or if you've, I mean, are you positive EBITDA? I mean, there's a lot of the actual financial metrics that go into it. Obviously, sector or particular product, those are critical. I mean, if you're in a hot market, maybe it's SaaS software, something like that, or renewable projects, whatever it could be. The hot item that could end up being, and one that gets overlooked a lot is competitor analysis.
Mm-hmm. Excellent. You mentioned the management team and the importance of the management team. How do you quantify the track record of the management team?
That is more of an art than a science. And we actually have a 25 questionnaire for when we look at reviewing a management team. I don't really want to go through all of the metrics on it, but really it's has the management team work together? I mean, these are pretty common sense and obvious types of questions or answers. Have they worked together? Have they had an exit? Have they had a product launch? Have they had a buy and sell? Have they had an M&A transaction? Have they done something together to create value? Those are, I mean, it is an art, not a science, and we try to quantify it as much as possible. But particularly for younger management teams, it can be a little bit of a struggle.
Absolutely. And what variables do issuers always think are very, very important, but they're really not important in the valuation?
Well, every issuer thinks their baby is pretty, right? So once you can kind of get over that and really get down to brass tacks, I would probably say that what they normally do is overestimate the sales assumptions. So it usually would be something that they have false expectations of really how tough it is to build their sales pipeline. That would probably be an overarching statement.
Great. And I see a couple of questions over here. So what is the average cost for evaluation?
Well, for the whole market or for what we do? I mean, whole market as a whole, it depends on if you're doing evaluation, depends on if you're doing a rating. It also depends on what you're asking for in a particular valuation or rating. We actually have we do things in threes. We have 3 different products. It's basically a snapshot, then a report, and then a study. It all depends on what it is for that. I mean, if you're looking at how other companies do, Gris can pipe in here and talk about what he's doing. But ratings evaluations can be, well, it depends on, they may be free or they may generally somewhere between 10 and 20,000, 25,000 is kind of the average of most. And I'm grouping that into market knowledge, not only of ourselves, but some of the other competitors. I mean, I wouldn't compare what we're talking about to S&P, Moody, or Houlihan, Lokey, any of those types of groups, because they're not going to reach down to these types of valuations. They're going to fly at the publics. They're also going to fly at big structured finance type of products.
Great. Chris, do you want to comment?
Yeah, sure. So in terms of ratings, to be honest with you, the way that we work, like I said earlier on, it's all about working on behalf of investors, right? So in order to provide that best experience, we rate everything. As soon as a Form C, a Form A1 is filed, that's automatically collected into our system, and it goes through a standardized methodology rating. And the key things that we're typically looking at are market opportunity, team experience, valuation, differentiators of the business, performance of that business. And as many of you may know or may not know, in your Form C, you're going to have your past 2 years financials, most recent, right? So if you're raising in 2020, typically it's 2019 and 2018. You're going to have your operating agreements. We're going to have bad actor checks on the key management teams. We're going to know who owns more than 25% of the company. So we have access to all of this data in these new online private markets. And what that does is it creates a way for us to be able to pull in standardized information and go and do our own market research and essentially create a standardized rating for every company that's raising on these various portals. So us, again, we don't work on behalf of the company. So in our instance, it's free. It's going to occur as soon as that Form C is filed.
Great. And one last question, first maybe Chris and then Jim. So what measures are in place to really protect against conflicts of interest? Having been in the public equity markets, I know that was a massive situation there. So what's in place in this market to protect against that? Chris, maybe?
So,
okay,
yeah,
go,
if you
go
don't
ahead,
mind,
Chris.
I would love to jump in here. One of the things I'm probably most proud of is that we're founded on this idea that we want zero conflicts. Like so many investors said, you can monetize this thing so many different ways. You can charge the issuer, you can charge the platform, maybe you have fees for when you drive investment. We want no part of any of that. Our whole thing is to be a standalone business that looks at every company in the exact same way. We don't care where you're from, what you do. And we've tried to actually take that next step, which is to make it all data-driven. So not to say, well, this market's exciting or this founder is exciting because they remind me of Mark Zuckerberg. It's to say, no, what experience does that founder have? Do they have relevant industry experience? Do they have founding experience? Do they have any exits to their name? Have they worked together with these people? How old are they? Those are actually quantified metrics, again, that are standardized for everybody. So we can look at every company in the exact same lens and put up every wall that we need so that it's totally independent, it's totally unbiased, and it's even taking out our own biases and just how we feel about companies when you meet with them and have those meetings and things of that nature.
Great, Jim?
Nothing to add.
Excellent, excellent. So perhaps, Jim, you can talk through a little bit about how often are these reports issued? And
well, it all depends, I think. I mean, a Reg A is going to be different than a D or what have you. You know, we do valuations for, you know, closed in, you know, funds, et cetera. Those are quarterly, right? So Chris's, his business is much more at the initiation. I mean, it depends as well. I mean, it depends on what model. Chris's business model is different than ours. So he will probably doing, you know, conducting more updates than I would. So it all depends on the product. I mean, a Reg D, you may not need to do it once a year. I mean, if you're talking about Reg A, you know, you're probably talking a quarterly type of, I mean, not a lot's going to move in a quarterly time period. And frankly, most of these entities are too small to justify the time or expense for it, frankly.
Great, thank you. Chris, maybe you could walk through a specific company. It would be really helpful to walk through a specific example of a company and the process for, you know, for actually generating a rating and writing research.
Yeah, absolutely. So I know one company we threw out there yesterday, a fintech company that's on Seed Invest, doing a Regulation A+ offering. And the reason I'm mentioning is right now we rate every CF. We look at Reg A+ deals, we track them, but they're not necessarily rated. So it's a good way to talk about something that's like not in their product set, just talking about a company that we've looked at, we've seen, and then thinking about the dimensions we care about, how to discuss it, right? So again, getting back to the things that matter, it's looking at market opportunity. It's looking at founding team experience. It's looking at business model. It's looking at the valuation and the price of that firm. It's looking at the differentiators of that business and their performance. And so when I look at a business like Ground Floor that we've looked at before, you know, you go on Seed Invest and you can find that company, you know, they are a company that's been raising capital progressively over time over the past few years. They've gone from kind of a Series A stage company through to a Series B, and they've made a lot of progress. And if you look at the management team, the people that they have on their team, you know, all have founded companies before, have had exits before. Brian Daly's done a ton of work in building companies and selling them off before. And so he's someone that's actually experienced, right? He's been there, he's done that, he's accomplished things. They have an incredible legal team that they've put in place. So they have all the parameters and things that you need, and they've built out this team of real estate experts because they are essentially a real estate investment platform that lets anyone invest as little as $10 into real estate deals. And so what I love about that is the fact that they've made a lot of progress, but they have the right team in place that's showing they can execute, because they've gone from, you know, maybe very small revenues into the millions and millions of dollars last year. So when we look at traction, they've built their user base, they've grown their revenues. So the business is doing really well. So when you look at the valuation that they have, it's based on their progress. And I think one of the things that's really helpful, if you're a founder, in terms of coming up with your valuation, a lot of it is, what is the market willing to bear, right? So if you're a fintech company, high growth fintech company, and you have X, Y, and Z parameters, go and try and find similar companies to you. look on Crunchbase, talk to your friends. You could find information and hear things and figure out what does your valuation need to look like, right? And get in a ballpark that you think is fair and reasonable to what the market is bearing today. And don't be way beyond that. We all want to think we're way beyond, but frankly, that could end up setting you up for failure down the road. So if you look at Ground Floor, I think, you know, it's a little bit of a high valuation, but it's fair for the progress they've made. And when you look at other comparative fintechs, I think actually they're in a relatively decent place. It's probably the biggest knock on them is their valuation felt a little high, but overall.
Really quickly, because you talked a lot about the management team and the weight of the management team in that evaluation. Jim, going back to the importance of the management team that you stated yesterday when we were having our prep call for this, what are the third-party background checks or other services that, when you're evaluating a management team? Are you simply looking at their background? Are you digging deeper than that? Can you talk a little bit, Jim, about that?
Well, yes, for us, if it's something that's been conducted under a broker dealer, I mean, you're going to not necessarily rating, you're going to do OFAC, FinCEN. We do independent broker checks on the broker dealer side of the equation. You would usually replicate that same thing on a valuation. If you know, if you're doing a total standalone transaction, you'd absolutely want to know what the backgrounds of these individuals are. And surprisingly, Googling somebody you can find out a heck of a lot. I found out one time the hard way. Just sometimes look, and you'd be amazed to see that somebody has been thrown in jail for a couple times for SEC violations. So it does happen. So you do have to do just the basics at a bare minimum. And you know, background checks can be quite expensive. So you just don't run those willy-nilly. I like to run. There's some relatively inexpensive resources in that category to do that. That can be a couple $100. But you know, because you know the rating side of the equation and valuation services, you're not regulated, so you're not held to a fiduciary level. You're not held to certain. I mean, you're really protected by the First Amendment in the United States. It's an opinion, and so we really don't have that exposure. Clearly, you don't want to have egg on your face from doing a valuation of a bad actor. So, but doing a valuation and a rating, you're not getting a bad actor form. You're not collecting that kind of due diligence on somebody. You're really looking at a particular project. So a lot of it has to do with what Chris and I both kind of indicated is, what has been their tangible track record, exits and all the things we've already discussed.
And fortunately, Sherry, a lot of the CF and A plus, in order to occur, before you can even file that Form C or that Form A1, the management team has to have bad actor checks. One of my favorite, I'm not trying to promote anyone here, but CrowdCheck has been great. We've used them before. They're pretty cost affordable and they get the job done. So that's one that I see on a lot of Form Cs is the only reason I'm mentioning.
Great. And so now let's talk a little bit about the investor end. So what do investors look for in a report? Chris, maybe you want to, oh, actually, yeah, Jim, why don't we start with you and then kick it over to Chris?
Well, sure. To me, it's got to be something that's, the obvious, easy to read, gets to the point, articulates the value proposition. I'm always a big fan of comp analysis. I'm a big fan of summary tables to get to the activity. I'm not a fan of the traditional Wall Street reports where you have something 40 pages and they've just repeated something 3 different times. That doesn't do anybody any good. So charts, graphs, tables, the more the better, as long as it's clean and easy to read. I think it's good. That's on a valuation side. Depending on what your ratings met, if you're doing something similar to an S&P or Moody's bond type of rating, that's one thing. But you need to make sure that your metrics and your methodologies are clear, so a first-time reader can understand quickly.
Great, Chris.
Yeah, I would say they're looking, 2 big things we hear is they're looking for validation or to see discrepancies. And so one of the things that I would kind of urge to issuers when you're thinking about listing your company, everyone wants to tell the best story in the world, and I totally get that. But I think it's really important that you be honest with yourself. It's okay to say that you're an inexperienced management team. I myself am an inexperienced management team. So I said, here are the people we want to hire. Be honest with your weaknesses, be honest with your strengths, Don't just say your market is, trillions and trillions of dollars. Talk about what's actually applicable to you. It's okay to not have a multi-trillion-dollar market sometimes. Everyone says it, but it's okay not to. What they don't want to see is they read everything is incredible on your offering page, and then they come to a rating report and they realize everything is completely sideways and different. If they come to the rating report, it's like, yep, that's basically what I read on the offering page. It's because they were honest with themselves and realistic with what is actually real. And that gives them comfort that, hey, I felt good about the company. It basically looks like someone else does too. But if that discrepancy is huge, they're going to go, wait a minute, something's wrong here. So I would say that that's the big thing as an issuer to think about, is just being honest with yourself.
Great, great. And Oscar said we should have fun. So I'm going to I put in another question here.
Fun? Who said you could have fun? Not with this topic. It's so controversial. I mean,
I was going to say there's a controversial question over here from Dave asking basically, once a rating or valuation has been made, even if the company didn't request it, aren't they obligated to report that? And can that make a raise even more difficult? So, Chris, do you want to kick it off and then hand it over to Jim?
I'll provide some thoughts. Ultimately, there's a couple of things here. One, it's a public raise. And so, to a degree, the public has a responsibility to know what's going on with the company. More importantly, I think it's all about how is the rating company approaching that effort, right? So from our perspective, what we try and do is be extremely respectful and thoughtful about how we rate these companies. We do not blast this to the universe. We keep it behind expensive paywalls that people have to pay for to access, so it's certain individuals that are utilizing it. And we present this as a market scan tool, and every company is looked at in the same way. And literally you go to each company, you can see how on each bar, how do they score on valuation? How do they score on market? So, if you get a three is actually quite good, because some of your elements are excellent and others are weaknesses. And really what people are utilizing this for is more to give them context and thinking about their investment opportunity. It's not necessarily going to be the total turnoff. They just want to understand what's going on with it before they make a decision. The reality is people are used to this in the public markets. So if you simply don't have it in the private markets, it's going to hinder the market in a bigger way than probably not, having the best rating in the world. So ultimately we have our position in the world, we stay independent, we stay respectful, we don't try and hurt anyone, we're super clear about our methodology, we're standardized for everybody. And, ultimately my rating early on was not that great. If I put all of our stuff in, it wasn't that great. But I went and sold my company anyway, because I'm me and I have to go and do that. And you as the founder have the most power to drive and influence and create investment volume. That's not really our role. We're simply providing another context and way to think about them.
Excellent. Jim?
Nothing to add. Chris did a great job there.
There we go.
I have something to add to that. So because I'm the compliance guy today. I'll be Mr. Compliance.
Are you going to take my spot, Oscar? Is that what you're trying to do?
I just kind of figured that you've been put on the spot
Okay, if you're going to talk compliance, I'm ready to go.
Well, actually, the question that Sherry, it was a good question. What do you do? I mean, as a company, you're eager to take that report and you post it on, good or bad. You shouldn't. You should talk to your lawyer first. You have to understand that what Chris and what James are doing are independent research reports and are each for different type of environments. And listen, when you join the crowd, get ready. I mean, I wrote an article about 6 years ago now. It's 6 years old. And I said, get naked. Because that's what doing Reg A, Reg CF, Reg D 506Es, you got to get naked. You got to get ready to take all that, who you are and put it out there. And you got to get ready for people like Chris and others who may emerge that are going to provide reports. And they're out there. That's just the facts of life. But the key is that if it's a positive report, you're eager to promote it. And that's where you're going to get yourself into some issues. Consult with your lawyer, number one. There's not the report is there, but consult with your lawyer before you do anything with it, because again, the information that's there, it's independent. The minute you connect to it, it's no longer independent. So that's that was my only comment on that one.
Yeah, and actually I'll throw in one thing, Oscar, to the get naked and get ready. I have to tell you, if you're going to experience any challenges, boy, is it going to be from the crowd. The hardest questions I've ever gotten are from people on the Q&A sections on the offering pages, and you have to answer them. And the one thing that I would strongly suggest to you is when you get those Q&As that can be super off-putting and feel like they're just attacking you when they don't even know you, is to be respectful and very thoughtful in your response. Talk to your lawyers about your response, and make sure that they come across in the right way, because I have seen offerings get totally demolished by a terrible Q&A section that just scares everyone off. And you can do that, but if you answer respectfully and thoughtfully, you can prevent putting yourself in that situation. But it is a very vulnerable position to be in, and it's not always easy, for sure.
It isn't.
That's great. So why don't we just finish up with 2 more questions? I see that the next panel is on. So Jim, what are 5 lessons that you've learned from conducting evaluation?
Well, as I mentioned earlier, everybody thinks their baby is pretty, so you have to temper that with activity. You suffer from in the private markets the lack of really good information. You don't have that like you do in the public markets, and so comps can be wildly different, and you have to just take a step back and say to yourself, does this make sense? And you got to make sure that people understand that, you know, this is an art, not a science. We try to drive it to a science, but at the end of the day, there's a ton of subjectivity into it. You know, the weightings of things can grotesquely alter an output. So for our own analysis, we do weightings, and then we have a whole risk section where then we go and we risk the entire valuation or the rating just to bring it into what would make common sense. Another lesson is the issuers most of the time don't know their competitors as well as they should. They have a difficult time, many of them, articulating single set kind of economics, meaning margin analysis or single unit economics. They fail at that quite a bit. Those are the high points.
Great. And Chris, why don't you just end us out before we turn this over to the next panel with a few things that issuers always fail at during a rating or valuation review, just as parting words.
Wow, that's a loaded question. A few things that they always fail at. Honestly, I think, like I said earlier on, be honest with yourself. If there's 2 things that they continually inflate to the moon, that would be their market size opportunity and their revenue projections. And the reality is, as soon as you start working on whatever it is you're doing, all of those numbers are completely and utterly wrong. So just, think critically and thoughtfully about what it is that you put out there, because ultimately, you have to answer for that. And over time, as you continue to progress, it's still going to live there and people can see it. So, just think about that.
Great. Thank you so much, Oscar. I will turn it over to you, but thank you so much to Chris and Jim for a very insightful panel.
Hey, thanks for having us on. This is great.
Actually, I want to say thank you to all 3 of you because it was gutsy. First of all, we haven't done it before. Nobody's done it. We're doing it online, which puts the dynamic even more different. But we're finally having this discussion. And as you may recall with David, it started the morning with, until we can get this to some secondary component, but it's price discovery, all of this. So we all need to understand that the pieces are coming together, and they're coming together with people who understand each other's work. I know Chris has been working with the lawyers to understand how to approach this in a fully compliant manner. I know James, being a FINRA broker-dealer, understands that all too well. So thank you so much for the 3 of you today. This is a great discussion, and it leads us perfectly into our next panel, the broker-dealers. So thank you.
Thanks, guys.
Thanks, Oscar.
Oscar, are we getting back to you getting naked here? I mean, we would get on and then that's supposed to get lost.
I just realized that I used that term, getting naked, and it probably, if you just came in only at that part where I said I'm getting naked, it might have been taken out of context, but it's in relationship to where we are today with the what's emerging with these new participants, such as ratings and research. Guys, we're embarking in a new arena, and you guys are going to have a phenomenal discussion here today. I'm just so looking forward to it. I can't believe I kicked James and Sherry out. I got to bring them back in. Sorry, guys, I didn't mean to bring you.
I can't believe Steve's setup there. I mean, dude, you're putting all of us to shame, man. That is some serious stuff.
So there's really I think that last discussion finally, what I'll start with today for you guys, and you guys have a whole hour, and typically people go, why on earth would you give lawyers and broker dealers so much time? Because I think something's come full circle, and that is that, when we first got started, it was all about the lawyers and broker dealers understanding. And then people go, oh, we got all that figured out. It's pretty cookie cutter. Well, we're not there anymore. We're in a very different times. We're in times when things have gone wrong, and it's starting to, the market is maturing. So what does that mean? It means that the role of the broker dealer is not just, hey, I do the compliance and I'm out of there. Today we have, look at everyone, we have 5, 6 broker dealers here for you that are going to enlighten you on the A to Z. I'm not going to steal their thunder. It's going to be led by Elliot Chunf with Real & Co. He is joined by Stephen Distante from Vanderbilt, an impact broker dealer. James Rowe, of course, from eToro Capital, and without a Tom Butler from Delmore, and our good friend Victor from Capital 2 Market, and Sherry, as good as always, from Rialto Market. So enjoy this session, have fun. As I always tell you, I won't come in unless I'll be the compliance alarm, but come on, we're in good hands here. Enjoy. If any questions come up, look at in the side channel there if you want to take it, if anybody wants to have a look at the questions there. Okay, enjoy.
Excellent. Thanks, Oscar. And thanks everyone for having us today and talking a little bit about the role of the FINRA broker dealer in Reg A Plus. We're going to start. We've got some visionaries on the panel here today, and define what a visionary is. It's somebody that can see a future that others can't, and that have positioned themselves as a critical component of making that future a reality. And I appreciate everyone that's on this panel here today, because these are risk takers that have gone out and really gotten out in front of what I think we all believe is a very necessary function, and what we also believe is going to be a very new and critical way of how capital is going to flow from investors into issuers. So with that, we're going to go around the horn with some introductions, and then we'll get right into the panel topics. Victor, we'll start with you.
I've been involved in online capital formation since about 2009. Worked with a firm called Weild IV, for you of those that have been around for a long time, and we had a heavy impact in comment letters with Titles 2 of the Jobs Act. And I started Capital to Market in 2016 after writing the crowdfunding exemption for the state of Virginia with the Small Business Financing Authority and the State Corporation Commission. So I've had a heavy hand in some of the rules and regulations. And I've always found that Reg A Plus was the true democratization of capital on the side, where it holds a lot more of the compliance factor and the regulatory factor, because despite public opinion, brokers are here to protect investors as opposed to raise capital for issuers. And we always take the line on the side of caution when dealing with private issuers, and FINRA obviously has a strong opinion about allowing non-accredited investors to invest in private placements. So having a broker dealer was an essential step to bringing all of that together. And we've had a few Reg A Pluses that have been extremely successful. So being on a panel with all of you is more than honorable and exciting to be a part of this.
Excellent. I love the term true democratization, as well as here to protect investors. I think you'll hear some of that theme play out as we continue this discussion. Eitan.
Yeah, thanks, Elliot. And thank you, Oscar. Once again, Eitan Butler here. I am the chairman of Dalmore Group. We are a FINRA and SEC registered broker dealer headquartered in New York with offices nationally and active in all 50 states. We were founded in 2005. And for the first 10 years or so, we were exclusively focused on providing investment banking and corporate advisory services to private and public companies. And we still have a active institutional investment banking division that's broken up into different areas of focus today. Since 2015 or so, we've been immersed in some of the Jobs Act born exemptions, including 506C, Reg D 506C, and more recently Reg A, and most recently CF. On the 506C side, we serve as the underwriter or the broker dealer of record for a number of high profile serial online syndicators of equity, many of whom are in the real estate space, but also into other verticals as well. On the Reg A side, we've been active over the last few years, very active over the last 12 months. We've been signed as broker dealer of record over the last 12 months in over 70 Reg A offerings. We're on track for that number being over 100 by the end of the year. So that's been a very active area of focus for our firm. And most recently, actually last week, we launched a CF solution called Direct CF, directcf.com, which is really aimed to bring a direct and cost-effective Reg CF solution to issuers who are looking to take full control of their capital raise.
Love it, Eitan, and appreciate how long you've been in the game, having started this in the early 2000s, and even in fast forwarding 15 years are still innovating in the space and you know, looking at 100 type deals. That's awesome to hear. Steve, on to you.
Yes, thank you for having me, Elliot. So I own 2 broker dealers, 2 RIAs, Vanderbilt Financial Group and Impact U Investments. I'm the founder and chairman of the company, and you know, I've evolved over the years to really realize that I am an entrepreneur all in my entire life. My first business being at 60 years old, and being able to bring capital to entrepreneurs to be able to scale and grow is really where I have my heart in this business, in the impact space, entrepreneurs, and being able to meet those entrepreneurs and understand really what's going on inside their business. What's the culture of their business? What are they going to do when the shit hits the fan? Are they going to be there with us throughout this investment? Because I've had, you know, traditional style private placements, and those are, you're so disconnected from. These Reg A pluses are amazing. You get audited financials, and I get to intimately know these people in a much different way. So you see to my right is Igniting Impact. That's a documentary film I did. And in the film, I actually do content about companies that we're looking to help scale and grow. So we're looking at this industry from a whole different perspective, which is being able to align our clients' values and mission-oriented aspirations with the investments that we make. And the Reg A Plus really works very well, especially from the non-accredited aspect of things. So I'm just excited to be on the panel and share, you know, my perspective on things.
And Steve, just hearing about that passion is inspiring, and also your perspective as an entrepreneur, right? And an entrepreneur in a later stage is when you first started it. So it's great to hear that you put yourself in the shoes of the people that you're helping, right? And they're not just clients, right? To you and to many of us on this call, on this panel here, we bring that same level of passion to the groups that we work with on a day-to-day basis.
Yeah, without
James?
a doubt. So this left side of me is the SDGs. So I for 3 years, I was the UN ambassador for entrepreneurship. So I got to do through a group called EO, but we brought entrepreneurship to the UN, and then teaching entrepreneurs, celebrating them, and being able to bring capital was just like the whole next step. So that alignment with mission-oriented companies is where I live.
Beautiful. James.
Yes, thanks, Ellie. You can call me Jim. Oscar keeps calling me James all the time, but you know, he keeps, you know, and he still pronounces my last name wrong. So I'll take one or the other from him, and we'll call it a victory. But I'm still trying to get, you know, the thought of him being naked out of my head right now. He keeps
think
talking
about the
about
beautiful baby instead.
Yeah, we got to do that. We got to do that. No, I'm the founder, managing partner of Ventoro, investment bank, broker dealer, like Eton, all 50 states plus the district as well. We have a securities platform that we acquired 3 years ago called Offerboard, out of New York, moved it to Houston, rebuilt the tech stack. We are an RIA as well, and soon to be having one of our first registered funds get out in the market here, hopefully 2 or 3 weeks. As you know that we participated in the last panel, we also have a valuation company called Clear Rating. So we have a little bit different model than many individuals that focus strictly on the BD side of the equation. And look forward to the panel.
Excellent. And Sherry.
Great. Thank you so much, Elliot. So I'm Sherry Noonan. I'm the CEO and co-founder of Rialto Markets. Rialto is a FINRA registered broker-dealer and also an alternative trading system. So our team is really focused on and has built many of the ATSs out there. This is collectively our 7th. That's really our sphere of expertise, if you will. And so we've been working for the last 2.5 years to really expand our mandate and be able to bring secondary trading to the private markets. And we're so excited to begin with Regulation A. So that's Rialto.
Excellent. And finally, I'm Elliot Chun. I lead Emergence, which is the emerging technology and digital asset investment banking team under Weild & Co., which was founded by David Weild, who was fortunate enough to keynote the event today. So we're going to kick right off into this just to give a sense for the people in the audience how we're going to take the panel. We're going to start with a couple of Reg A plus observations based on SEC filings. The goal is for everyone to understand where Reg A plus is today from a numbers perspective. So there's a lot of people out here that will talk to you about from a qualitative perspective. We want to bring some numbers to this. Then we're going to talk a little bit about what a life cycle of a Reg A plus deal looks like, process, timing, and participants. Then we're going to go into a little bit, what are the options that if you're an issuer that you're facing when you think about raising through Reg A plus. While we have some of those discussions, we're going to have people on our panel play the roles for you that are listening today. So when you hear Victor's line of questioning is going to come from an issuer perspective. And when you hear Steve is going to be talking from the investor perspective. And then finally, we're going to touch a little bit about secondary markets. I know that later today, Commissioner Peirce is going to be on speaking. And so we wanted to provide our views going into that session. So with that, I'll hand it over to Sherry to talk about some initial observations.
Okay, thank you so much, Elliot. So first, to provide some context, why don't I start at the private market level and then we'll drill into Reg A. But just to provide some context as to the macro shift in private markets over the last 20 years, right now there are triple the number of private companies vis-a-vis public companies, so about 14,000 private companies and around 4,400 public companies in the US. Over the last 20 years, companies are staying private longer, so on average about 8 years longer than in the past. And finally, private equity has increased 7-fold over that same 20-year timeframe. So if we look now drilling into Reg A specifically, the SEC published a really helpful look-back study back in March. And looking at the data in there, what we see is that the year-over-year filings, 2017 to 18 and 18 to 19, rose 35 and 40% respectively. And so the years prior to 2017 and 18 was a much larger, but also on a lower base. And the amount raised has risen 44 and 52% on those same year-over-year timeframes. But what's really, really interesting, I find, from all the data looking in the report, is that you've got filings increasing, qualified filings increasing, but the amount of qualified filings, so the amount of filings that have gone into the SEC, and Jim, I think you're going to take through a really helpful flow chart. So first you file and then get qualified by the SEC. the interesting fact I found from the report was that the amount of filings that were actually qualified in the various years has risen from 16% in 2015 to 81% in 2020. So what that's telling me is not just, is this a growing market, but it's a growing healthy market, because the amount of total filings has increased, but also the amount within those total filings that are qualified has increased dramatically. And, you know, that's telling me either there are higher quality companies that are filing, that the SEC has, you know, gotten the process down to review the filings and actually qualify them, or perhaps the issuers have, you know, found service providers to help shepherd them through the process. But overall, it's really telling me that you're getting a much larger amount that's getting qualified and raised within the filings, which are also growing.
And I mean, that's fantastic numbers, as we're seeing consistently the number of companies, the amount raised. Eitan, you've been kind of on the forefront of a lot of this. Can you talk a little bit about the experience that you've seen in terms of the numbers that are increasing in Reg A plus?
Yeah, I mean, I think that there's an increasing number of options that issuers have now. There's more and more you know, marketplace-oriented platforms that offer Reg A. They're out promoting their platforms. They're out promoting their issuers. There are more investors that are now, as a result, being made aware that this exists, that they have the opportunity for the first time in history to look at and participate and support some of these companies. It's been as a result of the PR campaigns from a number of these issuers and platforms. I think the word is just getting out. I think, you know, many of the business lines that we've seen as an investment bank took a bit of a pause going through COVID, right? The idea of getting board approval to move forward with an institutional investment banking deal, people were in triage mode for a while. Interestingly, the Reg A side didn't really slow down, from my perspective at least, as far as volume. Being able to give the average investor out there served up on their device, on their screen, an opportunity to look at interesting opportunities, oftentimes that they're specifically targeted to, right, to be able to see and participate, even with a credit card, makes this process, you know, I wouldn't say not impacted by these types of world events, but certainly they've been able to grow and consistently rise numbers-wise throughout, you know, even the most difficult times so far. It's still relatively new. You know, it's really become more popular as it is now, you know, really since 2017-18, right? So we're seeing now, you know, the numbers consistently surge, and I expect that's going to continue.
Yeah, and great note that not slowing down due to the global pandemic, and in fact, bucking the trend and might be even seeing more support for that. And Victor, this kind of leads into true democratization. If you were to put your kind of your 5 years from now glasses on, what kind of growth numbers are we going to be talking about in 2025?
It's a good question. I think you're going to see, based off of what Sherry said, it's going to continue to grow, and even more at the pace, for a number of reasons. As Eitan was saying, there's more platforms out there that are operating in this way. I think bucking the trend where there was a stigma of putting your company online to raise capital early on has been overcome. And more importantly, the quality of those companies that you're seeing, where initially when Regulation A+ started, I think we all had to go through an enormous amount of vetting before we found the right companies that would be suitable for non-accredited and retail investors. And so also in the case where initially I think a lot of these companies looked at this, or some of the competitors of ours looked at it as a way to inexpensively IPO, and valuations, as Jim was discussing previously, were way off. And it gave Reg A Plus, and in particular, I think, a little bit of a black eye, where these companies went to market, they had no post-market institutional support, and they were overvalued, and it created an opportunity for short sellers to come in and crush those early on investors. And I think a lot of those black eyes have been overcome by what I said before, higher quality issuers, higher quality brokers being involved, and more of an open-mindedness to this way of raising capital as opposed to before, where it was more of the traditionalist wanted to have those door type deals. And now people are more open-minded, especially in the COVID area, to have to put their offerings online in some way, shape, or form.
And Steve, playing the investor role here, when you hear about investor black eyes and you hear about some of the bad behavior that happened, what's your response to hearing about, hey, there's a growth in numbers, but I'm a small investor. What does that mean for me?
I'm just kind of confused because I don't know what a broker dealer is. And I'm not sure how they fit into this whole thing, because I could just go online and invest, right? I mean, what's the difference?
And I think that leads very well into Jim talking about what the functions a broker dealer does put together. And Jim, I'm putting up your document right now.
Thank you very much. Just a little comment to Steve's point too. What you get that question all the time. Why do I need one? After some of the well, I don't know if anybody on the panel seen the SEC's release of finders today. Made life a little bit more challenging, and might be worthwhile, Elliot, having that question come up at the end of this panel on how it affects Reg A, because I do think today's announcement was kind of interesting, particularly in light of how to compare that also to Reg BI, which we're now subject to both on the RIA and the BI or in the BD level. So those may be good questions for you later in the panel. But just wanted to capture and Oscar, you can make this slide available to anybody. We just try to keep it high level on the life cycle. I don't want to go through and read all of this. The darker blues are more of the required. The lighter blues are things that would be options at a later state. But clearly in a life cycle of a Reg A, you have the function of test the waters. And this could be a 1 to 4, 1 to 8 week kind of process of distributing, the issuer distributing their materials to get feedback from potential investors that can be solicited through any number of ways could be social media, it could be email, it could be a number of distribution means, advertisements, etc., that get interest on a particular issuer's project and offering. So that period can be optional, but it usually is a nice way to have some feedback on whether or not your project has interest. It's not not a requirement, but it is an option to you. Then the more the technical side is to obviously prepare and file a 1A with the SEC. That normally takes somewhere around 30 days. You can, you want to have your audited financial statements. You want to have your document ready in a proper manner to be filed with the SEC. Really, the next stage then is to receive and interpret the SEC comments. That can take, who knows how long that can take. I've seen it take very little time, and then other times, depending on the quality of the materials and the issuer, that can actually take a lot, depending on how comprehensive it is. Sometimes it's the legal team, the audit, whatever you can do to make the SEC more comfortable, usually expedites the process. So
and James, in these first 3 buckets, talk a little bit about how the BD gets involved here.
Well, the BD is in a Reg A is primarily focusing on the function of due diligence and compliance activities. Depends on when a issuer brings in a BD, and that's always up for debate. Some have had troubles; they'd never bring one in. but it depends on if you're bringing one in early and if you're doing something as just a placement activity, or you've hired a broker dealer securities operations for more of a full investment banking engagement, which would be to kind of shepherd that process all the way through. So it depends on what you're asking the BD to do. Like I said, it's usually broken down into an engagement, a full engagement program, which is an investment banking, and that's a process where you're really working side to side with the lawyers, with the team, et cetera, to get the materials in order. Or if you're just playing the part of just due diligence and compliance, which would then get you to just being a placement agent. So there's really multiple functions there that the BD can participate in. Did I answer your question, Elliot? Go ahead.
And Jim, as my role as the issuer, are there any additional costs when you add a broker dealer, or there's any additional process that would go into that? And I'm talking about a 5110, if you could go into that, where that's that additional process when you have the broker dealer. So the cost and the process of having that, where if you don't have one, you might not have to go through that.
Yes, good point, Victor. There's, when you bring in a broker dealer for anything, and like I mentioned before, whether or not you're doing the full or what have you, you have you've got to file that comp structure with FINRA, right? So you do have to put that out there. You have the added cost of the due diligence aspects of it, and anything that the broker dealer is going to do in addition to from a preparation standpoint as well would be at an added cost.
Thanks. So I think what on the 5110, that's what they're talking. So simultaneously, when you do get qualified with the SEC, you also have to get qualified by FINRA under the broker dealer for the compensation,
Correct.
right? Okay,
Correct.
got it.
Good point. Thanks, Victor.
Thanks.
The next section would be really the file offering statement with the SEC. This is where you figure out whether or not you're meeting the requirements of a securities exchange. You have the listing application, etc. And depending on what the role of the broker dealer is, again, whether or not it's a kind of a full process or a placement process, this can alter on how much support a particular issuer receives from their BD. And then really on the last side of the equation is the qualified offering statement. The issuer and the placement agent in this particular situation, the broker dealer, is lining up the interest from potential investors in the pre-qual period, and work to get the conclude to get the full qualification. So those are the main points of the life cycle. Obviously, a lot of things can alter the timing. It can be the calendar, the time of the year. It can be SEC backup. It can be the preparation of the issuer. There's a number of factors that go into the actual speed of the process, and some things you can judge, some things you can't. And to Etan's point, there's been a lot of activity in the Reg A space from the SEC, where they've slowed down in other areas. They actually had more opportunity to process the Reg A activity a little faster. So you see, the variability can vary between 30, 60 days on this kind of timeline and life cycle.
Yeah, and when we think about these life cycle steps here, in the back of my head, if we think about what the fundamental reason why each of these steps exists, it's to protect investors at the end of the day, right? Isn't that right, Steve? When you think about these steps from an investor perspective, these all exist to protect the end investor.
That's my experience, of course, and we play a very vital role in that process with suitability, not putting too much of our assets in any one particular investment is clearly something that you don't get when a broker dealer is not involved. I mean, there may be a click the box or so, but the broker dealer actually is the ones who are able to help with that, you know, the determination of whether or not the investment is appropriate.
Great. If we move a little bit to the next phase, which is, okay, now that we know what the life cycle of the Reg A Plus deal is, what are some of the options that someone who is seeking to raise capital in Reg A Plus form must consider? Eitan?
Right, so you're a prospective Reg A issuer. You have an important decision to make and you have some options. One is you, assuming you want to conduct your Reg A offering through a regulated entity, which I think most of us, and I think many of the securities attorneys that I know would advise for a number of reasons. You have two choices. One is you could list your offering on an ever-growing list of marketplace-oriented platforms, right? And there's 6 or 7 very big ones that everyone knows the names of, and there's many more popping up. The model there is, and you'll see, you know, we have 200,000, we have 300,000 investors that are ready to pounce on your offering, sign up, pay us 7 to 15%, and have a lot of hope and faith. Now, it works for some. It definitely doesn't work for everyone. The alternative, and by the way, when an issuer eventually realizes, and I think most of them do, that, hey, this is my offering, ultimately the responsibility of promoting this offering and assuring the success really falls on my shoulders, not on listing on a third-party platform and hoping that the majority of my offering is raised automatically just because it gains traction amongst dozens or hundreds of others. The alternative is to do it yourself and to work with a BD like Dalmore that could set you up with your own landing page, that could set you up with your own Invest Now button so that you become the sole beneficiary of your own marketing and promotional efforts. This is very important and at a fraction of the cost in joining a platform, right? So the idea of being able to take control of your own offering. Yeah.
Eitan, would you just take a step back, because you made a really good point. In the beginning of as an issuer, you said a term that we would understand, but maybe issuers do not. Let's talk about the difference between broker of record or executing broker fee, and then what you just touched on, where if you list on a platform and you're looking at a full placement fee, and even though you're going to end up doing a lot of the heavy lifting. Could you kind of just get a little bit more granular on that?
Yeah, so the broker dealer of record option is to have a broker dealer that's conducting your offering for you, that's registered in all 50 states, that's doing due diligence on the issuer, running bad actor checks on all the officers and directors, running diligence, making sure that the advertising is acceptable and disclaimers are on there, making sure that the suitability attestations are collected, making sure that KYC and AML and suitability are all in place and stored for the regulators, right? That's a buttoned up way for an issuer to approach making their offering available to the public, right? You could hire a broker dealer of record. That's the role that Dalmore plays. Very cost-effective solution for having a broker dealer involved. Or you could list on a consolidated platform and you could pay much higher fees and commission fees in the hopes that they're going to sell your offering. It's our belief that there's really no established syndication and distribution strategy for Reg A, like there is for Reg D, right? So if I have a Reg D 506C and I'm the broker dealer, I could then build a syndicate of other broker dealers. Each has their own kind of brokers, and each of our brokers could call their, high net worth, their family offices or institutions saying, hey, we have this deal, $100,000 minimum, are you interested? For a $500 investment or a $1,000 investment, it's just not happening, right? So the only real syndication and distribution strategy, in our opinion, and based on all the offerings that we've seen what works, we've seen what doesn't work, is a solid marketing and promotional campaign designed to steer as many eyeballs as possible of folks who might care about what it is you're doing on your offering. Let them decide. Let them make the decision if it works for them. And that's why marketing and PR are so critical. So that's the difference between like a broker dealer of record that gives you that 50-state blue sky access, that does this diligence, that serves as a regulated entity for your offering, versus hiring someone and paying them the traditional investment banking fees, like, you know, the 7, the 12, 15% that, you know, involving equity and warrants, if you add them all up. That's really kind of like a placement agent structure. I don't think that's an appropriate structure to use for most issuers, although there are exceptions.
And that fee for as an executing broker fee, I know the industry average is typically right around what?
It's 1%. Typically, if you just serve as a broker dealer of record, right? So that's really what you're looking at. That's how most of our deals have been structured. It does vary if it's a very small offering, or if it's going to be a taxing process on our compliance department, that'll be indicate. You know, we're also seeing a lot of which some of the attorneys mentioned before, these series issuers, right? So they're getting approved, or they're getting qualified for the full 50 million, and then they're accessing that $50 million in the form of different series, different assets that they're offering out to the public, right? So that's, you know, having a broker dealer involved in that process is very helpful as well. And we're seeing a big trend amongst folks that are building communities of investors. Like, you know, some of our clients are in the racehorse business, collectible business, real estate business, wine business. It's something that we're really seeing the numbers increase. It happens to be my favorite use of Reg A, because it really is like, you know, you're building a loyal base of individuals who are, you know, you're constantly showing them new products. I think that's great. And I think that, you know, that goes into a further emphasis as to why having some type of a secondary process ultimately established for them. Now I have all these assets. Okay, great. How do I trade them? How do I list them? What do I do? You know, we help these issuers. We enable the issuers to have a internal secondary process where they're able to bid and ask amongst themselves, amongst existing shareholders or account holders or members of that ecosystem. The next step, and I know some of you, Shari, I know you're working on this as well, and a number of other folks, is to have an ACS where you're listing these shares out to the public, so that everyone in the world could kind of go and browse some of these assets. And I think that's the direction this industry is going, and we welcome it.
Yeah, and I think one of the most powerful comments that you had mentioned was really taking customers and turning them into investors into your business. And that is something that loosely public markets was trying to build that connection, right? You're a publicly traded company, I use X product, ooh, I can be an investor in that product. Well, there's a lot that goes on in between there, and to get to that point. Here, we're bringing that direct connection or that bond building and making a customer an actual investor much, much, much earlier, and allowing truly that user slash customer slash potential investor to grow with the company. And I guess when there was one, when you were talking through that, do we see an environment where, yes, there's always going to be the option to do it without a quote unquote broker dealer, but are we going to see a situation where why would anyone want to take that risk on their own?
You know, you're going to run into some issues. You're going to run into some state issues, most obviously, right? You're going to make a choice. Look, if you don't have to pay the broker dealer fee, then why hire a broker dealer? I get it. Most people when they think about a broker dealer, they think about the typical investment banking fees that they're accustomed to with other securities exemptions like Reg D. 7 and 7, 6 and 6, 8 and 2, 5 and 10. That's expensive. That doesn't work for everyone. That's worth hiring an attorney to go fight state by state and go through that rigorous process to try to prevent this. That's worth you worrying about KYC, you worrying about suitability attestations, you worrying about your own advertising, perhaps. But if you have a solution to hire a broker dealer of record that could do all that for you, and that could get you access to all 50 states that they're registered in essence with a box check with the 1A application, I think it's a no-brainer. And I think I think most of the folks in the industry agree with that at this point. So I think that, you know, it's all a matter of, you know, how cost effective, the risk reward involved. And when you factor it all together, I think this is the right solution.
And Eitan, also, are there any, I mean, I know we do this with our clients, but are there any ideas that you give them as far as structure of securities to simplify, to make it a little bit more understanding, to protect the investor, but also to protect the issuer? You want to touch on that a bit as an issuer question?
Yeah, I tell them, absolutely. I tell them a couple of things. You know, remember who your investor is. This is John Doe, 10:30 at night, sitting in his robe, looking at his iPad. He gets an alert on Facebook because he was browsing something and he sees an interesting opportunity. What's important to him? And for his $500 that he worked so hard for, that he finally has the opportunity to invest in this cannabis company. It's number one, do I understand it? The structure. If it gets too complex, you're going to lose them. Common equity, preferred equity, something that most people can relate to and everyone's aligned with. That's number one. Number two, does he feel like this could be worth something significantly more down the road? Does this resonate to me? Do I want exposure to this? That's number two. Number three, could I afford it? Could I put it on my credit card? You know, and these are the things that are going on, in my opinion, from the average investor's perspective. They're not necessarily even able to understand fully what valuation means, right? It's a very different conversation than we're having when venture capitalists are looking at this. It's important that you're fair with your valuation, but it might not be amongst the top 3 or 4 or 5 factors that cause someone to swipe a $500 investment to become an instantaneously shareholder in your company, right? So that's how I would look at that.
And Steve, when you think about kind of investor protections, and you think about some of the things that Eitan and Victor are talking about here, does that make you feel good, bad? What's the reaction?
Well, I think the broker-dealer aspect seems to be it's a more protective realm for the client. The part that gets confusing to me, acting as my investor perspective, is advisors often are trying to throw these things into RIAs and charge a fee. And what I keep seeing over and over again is the SEC or the states coming down on these investments because of their illiquidity. And I'm certain that the BD fits in much better in that relationship versus this asset going to an RIA. I'm just not sure if other people are if you're willing to go there, Elliot, if other people have had experience with that as well.
Yeah, certainly. I'll open that up. Did anyone want to jump in on that question from Steve?
Yeah, I will. You know, we work, as a matter of fact, we have a selling agreement with Steve, so we work with some of his IAs, and it is there's one, the custodians themselves, you have to get the securities approved to be held in, depending on the size of those custodians. That can be extremely onerous, and having a broker dealer help you through that process can be extremely beneficial. But on Steve's point, because of Reg BI, these IAs have to be extremely careful what they recommend to their clients and making sure that they are suitable for those investor profiles and their overall investment goals. So where somebody like Eitan was talking about previously, and I know I'm going out of my issuer question role, but the suitability is a big deal, more so with the IAs, as opposed to somebody who gets, like what Eitan was saying, something pops up and they want to invest in the next hemp drink that they saw on Facebook and want to throw $500 in it. It does add that level of complexity and that level of scrutiny from the regulators and the state regulators, depending on those investment advisors. So having those resources and doesn't necessarily mean that they're going to be able to place those securities into those investor portfolios if they're not fitting for their investment goals.
And that kind of leads into a key point that Steve had mentioned, and also Eitan, about liquidity, which is probably the most misused term in our industry, because it probably means 7 different things to the 7 different people on this panel. And so Sherry, when you think about secondary markets or liquidity, how should we be thinking about it from a Reg A plus perspective?
Absolutely. Thanks, Elliot. So first off, there is a panel on secondary markets at 5 o'clock. So for more details, I'll give a very broad overview. And then for further details, you can go and attend that session if this is piquing your interest. But liquidity is, a often misused term in Reg A's. I came from the equities market, and micro cap was $400 million. So it's very difficult, public equities market. So it's very difficult to find liquidity. You're not going to find liquidity in a $10 million offering. You're just not. It's not going to be a robust liquid market. So that's sort of level setting what we're talking about when we're talking about liquidity. However, Rialto is an alternative trading system, and our goal is really to reduce the friction. So today, if you would like to transact and transact in the private markets, it's very heavy and laden with friction. And also there is somewhat limited access. So, I grew up in the public markets again, and really lived through the equities market moving from voice to electronic. And back then, while public equities had a platform, it was still somewhat restricted, mainly to institutional investors. And yes, as a retail user, you could call your Merrill broker or EF Hutton, pick the broker of record back in the 80s and 90s, and you could transact, but it had a lot of friction, over the phone. Really, the growth and expansion of the equities markets came when we started allowing retail to enter the market more directly. And back then, for those of you that remember, you could log on and maybe buy or sell your securities for whatever, $30 a trade back then for E-Trade and Schwab. Now it's pretty much zero. It's not free, nothing's free, but there will be zero commissions associated with it. And really what that's done is it's expanded the markets. And so what we're trying to do at Rialto is really build the beginning of a vibrant market for private securities, specifically Reg A, and really expand and increase the access of the network. So that will in turn create a larger marketplace and a more robust marketplace, but still will not provide unlimited liquidity for a $10 million issue.
I love build the beginning of a vibrant market. We all hope that it is vibrant. We have 10 minutes left, maybe a couple minutes less than that. So if you do have questions, drop them in the chat. We'll get to them. I'm going to go around the horn and ask 2 questions while we're waiting for that to the panelists here. The first is giving a sense of the people on the phone where we are from a timing perspective. I'm not going to use the baseball analogy, but if we do use 4 quarters in a game, at what point in this game are we? And Sherry had kind of mentioned the 80s and the 90s in equity trading. So things were very, very, very different back then. Can you give us a sense, each of you, on where you think we are from a timing in the game perspective? I'll start with Victor.
Yeah, it's a great question and asked a lot. And I think we're I almost like the 9 innings, really. I think it's a little bit more descriptive as opposed to quarters of where we are. I think what happened in the first rollout of Reg A Plus in 2017 was we got thrown out on first with some people that misused it and gave it a bad name. So it slowed down the growth impact of where we could be in the 4th or 5th or 6th inning, where I still think we're more in the 2nd or 3rd. And to Sherry's point of liquidity, it's having the right issuers that have that exit strategy where they're capable of getting there, whether it be through acquisition or IPO, is going to be more and more based off of, I think, in my opinion, not necessarily the secondary market at first, while we're still building the primary, but the more so that the qualified companies are more better suited to use Reg A Plus and better positioned to exit more quickly, as opposed to an individual secondary buyer selling on a secondary market at this point. But I appreciate the fact that she is creating that, because it's something that's going to be heavily needed very soon.
James?
I'm with Victor. I'm in the baseball analogy. I'd say we're second or third inning as well. I totally concur with everything he said. But my thing is, you know, are we going to have some kind of black swan event when it comes to a Reg A or a, you know, just from a market situation to slow it down? That would be my only question.
Steve?
Well, for me, it's a whole different world. I'm totally aligned in the impact space. I say first inning. You know, I'm doing my first virtual reality aspect. So inside of 5 minutes, either on a Google Cardboard or some sort of VR platform, you can see really deeply in an immersive way, just a visceral connection with that company. And this space really serves that so well. People being able to have something super unique, great opportunity, and the firm and their advisors, the advisors being able to reach out and connect with clients in a whole unique way is where I'm coming at it from. It's just, for me, it's first inning.
And I just want to reiterate that bond that you're building by taking people that are aligned to your vision and share that passion and being able to take them on the journey with you at an early stage is just so powerful for what Reg A Plus can do. Eitan, where are we in the game?
We're early and it is exciting, and it is moving fast. And all of us are starting to see what's working, what isn't working. Marketing companies are starting to build data. What's working, what's not working? How much does it cost? What's the conversion ratio? What should I expect? How do we advise clients? What's the right valuation? Securities attorneys are dealing with questions that are fluid, you know, with regard to international investors. These are not necessarily all black and white things. And from a regulatory perspective, you know, there hasn't been big headlines of fraud. That could happen when you open up markets like this to new companies in mass that are launching new things and one after the other. In my opinion, eventually something is going to happen, and not everyone's going to be happy, and that's going to be a learning experience for us. And I think that just adds to the importance of using a regulated entity, using a broker dealer, making sure that there's someone, a third party, that's doing the bad actor checks, that's putting the diligence down, that's making sure that all of the investor suitability attestations, that's making sure that all the IDs are uploaded, that the subscription agreements are signed properly, that the advertising is what it should be and not what it shouldn't be. That's important to have organized and buttoned up, I think, at this point.
Yeah, and I think a lot of our friends that have been on these panels earlier almost most, I would say, are agreeing that, you know, they won't work with issuers that aren't working with some broker dealer in some way, shape, or form. I think everyone, for the sake of the investors, agrees with that. Sherry, where we are in the game, then Oscar, I'm going to flip everyone for one more question, which will be really quick, and I'm passing it back to you.
Okay, great. I still think it's very early in the game, and I just want to clarify one of the questions that came up from Derek. When I talk about liquidity, really what I'm talking about is liquidity a la IBM, where there's a very full depth of book. There are lots of quotes, lots of people standing there ready to buy or sell, or liquidity with less friction in it, where today, if you are an investor in a Reg A, there was another question from Derek talking about if you're an investor today in a Reg A security, where can you exit that investment? And there are, like Eitan mentioned, internal platforms where you can buy or sell from an existing shareholder. And what's just happened, we were actually the first to get this mandate across all private markets. There are now ATSs that are coming to market that allow you to transact, buy or sell Reg A securities across a large network. So it really expands that access. And so while, if you have a $10 million issue, yes, you can come onto the Rialto ATS, that's absolutely fine. Just don't expect there to be a ton of activity in that security, because there won't be. However, the friction associated with exiting that position will be diminished greatly.
Sherry, would you agree that a good analogy would be exactly what's going on sometimes in the OTC pink sheets, where you might list on the security, but there's just no market for it?
Well, and I would actually say yes, but before entering this market, we built an ATS for the corporate bond market. And in a very similar fashion, it's a very dispersed market. There are lots of different securities. IBM could have 100, 200 issues of bonds, but the key is in the ATS, or the execution platform, really bringing together that expertise in terms of building the network, as well as building the functionality and the facility to highlight your security to someone who would be interested in buying that security.
So everyone on here on the line, on the panel here is they are innovators and entrepreneurs. It's important to know that these aren't like people that are untouchable. In fact, we welcome people to reach out to us and have conversations. We've been in your shoes, both as issuers, as investors. So please reach out to us. I know that we only have 90 more seconds. We have the pleasure of Commissioner Peirce being on. So for the people on this panel, in less than 3 words, what is one thing that you would ask her, and maybe Sarah can get that through? Victor.
Well, that's really putting me on the spot there in 3 words.
You already used them up, Eitan.
I'm done. You stumped me on that one.
75 million.
Love it. Gary?
Bravo.
I was going to say 75 million, but so you stole the words out of my mouth.
Nice. Jim?
Get rid of Reg BI.
Which we didn't touch upon. Get rid of Reg BI. And Steve, finally.
Not an easy space. I'm going to pass. Thank you.
I agree. 75 million. Let's get it going. There's no reason why we shouldn't increase these levels. And so thank you, everyone, for the role of the FINRA broker dealer panel. We really appreciated being with you. And Oscar, that's 4:15 on the nose, buddy. Let's go.
Well, I give you guys a whole hour, and I hope everybody heard it from the beginning. Team sport. We're now moving into a different iteration. We're just at the beginning. You guys call it a game. I call it a journey, because a game ends. This doesn't. This just keeps going and going. And Eitan said it best. We're learning along the way. And the critical piece here is that we need the broker dealers involved in that discussion, along with the lawyers and everybody else sharing that information. And so we can bring more transparency to it. We're seeing a different type of companies now asking for Reg A. And we're going to meet some CEOs here coming up. And they're asking different questions that they asked maybe 2-3 years ago. 2-3 years ago is a novelty. Wow, it's new. I want to be the first. And when you're the first, you don't ask many questions. You trust your advisors, and away you go. And I'm sure all of you are going through this. People are asking, so if I use this, what's my return? And what does that look like? What am I going to see daily, hourly, and all that? So it means all the pressure is back on us. We made the promise. We're building the roadblocks. Now we just got to make sure that we can deliver that. And that's a great thing for the industry. I thank you so much, Elliot. You did a great job. James, Eitan, Victor, Sherry, everyone, thank you so much for your time today. I really appreciate it. Looking forward to talking to you guys very soon. Take care.
Thanks, Oscar. Thanks, Elliot. Thanks, everybody.
All right, so we're going through a path right now, everyone. We're doing something different. We're adding another element to this event that has never been done before. Sorry, James, I like you so much. I kept you here.
He's welcome.
Yes, he is. And this is, it's exciting for me because, I think that broker dealers said it best. There's a lot of pressure on them today for information. about the market, success, non-successful, what works, what doesn't work, and all that. So today we've been hearing to the lawyers, if you've been part of that, we've been hearing from the investor acquisition firms, we've been hearing about the different verticals, IR, PR, we're now hearing about ratings and research, which, you know, for any CEO, that's an exciting moment. But for the 5 of you that are here, or 6, I learned how to count. Uno, dos, tres, cuatro, cinco, seis. Do not contact him. Do not contact him. Whatever you do, do not. If you know. So where we are today is exciting. For the very first time, we're actually bringing CEOs of companies that are either one, they finished their capital raise, they've done their Reg A, you're going to meet Jeff at Legion M, and those that are in the middle of their capital raise, which you're going to meet Michael Jansen from City Zenith, Ryan Betancourt from Legion Works, and some that are just getting started, finished, kind of starting finished, Sally Outlaw at Worthy Financial, and one that's just getting started. Boy, his journey has been unbelievable. Greg Anderson from Ceres. And of course, my colleague, Jordan Lamb from Enjoy Moxie. I hope I said that correctly. I did? Okay, good. So
the only thing you didn't do, Oscar, is you didn't tell Greg to wear black. I mean, all of us are wearing, you know, just clearly not as cool.
I'm wearing gray, to be
honest.
Yeah,
the memo. Yeah, clearly. So, I mean, clearly we're way cooler.
The rules of the game are as follow, because I want to keep everybody compliant. We've never done this before. So this is really to talk about the journey as CEOs that you undertook. And obviously each of you has something very unique, and part of it is what you do. So what I'm going to ask you to do is I'm going to come at you and just tell us about your company and give us an idea of, you know, you heard what everybody else is saying. Did you follow that, or did you go on your own route for that? So I'm going to start with ladies first. I'm going to go to you, Sally, first, and just want to get a little bit of takeaway, because you've done this now twice. You raised $100 million so far using Reg A. You're successful. You're going to do another Reg A for another 50 million. So clearly you like it. So, well, sorry, I mean, you like it so much you went back the second time.
That's going a little bit overboard. No, I do like it. You know, obviously most of us are in this space because we want to, you know, attract retail investors. We want to, you know, in my case, you know, our goal was to help, you know, everyday Americans build a nest egg. So what we've done is a little bit different maybe than most of the other Reg A's I've heard about today. I've tuned into a couple panels. Most of the Reg A activity I've been hearing about is equity, right? Where people are selling, you know, shares in their own company, BrewDog or what have you, you know, to raise money for their own company. What we've done is we took Reg A and we really used that framework to create a debt product. And what we've done is we've created really $10, 5% interest earning bonds, and they're totally liquid. You know, the panel previous to us talked about liquidity in Reg A. And that again, more with the equity framework, but we created a debt product with Reg A. And, you know, as you mentioned, we've sold through $100 million of that product. We did a first offering of 50 million. That was called Worthy Peer Capital. And then we sold through that 50 million. We created another entity, Worthy Peer Capital 2. And now we've sold through that 50 million. And we just launched last week Worthy Community Bonds for another 50 million. As you know, there's that $50 million cap. So, you know, we have to create new entities with new assets in order to continue within a 12-month period to be able to sell to the public. So we've had a lot of success with it. You know, the journey was difficult at first and then got easier. Someone in the last panel said, you know, people are starting to see what works in this space. And that's what happens, you know, right? You might take 6-7 months to get that first Reg A approved or qualified. And then you learn in that process. And the second one went faster and the third one went even faster. So you live and learn, and you figure out, you know, where the SEC falls and how they're viewing, you know, your framework and your product. And that's helped us a lot, obviously, you know, get through to where we are today.
So I'm going to ask you just 2 short questions because I'll get around. So number one, obviously you heard broker dealer. So did all of your races till now, did you go with a broker dealer, or at the time when you started, that wasn't the case?
We have not used a broker dealer. We are looking to do an equity raise, and we'll use one for that. because to me that's a different product. We're just really an issuer of a debt product. We're a bond issuer. They're called worthy bonds. So we just sell them directly through our Worthy Bonds website. And we do have obviously a payment processor, and they have to do the identification verification and fraud checks and all those sorts of things. But we're not worried about the KYC, so to speak. We're not an investment advisor. We're not a money manager. We're really just an issuer selling this bond to the public. We have to obviously do all the full disclosure like everyone else does going through Reg A, and we link to our offering statements, and they have to read through that and accept those risks and disclosures. But we did not use Reg. We did have to knock on those 7 or 8 state doors, and I am a registered investment advisor, and I think that helped, because I think in 3 or 4 of those states you had to either have that exam that I took or some sort of license in order to sell in that state. So between my having that Series 65 license and us having lawyers obviously that worked with those 7 or 8 states, we got through those 8 states. We're doing it again now for the 3rd time. Unfortunately, every time you create a new entity, you have to go back to those 7 or 8 states. So we did get it through. The first 2 times we've done it ourselves without a lawyer. Without a broker dealer the 3rd time. But when we do an equity raise with Reg A, we'll definitely use a broker dealer.
Perfect. Yeah. And I'm going to go to Jeff now, one of the co-founders of Legion M, so who is completed as well his Reg A at the moment. And his Reg A was done very different than what we've talked about. There's been this whole discussion, doing it on your website or not. And obviously he was one of the early entrants into the market. And you ended up doing your Reg A on WeFunder. So when you started that path, did you decide between WeFunder and a broker dealer? And why did you make that decision at that particular time?
Yeah, it's a great question. For us, our journey actually started with Reg CF, because we were one of the very first companies. In fact, on May 16th, 2016 at 9 a.m., we were literally one of the first companies in the world, well, in the US, I guess, to file for a Reg CF. And so we started there. And then based on the success of the Reg CF, we went and did a Reg A. And then we've gone back and done a Reg CF. And for a while, we had a Reg A and a Reg CF. And so it's kind of a little bit of an alphabet soup, along with some Reg D in there for good measure for accredited investors. And our company is a little different probably than a lot of companies, because the only reason that our company exists is because of the Jobs Act. Our foundational premise is we're a company that makes movies and TV shows. And our foundational premise is that an entertainment company that's owned by a large group of fans has inherent competitive advantages just because of the fact that it's owned by a large group of fans. So for us, this is a different route of raising money. It is literally the whole foundation of our business. And so to answer your question, we started off with WeFunder, and on Reg CF, you have to go on a platform. And we've established a great relationship with those guys. And because of that, when we went to go shift gears to do a Reg A, we just stayed on that platform. And we have done a little bit of stuff off platform on our own. We have not worked with a broker dealer. And it's funny. I feel like the times are changing, and when we started 4 years ago, it was a dramatically different landscape. And so today, I think we're very interested in talking to broker dealers. But at the time, it didn't seem like a good fit for us, because we were not going after large money investors. We've got kind of the opposite philosophy. If you're trying to build a legion of fans, you're not going after whale investors the way that you traditionally would if you're raising money through angel investors or something like that. We're looking specifically to get $100 investors. And that was really problematic at the time with the broker dealers, just because the level of overhead that they had to go through in order to make $100 investment. And back at the time, half the people thought it was Kickstarter, right? And so it was just really, it's changed dramatically.
We've come a long way since then, Jeff. You're right. I mean, 4 years ago, and that's, if you heard the last panel, Etan and Elliot and all of them were talking about, they call it a game, I call it a journey, because it's going to go on and evolving. How you started 4 years ago may not work today. And it's important for everyone who's listening here that, you know, Sally, you have to really understand, she said something really interesting about her. She's a registered individual. Most CEOs are not registered. So pay attention to that, because that's had an implication why you need broker dealers. But even when you are registered, getting professionals on your side, given that the team sport has now grown. So the two of you have gone through the, you know, you're already done, and I know you'll do it again, I'm sure. But I got two speakers right now, two CEOs here that are just starting their journey. Well, not just starting, but they're getting started today in 2020 COVID-19 era, right? COVID-19 era, what do we know? The first 6 months, 280% increase of online investing over last year. So boy, are you coming in at a great time, but as the rules have changed. So Jordan, I'll start with you first. I mean, Moxie, enjoy Moxie, my apologies. It's, you know, you and I had a great conversation. I love the passion you have for your company, what you've been building, the differentiators, but tell us the journey that, you know, you were telling me everything you absorbed to get where you are and choosing all the things you needed to be successful.
Ooh, where to start? Apologies in advance for the background noise. I'm starting to get back into travel life. So I'm actually in McCarran Airport right now. But I actually got really turned on to the entire landscape of Reg A through a KoreConnect's webinar that I watched that was taped, I think, back in March. And I had known about it for a little while before that, but it had exactly what Jeff mentioned, this like kind of a optics of though it was just a Kickstarter thing. The breadth of what the opportunity represented was very unclear. And I think that's because it really hadn't hit critical mass yet, at least not in any of the spheres that I in the cannabis world was aware of. And so understanding and seeing the landscape of the different service providers and how they interacted with one another was kind of the first step of, you know, untangling the knot in the dark, so to speak. But once you understand kind of everyone's place in that world, and how it plays into this ecosystem that really is, it feels more like a community than an industry to me at this point. It's a grouping of people that see this ability to change the entire paradigm of finance and do so in a manner that really decentralizes the power away from banking and more to where it belongs ultimately amongst the visionaries and the operators of these companies that have audacious goals that they actually have the potential of achieving.
That's great. And you know, your other colleague who I'm going to bring in is Greg. I mean, your journey, you got a viable business, you generate revenue, which is great. I mean, you and I had a conversation about this, Jordan, and obviously I'm not going to say it's vanilla, but you're doing a Reg A, and you know, it's pretty straight through going through the process as you might have heard some of the lawyers like Marty, Jamie, Louis. The process doesn't take very much anymore in the legals. But this next CEO I'm going to tell you about, let's see if you all have the patience as he has. I think they're 2.5 years in. So what he is about to embark on, what he is about to get qualified on, is going to bring a brand new dynamic to Reg A. Greg Anderson, CEO and co-founder, of Cirrus Coin, a new fully qualified stablecoin.
Not yet fully qualified.
Not yet fully qualified.
Only another 2 years to go.
We're 2.5 years into it, Oscar. Let's not fumble it right before Miss Peirce comes on. Right.
I want to make sure she knew you.
Yeah. So it has been I know you talked to us a little bit about a journey, and you call it Jordan's thing of vanilla. I guess ours a Neapolitan offering that we have. We started a couple years ago trying to figure out a way to facilitate financial transactions in legal cannabis. And at that time, this is about 2016, ICOs were kind of blowing up and whatnot. And we saw these ICOs as a quick and easy way to raise money. And that's what we thought it was all about. And we have obviously progressed significantly since that point. And we took our original offering of a security, recognizing that these securities with their volatility are not very good for transactional vehicles. So we bifurcated our offering and we created a stable coin, which is the vehicle that moves within the ecosystem. So what we have been doing for the last 2 years with the SEC is helping them get their hands around this stable coin as a security. And so it trades and acts like a security, and it is a security. And so we're able to use that security to eliminate the cash out of the ecosystem. By having it as security and using a broker dealer, which I know you want to refer to, that all of those folks that come into our ecosystem and using this stable coin have gone through KYC and AML, which provides the regulatory oversight that that the players in the system want to do. So it's a pretty exciting thing. Now we're working in legal cannabis. We have a stable coin offering. We have a Reg A offering, and all these things kind of blow up our investors' minds. Like, you know, this is too much for us to handle. And sometimes we are trying to boil the ocean, it seems like. But the technology that is available and these tools that we have available for us now are going to allow the stable coin to be used in other industries outside of cannabis. And that's kind of our petri dish right now. But using these, you know, in these new spaces, these opportunities with these new tools is just too much fun right now.
I like the way you say this. It is a lot of fun. It really is, because if, you know, this is not a crypto event, but when you think of crypto, nobody ever thinks about using it. That's what I like about this. It's an usable thing. So you know, we're all, you know, rooting for you.
The use case, you know, between that and then having the secondary markets that like Rialto with their ATS is providing, it just is all coming together at a time that's going to really allow this to be a functional thing.
Perfect. Thank you. So the last two CEOs we have here are right in the middle of their race. So, you know, they're not at the beginning. They were there before. They're not at the end yet. I'm sure they wish they were. I know Michael Jansen does. I feel the neck. So Ryan and Michael are both, interesting enough, they're both doing a Reg A, and they both started differently, and they both gone with little bumps along the road. And I really want, you know, the thing that I want the audience to understand is it's great to know what the company's doing is great, but, you know, choosing your partners right. And I know, Michael, you have an experience, Ryan, you as well. We don't need to go into the details who they are, but both of these companies are at the moment on their offerings. So Michael, let's start with you. So, because what you're about to do is you started with a Reg CF in one platform, then you moved over to another platform for a Reg A, and then you're going from there directly to your own website. What a journey, right? And lots of gray hair to go along with it, with all the grueling components of it. So
that's why he's wearing a hat. He's hiding his gray hair.
That's why he's hiding it.
I want to address the gray hair issue right away. So in between.
Oh, it's nice. It's nice and wavy. Damn, I got to get that hair color next week.
The whole story behind that, which I'll tell in another conference. But yeah, no, thank you for having me here in the first place. Nice to meet everybody. Great to hear your stories. Happy to share ours. We did a CF on a different platform last year, and we knew nothing about crowdfunding. My background as an entrepreneur predates the Jobs Act. So my previous company, I schlepped a tote bag up and down Sand Hill Road and got funded by Sequoia Capital eventually and grew business number one. And then when business number two came around, everything was changing, including the fundraising environment. And somewhere around the time I knew how to raise money from angels because I had done that before in my previous business. So I did it again in like the 2012, 13, 14 timeframe. And around 2015, 16, I got introduced to crowdfunding in the UK. Actually, you guys may or may not know that the UK predates us, the Jobs Act. Their peak of crowdfunding was actually before us. I think we just surpassed them this year in volume or something like that. But anyway, so we got into that scene because we had a London-based company and we were able to structure things in such a way that we could apply for this type of funding. And I did a number of pitches and I raised about £4 million that way, which for a company which was kind of getting off the ground in a very, very difficult time was really a godsend at the time. And then I came back to the States and began thinking about, what we were going to do here. And, I had the experience of institutional money and I had it from end to end with one of the finest venture capital firms apparently in the world. And they are a very talented venture capital firm with a lot of success. I also felt that there were negatives to being funded by any VC. any private equity firm of various kinds. And then I remember difficulties I had in that relationship at certain times of the business where the structure becomes a real challenge for the company. I think many of you know about this. So the crowdfunding became a really interesting solution because you could, fund a company and then maintain control and then actually bring kind of regular people into the company and let them get rich as opposed to the LPs of these very fancy VCs and private equity firms, which is all really a very interesting thesis. And for us, to Jeff's point, it's this Reg A journey is actually beginning to transform our company a bit because now that we have not 5, but thousands of investors, we start thinking differently about how we want to go out there and what kind of products we want to make, because now you have a community out there that's different from the one you had before. So I raised that money in about less than 3 months, the first million last year. It was a successful CF. And we got lucky because we got endorsed by one of the publications in the first month, and then frankly never looked back. It was a very successful campaign. And so that can be good and bad. Sometimes having a home run on your first at bat can be the worst possible thing that can happen to you, because you think that, well, that's what I do, I hit home runs. And then we did our A+, and thought a lot of the old tricks would work, but it was a different arena. And I think what we learned and we're learning is that it itself is changing. So you make a decision, you think you're making all the right decisions based upon all the right parameters, and then things themselves, the parameters are changing. So, but I do think that, yes, we started on a platform and now we're going to our own. And there's a bunch of reasons for that. I think we're doing okay kind of raise-wise, but we feel like a lot of the audience that we're generating is dying into the platform that we're on. And the attention that we create gets lost to some extent. If you will, it's kind of like being on a shelf in a grocery store with a lot of other products. And you create attention and people go into the grocery store and they forget what they're in there for. So there's a lot of, I think, loss of attention and inefficiency of marketing dollars of our own that we've discovered in this process that has us as a concern. And secondly, I think it's been talked about a lot earlier, just simple access to the data. We really want to build a community. We want to work with them. We recently launched a pledge in the company. We, not to talk about what we do, but to help the world cities decarbonize by donating our technology there. And we were able to use this A+ campaign to invite people to invest in the company, and some part of that will get used to help create this and donate this technology to their cities. So we're able to tie what we do into what regular people in those cities are experiencing, which we would never have thought of before if we were just raising money from a traditional institutional investors. So I'll let you know how it goes. The most recent exciting thing, like everything else, we don't know what's working or not working yet. I think that PR is working great so far. I think some of the social media stuff is still a learning process for us. The current platform we're with relies on Facebook, but I think a combination of tools is probably what people have seen to be more successful. So we recently changed our digital ad placement provider last week, just being very candid. Kind of these mid-season adjustments you make doing an A+. Ryan, I'm sure, will have his stories. So, and
it's part of the journey. Look, I mean, there's no secret around the industry's gone through kind of a let's grow up really quickly. So there's been 2 bombs that's happened in the last 90 days to the industry. So,
sure,
and it's imperative that people understand, yes, you get qualified for this offering. Yes, you can do it without a lawyer. You can't do it without a broker dealer. So why now are these pieces becoming so important? Because when you need to take the money, the financial institutions are now saying, you know what? No, we can't let you go off to the wild horse. We need somebody regulatory oversight your activities. So we've seen the bad already when things are done without these entities. And because of it, when you're in the middle of an offering, Michael has experienced that pain firsthand. And it's nothing he did. It's not of him. It could have happened to Sally, to Greg, to Jeff, or anybody at any given time. And it's coming down to the whole market where financial institutions, particular credit cards and ACH providers, are getting a little bit more concerned about this, not because of the coming in. They love that part. They love making money. It's the part where we get one bad apple that does it and the whole refund has to be done. Imagine that for them. We think it's simple. It's click of a button. It isn't. So,
but I know the other gentleman has to talk, but just to that point real quickly, I'll tell you, when you're grateful that you've got, supporters like good lawyers behind you, is, in Florida, they knock on your door randomly. Our regulators, our, licensed securities guys came at 9 a.m. and showed their badges and says, we're coming in, let's see your books. Let's see your, audited financials. Let's, give us a list of every bondholder of your tens of thousands, who you sold in Florida. And, and show us every bank statement, every investment you made. I mean, you got to have your crap together, so to speak. So, it can seem fun to, interact with retail investors and engage with them and, and build this community, but you better have all your ducks in a row when the regulators come knocking. So you want to be able to sleep at night.
Yeah, you need to be responsible, and we'll get to that. So my last, our last CEO, and look at that, he's dead center there. He's been patiently waiting. CEO, one of the co-founders of Legion Works. That's right, we got 2 Legions. So I had to separate you two because otherwise people would get confused. And at first I almost did. Legion M Entertainment, which is pretty funky. And then of course, Legion Works. Ryan and I have been chit-chatting since he started, like most of you. I get to know you intimately. I love the journey because I'm going through it myself. So it's exciting to see what you're going through and the experiences you're having. And one area that I often feel is like picking your executive team, your board of directors, your advisors, the partners you choose around you, your broker dealers, your lawyers, and all that can impact. So Ryan, again, the floor is yours, my friend.
All right. So our journey is a little bit similar, or at least my journey is similar to Michael's, in that most of my experience as an entrepreneur has been building companies with institutional capital behind them. So VCs and larger angels. And as we got to the point that we started Legion Works, part of the premise was actually that within VCs and within angels, there was a hole. I'll stop short of saying that I feel that that's broken and that there's flaws within that space, but there certainly are holes, and that was part of our premise. So if that was part of our premise, we couldn't really go to VCs and raise capital saying we're actually trying to fill a hole that you guys create, and we're trying to fix flaws that you guys have within your space. So as we looked at where we're going to raise the capital, a year ago, last August or September, I had never heard of Regulation A. In full transparency, it wasn't something that had ever really been on my radar. I'd spent a lot of time going to the VCs that I knew, building relationships on Sand Hill Road and in San Francisco and New York and LA, raising capital from institutional investors and really trying to limit the number of investors that we had. Party rounds, as of last August, were considered those rounds that had more than 3 investors for me and my colleagues when we'd raised capital in the past. So going from 3 investors to now having over 700, and that's growing rapidly, is a new experience for me. So the journey has been interesting. The journey's been interesting as part of a year that we never could have seen coming, both financially and with everything going on in our lives. And so as I looked at Reg A and quickly had to learn what Reg A was and what Reg A wasn't, the key for us really was to build the right relationships. So for our business, very early on in my career, I learned that when I didn't know something, I had to find the people that did. And when I didn't have access to the right ideas or the right knowledge, I had to find the people that had access to the right ideas and the right knowledge. And Reg A, coming into it a year ago with very little knowledge, the first thing that I found that I really needed to spend my time doing. So thankfully, we have an advisor that helped us navigate Reg A. And through that, got introduced to great folks like Oscar, to our dealer broker, who we're very thankful to work with, to the foundational tech. We built our own platform. We jumped right into Reg A right out of the gates and build our own platform using our technology know-how. But without those partnerships, without that access to those individuals, we never would have been able to navigate this journey. We started the process literally writing up the documents last November. We were told that we would have everything in place by January. we mistakenly told our
You believe that? You believed it?
investors that we would have everything in place by January.
When did you actually, I had the same story, December, not November. When did you were told that they would be ready by, and when did you actually?
Yeah, so we were told in, let's see, we were told in November that we might be able to have it qualified by Christmas.
Qualified.
And at the latest, it would be the end of January, and we qualified.
Tell you what year? Did they tell you what year though?
Yeah,
yeah. But there's been a lot of bumps in the road along that journey. I mean, going from thinking we would have everything ready to go in January at the latest, and that made for an interesting February, March, April, May, and June with investors that were ready to invest, that we've been courting over a period of time, making sure we had everything in place, making sure we kept our sanity with everything going on in the world. And so for us, the partners that we have had within that journey has allowed us to navigate that. I honestly think if we didn't have a dealer broker, we didn't have Oscar to learn from, and the other folks in the industry to learn from, I think we probably would have dropped out. And who knows, maybe we would have gone and raised institutional capital. Maybe we would have not, and put things on, cobwebbed it for a period of time. But thankfully, because of great partners, we've been able to uphold our vision, which is, again, we feel like there's a hole in institutional capital for the entrepreneur, and we felt the product of those holes as entrepreneurs. We also think there are holes in the way that investors can and can't get access to those deals. Again, like, to have to be rich to get rich is not, I think, how we think as a country and how we think as entrepreneurs. And when I can't look at certain family members in the face and say, hey, this is what I'm doing, you can't invest in it, that's not a particularly great thing. So we're thankful we've been able to have the partners to get to a point that we can uphold our vision.
Thanks, Ryan. That's I really appreciate that. That's the journey of a CEO is it's not with ups and downs. And I remember the conversations you and I would have afterwards. Oscar, we're ready.
We're ready.
We're always ready.
We're ready. No, hold on. We actually got qualified, and then we had to retract it, and then
retract it, and then do it all. Oh yeah, Ryan's case has been really interesting.
So, because people were concerned we were going to be thought of as a SPAC, which, if you look at the public markets, being thought of as SPAC is a great thing unless you're within Reg A, which we're not a SPAC, and we have to be very specific that we're not a SPAC. So.
Yeah, we had the same challenge because they said, well, you're an investment company. Because we are selling these bonds and we pool that capital, we pool the bond proceeds and then we lend it out into secured loans for growing American companies. They said, oh, you're taking that money and investing it in another security because, they felt like loans were securities. So we had to, I literally spent days digging through the Reg A framework to find a definition of a security that we could get around. I mean, basically, if you do the kinds of lending we do, it's one of the only areas they don't consider to be a security. And that was able to, that little hole was what we were able to get through, to get the bonds approved or qualified, can't say approved. But, yeah, so it just takes a lot of digging and you have to be able to understand the regulations and understand you're trying to protect the investors. And, it's a long path.
Oh, and not just those parts, but when you consider what Greg is doing at Ceres Coin, it's changing, it's utilizing the regulation in a certain way, and then when you're also trying to add a different asset class, as you heard in the verticals. I mean, we're hearing about collectibles, fan clubs. I mean, look at what Legion M is doing. It's phenomenal. I mean, what are you at right now? 7,000 fans? I mean,
25,000. We have 25,000.
Sorry, I mean, even I've lost count, right?
Yep.
And people, and I wrote about this. So, look, I've been writing about this because I really love the Jobs Act. I'm in love with it. I'm a Canadian. I just think it's the ultimate regulation. It's well balanced. For those who say, well, it's too difficult to get in because you need to, no, it's well balanced. It's there for the investors, it's there for you, and for the community at large, the regulatory providers, the broker dealers, the lawyers, the auditors, and everything else. And for the very first time, people are recognizing it that, yes, you need them all. Yes, at the beginning, you could do it without it because you had to build that roadblock, what Legion M did at first, and of course, what you did, Sally. But now it's fully team sport driven, and it's opening the minds of so many people. I'm seeing some phenomenal projects, I guess, per se, that I would never even thought of. But the fact that we can take that idea and then put it to fruition and get them to go through the process with their lawyers, broker dealers to get qualified and then be available to the general public and make them fans. So my first article I wrote when equity crowdfunding was about to get launched was that making shareholders into customers and ambassadors, which is what you've done, Jeff, at Legion M, what BrewDog has done, and many others. I remember in a panel in 2015 getting into an argument with a VC who said, who on their planet would ever want thousands of shareholders in their company?
I think I was in the audience in that.
Well, it was ironic because I go, wait a minute, when I come and look when I'm looking for capital for my company from you, the first thing you ask me is, how many customers do I have, right? And what I'm telling you now is I got 5,000 of them. 5,000 loyal customers who love our brand, who use our product, and gonna go out there. I mean, how great is that? So,
Oscar, think of it in the public markets. I mean, my kids are buying Netflix stocks because they're in their 20s. I mean, you buy, even in the public market, you buy Affinity. You go to Starbucks, you buy your Starbucks stock. You buy I have my Tesla stock because I love Tesla. Even in the public markets, a lot of us buy based on loving the brand and loving their product or using their product. So it makes total sense that would cross into the private markets like this.
Yeah, of course. And the journey is just beginning, but I firmly believe that you need to, as CEOs, all of us here, all 7 of us, we have a responsibility, which is we've been given this gift. It's great. And yes, we're asking the commission to increase it to 75 million. That would be phenomenal. But the gift we've been given is phenomenal. But it comes with a responsibility. The responsibility is to manage them, to communicate with them, and get them involved. I mean, Jeff, what you guys doing, Zitty Zenith, Michael, same thing. I mean, you guys are doing a phenomenal job. I know Enjoy Moxie is just getting started. Greg Anderson at your group is just getting that whole process started, and Legion works as well. So it is a embodiment, bringing everyone together. So here's my last question. I need you all just to answer 3 questions. So imagine you're sitting in just like Jordan was a year ago watching the videos. If he was to watch this video from each of you, what 3 items do you think is so important that they should, when they're looking to doing a Reg A, what 3 things do you think are important that they should consider when they're doing it, or what kind of, what are the items that you think should be important? So I'll ask Michael Jansen first. Michael.
I was going to hope I could go last.
Okay, you want to go? All right, man. I'm good with that. I'll give you the last spot on that.
Many more seasoned people out here.
Yeah, that's right. Okay, fair enough. Jeff?
Well, how about Oscar and CoreConnex and Sarah Hanks at CrowdCheck to put in a shameless plug for 2 of our favorite partners. But no, I think surrounding yourself with people that understand the space, and I think that's way more possible today than it was a few years ago. But I think that's absolutely fundamental. If you're an entrepreneur, you're not probably used to things like audited financial statements and 100-page SEC disclosures, but that stuff is really important and you've got to get it right. So I think that's a critical thing. The other thing I'd say is, it's what you were talking about, touching on, Oscar, is that if you start to look at your investors as more than just a source of capital, but as a community, and figure out how you can leverage it, that's where the Jobs Act becomes fundamentally transformational. Because, up until now, if you think about it, every single company, every large public company has had to follow a path that was controlled by the IPO process. And the fact that you can go out to people, you can get them involved in your company, and you can get them involved with your decision making. I know that BrewDog uses them to help, taste test new designs. We use our investors to leverage the wisdom of the crowd to choose movies at Sundance. And we've got data now that shows that the films that our community chooses have better like Rotten Tomato scores than the films that we would have chosen if it was just us. And so I think that figuring out ways that you can make your investors part of the company, it unlocks so much power. And all those people, because we met the same people saying, you're crazy to want all these investors in your company. But I think as we've gotten into it, I think that it's absolutely key.
Perfect. Thank you. Jordan?
Yeah, I guess what I would echo so far for myself, because I'm still very early on, but normally when you go into finance as an entrepreneur, you've got a lot of advisors, a lot of people that you rely on for that like very serious expertise, and it feels very opaque. You know, I recall even, you know, because we've raised institutional capital before now embarking on this Reg A journey, and you know, I'm out there doing the roadshow while there's a whole team of others that are putting the rest of the pieces in place. And so you I don't want to say lose track of the details, but it's impossible to have your finger on the pulse of everything that's going on. And Reg A, while at the outset is a little bit daunting because you've got the SEC, FINRA, broker deal, all these terms that just, you know, create a bit of a swimming head. It's not that indiscernible. And it's probably more important than any other version of finance that I've seen for you as the CEO to really have your head wrapped around it. Because once you do, you can move forward with a level of confidence that it can help mitigate the risk of you know, running into roadblocks, or at least ensuring that there's a higher likelihood of success. Now, I'm saying this pre-qualification, so let's talk again in a little while. But
it's fair enough. Fair enough. Sally, we got 2 minutes. Sally,
yeah, real quick. Well, it's exactly what he said. I mean, okay. I think the number one for us is customer relationship. I mean, we call them our worthies, and they all wear T-shirts that say "I am worthy" on it. And they send us pictures of "I am worthy" stickers on their babies and their dogs. You know, it's like we just love them. You know, we get a lot of feedback, and you know, they're just very involved in our business. So I think that customer engagement piece, that customer relationship piece, is hugely important before and after, you know, using Reg A. And one more thing I wanted to slip in is time horizon. I mean, based on the comments here and what we went through initially, you give yourself more time than you think, you know, to get through the process and get out the door, you know, with your product or your raise, whatever. You know, in our case, it's a product, but it takes more money and it takes longer than you think. And of course, those resources, I echo, you know, we've got great lawyers. We have a CFO who's, you know, run public companies. You know, right now, since we have 3 Reg A's, he's like, there's only 2 days a year where I'm not preparing for an audit, you know, or I'm not doing a report. So it's, I mean, there's a lot that comes with it. Not just do your Reg A and you're done. There's a ton of compliance, you know, and just stuff you have to keep up with. So just make sure you've got the time and the money to see all that through.
Perfect. So Greg, Ryan, Michael, you guys got 1 minute, 30 seconds each, 3 items for CEOs that you think they should consider, obviously outside of what the others have said.
Real quick, use case for the Reg A, make sure that the Reg A is the proper tool for us going to, you know, trying to use the security as a retail mechanism, having that, and then having a committed team, both financially and touching on what Jeff said with your legal and broker dealer and transfer agent, all that stuff, because it is a long process. There is not a roadmap out there, so you're creating new paths. So just be prepared for that.
Ryan?
First, who's going to go on the journey with you as partners? That's key. Second, how do you talk about what you're doing and your vision to a much broader set of potential investors, some that are very sophisticated, some that are just learning, and how do you do that in such a way that everybody understands what you're doing? And then third, how do you create a relationship with your investors that allows them to become part of the journey, both transactionally and making it easy on them to invest, but also, as Jeff mentioned, takes them along on the journey so they can learn and feel part of what you're doing and be proud of being part of what you're doing.
Thank you. And Michael, the best to last.
He had all that time to come up with some really great things.
Yeah.
No pressure. Yeah.
Plagiarize and synthesize everybody said. I mean, everything that everybody said is perfect. Have a close circle of good people with experience in this who are there to fight the fight with you. I feel like I do. Thank you, Oscar. Thank you, Sarah. It's people who are really been terrific for us. Thank you, Paul. To Ryan's point, yes, you have a new family suddenly. you have thousands of people around you, and you have to sort of accept the fact that you've got this new large community, and if you can engage them and leverage them, I think you can do extraordinary things. We're just beginning to do that, but we've had customers invest, individuals, and it's a wonderful thing. And lastly, someone told me this once, every Reg A requires a little unique marketing magic, and everyone's got to figure that out for themselves. And so, you know, that's our everyone's challenge. We're trying different things. Some things are working better than others, and I think that was wise advice.
That's perfect. You know, kudos to all of you. I mean, in the journey that you're all undertaking, and obviously every speaker today is grateful that you've taken it, because we're all working with you. For those who already completed it, hopefully you'll revisit the Reg A again. For those who are doing it already for the third time, thank you. And for those just getting started, the journey is just beginning. Take good lesson to the fact of this is not just shareholders. These are people, ambassadors. We're calling them gladiators. You know, I love the Worthy. I love what the, you know, Legion M is doing. Everybody, you can create that little community on your own. So I want to thank you all today. Thank you so much for taking the time. And I'll be skipping you off. Right now, we have the main event coming. This is an exciting discussion that many have been waiting for. This is the event where we get to have our very own Sarah Hanks speak with none other than Commissioner Peirce. And obviously everybody's curious to learn about the role of the commission. We're all excited because of the role the commission has played in Reg A and other regulations. So today we get an opportunity to have them both have a fireside chat and speak to all of us. Welcome, Commissioner Peirce. It's a pleasure to meet you for the very first time virtually. And Sarah, the floor is yours.
Okay, well, thanks, Oscar. It's really weird to do fireside chats, sort of, you know, in the middle of absolutely nowhere, as opposed to, I know. I did actually think about having sort of fake fire that we could superimpose, and that just got too complicated. But Commissioner Peirce, thank you very much for being with us. And I think a lot of people know your background, but I was just looking back through your resume, which is such a perfect DC resume. So Commissioner at the SEC, confirmed by the Senate twice. You've been with a think tank. You've been on Capitol Hill as a staffer. You have been an SEC staffer, and you've been in a private law firm. I don't think there's any part of the DC experience that you have missed out on here. And as we'll talk about later, I mean, maybe that whole record is useful in your role as a commissioner. But I just wanted to ask you about you know, how it feels to be a commissioner. And in order to do that, I just wanted to step back and explain to people who might not understand it, the way that the commission works. It's an independent agency. It's not part of the executive branch. There are 5 commissioners who are no more than 3 of whom can be of the same party. So there's sort of bipartisanship built in there. They are appointed by the Senate. Sorry, they are confirmed by the Senate, appointed by the administration. And I hope you're still there, because you've gone blank on my screen. I don't know if Oscar, could you? It's interesting. I don't know if we might have lost Commissioner Peirce for a moment, but anyway.
What happened? You discussed fire and that's it?
I don't know.
I will see if I can.
All right, or I said bipartisanship, and maybe that's not a thing that you know, that causes computers to blow up these days.
Let's see if we can get her back on. There's no virtual event without its little glitches.
Oh, there she is. All right. So yeah, as I was saying, the whole role of a commissioner maybe not fully understood, because you've got 5 commissioners, and against that you've got a staff, a permanent staff, Washington bureaucracy, and I was a staffer too, so I love them, but it's 5 commissioners against a permanent staff of 4,500 or thereabouts. And so one of the questions I have for you is, how much influence can a commissioner have? I mean, how can you impose your thoughts and your personality on such a huge bureaucratic machine? I don't know if we've, can you hear us, Commissioner Peirce? That's.
Wow, so.
Yeah, I don't know. I said bureaucratic machine. I mean, obviously I'm being bugged or something by the by the SEC staff itself.
That is odd. I mean, it's been working. She is there. So I'm gonna, there's nothing blocking. So I don't know how she's plugged into a speaker, or I apologize to everyone for the little technology hiccup.
I'm sure we'll get her. I saw a chat there.
Yes, we have unmuted her. I mean, so she's unmuted now. So if she is there, we're asking them to share their video with us to start on the camera. There's 2 versions of them online right now. So, okay, so let's see. This is a very odd. We haven't experienced this
maybe
before.
if Commissioner Peirce can hear us, she could just say something. It doesn't sound like.
I'm unmuted. We see her.
We see you, but we can't hear you.
We can't hear you. So we're having a technical challenge. Wow. For some reason, her computer is either the microphone is not on. And I'm trying to figure out, there's not much I can do on my end. Let me see, I'm getting some tips here from everyone.
Yes, there's lots of tips coming through.
Yeah, thanks everybody. I appreciate everybody. Her audio is not connected. Yes, she needs to connect to an alternative device. Maybe it's her browser. Yes, no, she's unmuted. She'll come right back in. Probably what happened is everybody else scared her. Be nice to the commissioner, everyone.
Oh.
So, no, it's okay, Sarah. I mean, it's been a, it's been a great day today. It's amazing, the speakers today. It's a different event than we had, the one in March. Do you recall that we were still at the, not so much, these are all the things you got to do. Oh, here we go.
Here we go. Commissioner Peirce, can you say something?
Finally, I can hear something.
Oh, fantastic. It's finally, I did an introduction for you, and when you didn't do anything,
I am so sorry. Why don't we just hop right into the substance? I apologize.
All right, so the substance is with a commission that has 5 commissioners and a permanent bureaucratic staff of 4,500 people or more. How much influence can a commissioner have? I mean, how do you try to show, how do you try and introduce things that you think are important?
Well, I think the design of the commission, and I should start by saying that part of the benefit of being a part of a 5-member commission is that my views represent my own views and not necessarily those of my fellow commissioners. But I think one of the benefits is that you do have a diversity of opinions on the on the commission and a diversity of experiences, and we all bring that to the table. And so while the chairman does set the agenda, I think each one of us has an important role to play in highlighting issues that's important to us particularly. And so the topic of today's conversation, capital formation, is one that I think is really important, especially in a time like this where we're seeing so many small businesses go out of business. But I hope that we'll also see, coming out of this COVID crisis, I hope that we'll also see a whole raft of new businesses starting. And so thinking about ways to get capital to small businesses is something that I care about. And I think my colleagues care about it as well, but I think each of us can kind of bring to the table ideas we have for how we might spur capital formation. And I think we feed off each other. So I think it's actually a very healthy dynamic.
And is there some way that if something is important to you, you're able to just reach out to the people in the various divisions? And just as a reminder to our audience, there are 5 divisions. The one that we care about most right now is Corp Fin, because they're the guys who help us raise the money. Are you able to just sort of go over there and say, hey, Bill, it would be a really good idea if these rules were to be changed or added?
Yeah, I mean, certainly right now I'm not going over anywhere, but we can. I do virtually reach out, and we have regular meetings with Bill and with others on the CorpFin staff. There's a very good back and forth, recognizing always that the chairman is the boss of the staff, and it's ultimately a reporting line to him. But we have a lot of great conversations, and I think that's a really important dynamic. So that's why I do tell people, come talk to me and tell me what issues are important to you. And then I can go and take those down to the staff and raise them with the staff. Without hearing that from outsiders, it's hard for me to know what to put at the top of the list to talk about with Bill and others in CorpFin.
And I will note that several of our clients have reached out to you over the years, and you've given us a great hearing, whether it was issuers or whether it was intermediaries, and they very much appreciate the fact that they can talk to a commissioner who's in a slightly different role than the staff. I mean, the one thing that I've always known, of course, I'm biased, I'm a former staffer, people don't realize that you can actually go to the SEC and say, I don't understand, or this is really stupid, and what can I do about it? It might not move things. I mean, we are talking about, an institution that's got a lot of laws, but people will listen, and we've always very much appreciated that, the role that you especially play there.
Yeah, and I think the staff, the point that you make is a good one. The staff is really has an open door policy as well, and want to hear from people, and so I think people should feel comfortable picking up the phone and calling the SEC. It's a little bit intimidating if you haven't worked in the building, but certainly there's an openness to hearing from people, and it really is important to keep those lines of communication open.
Thanks. One thing that always strikes me is because, as I mentioned earlier, the commission is made up of 5 people, no more than 3 of whom can be of the same party. If they do have a party affiliation, is it more difficult for the party that is in the minority, or is that just meaningless because the issues sort of cross over bipartisan lines?
Well, I think that the issues that we deal with, financial regulation, are not inherently political issues, and so we're not thinking about ourselves with labels attached. As I said, different folks have different interests and different issues that are important to them, but that can, there can be crossover. And so I think it really is more a question of, are you chairman with the agenda under your control and the staff under your control, or are you a commissioner and not the chairman? But again, this Chairman Clayton, has been really a wonderful person to work with. He is extremely hardworking and expects everyone else to be hardworking, but he also is very open to hearing suggestions of what should be on the agenda. what issues are important to us. So I think a lot of it comes down to how the chairman runs the agency, and this chairman has really done a fantastic job.
Thanks. One of the things that comes to me, because having been a staffer in the past, is do you think it helps for a commissioner to have been a staffer in knowing all of the little secrets and all of the little tricks and trying to persuade people to do things?
I think it helps to know the building a bit, to know what, it really, each agency has its own personality. The SEC certainly has its own personality, and even within the SEC, each division has its own personality, and it's helpful to have some sense of that when you come in. And indeed, now we have 4 of us have had staff experience, and so I think we all come to it with that. But the commission can really, a commissioner can be successful with or without SEC experience, and people who have had other experiences can bring that to the job. So I wouldn't say one way or the other. It's a definite need to have that experience, but it can be helpful.
Right. Yeah, I've noticed something recently, and I don't know whether I'm seeing something that isn't actually happening, or maybe it's COVID related. It seems that in recent months, if not years, there have been fewer open meetings from at the SEC. And just to give people a little bit of a background, the Sunshine Act, the government in the Sunshine Act, says basically that you can't form little cliques. You can't. I remember the days when 2 commissioners would not get into the elevator at the same time. Now, of course, they wouldn't do that because they'd get COVID. But that you can't sort of go off in a corner. All of the debate has to be in the public. And I remember that there used to be a lot more, at least I imagine there used to be a lot more debate in the public meetings than there are now. Am I just making that up?
Well, so first of all, 2 commissioners can speak to each other. It's when you get 3 of us in a room that the Sunshine Act starts to be problematic. But I think as long as I remember, so I started at the commission as a staffer about 20 years ago. And I never remember a time when there was a lot of discussion at open meetings. However, occasionally there is, and there has been some back and forth in recent meetings. But as you point out, we have done some fairly major rulemakings and done them without an open meeting. And I think that's just really an expedience issue. It takes quite a few staff resources to put together to get ready for the open meeting and to do the work associated with it. And especially in a time where we're doing everything virtually. I mean, as you can tell, I'm clearly not the best with technology. So I find the virtual format rather frustrating for open meetings. But I think there is something to be said for a dynamic where you can have somewhat of a conversation. And I think if you look back over the past year or so, you will find some open meetings where there's been some back and forth and some interesting dialogue. But I think I try to be fairly transparent about where I'm coming from, and I think my fellow commissioners do the same thing. And so I think that's really what the Sunshine Act is trying to achieve.
Well, thanks. So now I wanted to turn to Regulation A itself and some issues that are relating to Regulation A. And one of the things is something that might not obviously be part of Regulation A, which is the accredited investor change. Just as a reminder to everybody, there is a limit to the amount that people can invest in Reg A. Accredited investors can invest as much as they like in any offering or all offerings, whereas non-accredited investors can invest only 10% of their net worth or their net income in any particular offering. And the Commission has just proposed and adopted a change to the accredited investor definition. And so first question with respect to accredited investors, where do we go from here? is this it? It was relatively modest. It was just people who have taken these exams can be accredited investors. Now, some of them, if they're over 40, they probably already are. So you're talking about the so-called Henrys, the high earner, not rich yet. So they'll eventually become accredited. So where do we go from here? What's the roadmap? And can we expect to see more people in that category?
Well, so you're correct that the recent rule change was not a dramatic one as far as individuals go. It did broaden the scope of accredited investor for institutions in some meaningful ways. And I think what I took away as being the really positive piece of this is that it opened the door and it said, we're not going to assess individuals solely based on how rich you are or how high your income is. We're going to look at things other than that. And we open the door for people to come in and suggest other ways to qualify as accredited. And that's where I think the really important stuff is going to happen. It's going to happen when people come into us and say, hey, I've established this credential, or, we think this credential should qualify someone as being accredited. So I'm hopeful that will open the door a bit broader.
And eventually we could see the accredited pool, which people sometimes say, well, it's only 1 or 2%. Actually, I think the Commission has measured the accredited pool at something like 12% of the population, although a lot of those are old people who just have a vacation home and aren't investing much. So we should see a much broader pool of people actually investing. From a philosophical point of view, could that be like eventually 50% of the population? And would that be wrong? I mean, where do you draw the line for people who don't need the protection of registration?
Well, I mean, I draw the line in a place that not too many other people perhaps do draw the line, but I tend to approach it from a libertarian perspective, which is that in the United States, people believe in individual liberty, and with that comes responsibility. And so people should have the freedom to think about how they want to invest their money. We give people, or people have the freedom, we don't give it to them. They have the freedom to spend their money as they like in many contexts. So why should this context be different? Now, I certainly share the concerns that motivated the accredited investor standard, which is you do worry about people losing a lot of money and jeopardizing their retirement and their children's education funds and so forth. So I understand those concerns, but I think they're better addressed in ways of reminding people that you need to ask a lot of questions. If you're not getting the information that you need to make a decision, then you should just run the other way. And so I think it really comes from us reminding people that the decision is ultimately that person's decision, and it's not we're not clearing any investments anyway. We don't do merit review. So no matter whether you're investing in the private markets or the public markets, we want you to ask lots of questions and we want you to think about it, or we want you to hire someone who can help you think about those things. And when I say we want you to do it, in the sense that that's sort of the model in which the SEC can function, because the SEC isn't a merit regulator, and so it assumes responsibility on the part of the investor.
I think that's an important point. From that the SEC's view is full disclosure. I mean, it is possible to go out, in theory, as a registered company or a Reg A company, and so you cannot ever say that the SEC has approved anything. All you can say is the SEC's finished asking questions and they've said we can start raising money. But in theory, you could have a Reg A offering who says in the risk factors, we're raising money to do X. We've never done X. We've got no experience in X. We're probably really bad at it. Here, I'm a pastry chef and my partner here cleans cars for a living, and we are trying to create a biotech company. And in theory, the staff should, after you've raised, given enough risk factors, let the offering go through. I've always found that in those circumstances, the staff in CorpFin will just keep asking questions until you are on, amendment number 17, and you know that this is never going to go through. But at least in theory, even completely speculative offers can be done when enough information is provided. And I think that's an important thing about the role that the SEC plays. Shifting to the question that everybody's got, I see in the chat, the increase in offering size. Currently, as we know, $50 million. The statute says $50 million, but you can keep an eye on it and you can change it. The proposal in March said we're proposing 75 million, but it also asked whether should it be 100 million, and quite a lot of us said, yeah, that wouldn't be bad, you should do that. Could you just weigh in on, everybody wants to know when. I'm not going to hold you to that, but whether, if you could talk for a minute about the authority to do it and the considerations that you take into account when deciding whether it stays at 50, goes to 75, or even goes higher.
Well, in terms of the when and the whether, I really can't say because we have this ongoing rulemaking, but I can say that I've been pretty upfront in the past that I do think it's something that we need to seriously consider raising the level. And, some people will push back and say, well, hey, there aren't a lot of offerings being done at the top end of the range anyway, so why do you even care about raising the level? And that goes to the question that you asked about what do we think about when we're trying to figure out what to do. And I think one of the comments that I've heard pretty often is that if you were to raise the level to 75 or 100 million, you would bring in a whole different group of market participants. And that could actually have a really salutary effect on this market. And I think it could end up making Reg A a more used exemption. And so to me, that's something that I'm always thinking about. We had so many years where Reg A was not used at all. And so the Jobs Act was intended to make it usable. And so that's kind of what I'm thinking about when I'm thinking about should we raise that number. We do want to be responsive to what Congress told us to do. And I think with the fact that they put in the statute a requirement, it's under the title adjustment, right, that we should be thinking periodically about whether the number needs to be adjusted. I think we have to take that seriously, and if we're seeing a need, we should raise the number.
I hear all the time that if the number were just that bit higher, or double basically, that you'd get the early biotech companies who just eat money. You'd get them using Reg A, and that would be much easier for them. Turning to one issue, which is crypto. You've been referred to as crypto mom. I think that diminishes, your very broad role in a number of areas of capital raising. But one of the things that we do want to know, and I know from the previous panel, one of the panelists mentioned the fact that he's been going through the registration process with his crypto for 2 and a bit years. If crypto is a security, what kind of security is it? And is it possible that there could be some influence, maybe from a commissioner, to have the staff not have issuers and their counsel do the homework for explaining how things should be treated, but more guidance? Can there be more guidance for crypto in the Reg A space?
Well, I certainly think there needs to be more guidance for crypto in on a number of different issues, and I think the SEC has not been particularly as forward thinking as I would like us to be in addressing what's a developing area, and it's an area that's developing so quickly. And so that takes me to the point of what is crypto. I think there's no one answer to that. We're seeing real-time development of what crypto assets are. And so, for example, in the DeFi space now, there are a lot of governance rights being built into these tokens, being coded into these tokens. And so that changes the nature and makes a lot of these tokens look a lot more equity-like than maybe some prior iterations of tokens are. But again, as with most things in this space, it's a facts and circumstances question. Now, Reg A is intended to be for equity or debt. And so presumably if you're going to be a crypto issuer and you're going to use Reg A, you got to fit into one of those buckets. And so that's part of the process that you go through when the staff is asking you questions. That's one of the things they're going to be asking you questions about. Where do you put yourself? And so I think that has to be answered. I do worry that Reg A means that you definitely have claimed that you're in one of those categories, and that means that follows the token through its life, or at least until this point when you can go into the staff and tell them that you're decentralized, which again, we haven't provided guidance really to explain how that is going to work. But so I think it raises potential issues, but it seems to have worked for a couple issuers so far. So it is a route that's open to people. Now, I get that the process is really slow, and it's something that I'm hoping that I can keep pushing on to. We need to be faster on a number of fronts, and especially in an area like this where things are moving so quickly.
Yeah, I totally agreed. And I see in the chat that there is certainly some appetite for regulatory certainty. So urging the Commission to work with everybody in this space, including SROs. And here's Oscar popped up again. So I guess we're at the end.
Well, Sarah, thank you so much. And Oscar, I apologize for my technical difficulties. This is very embarrassing for Crypto Mom, but here we are. So.
You know what? It happens to our CTO every single time, so don't feel bad. It's a pleasure to meet you, and thank you so much for making time for us today, and all our guests that are watching this today. I know we only covered most of the questions that we needed today. Sarah, great job as always. So everyone, we now move into the second phase of the afternoon. We've been going through a journey from end to end. You've been hearing it from the father of the Jobs Act, who got the whole ball rolling, to the commissioners who are there, like Commissioner Peirce, who are fighting for you, trying to get things changed. But the responsibility still on all of us to make sure that we can make this thing happen. So, and that means you need to work with the right partners, the right providers, and to do a fully regulated issuance. And I think that's the big ticket. If you didn't get that today, that's one of the things that I think it needs to be really. If you're taking down the notes, and you heard it from the CEOs as well, if you're taking down the notes of everything all of them have done, is telling you that in order to be successful in Reg A, you need the team and the commission of the SEC is looking at so many different ways to change this market. But in order to do so, you still got to come prepared. You can't just come with a flashy one-pager and hope that, oh yeah, I got the wicked one and boom, I need them to bring me in. No, it's going to be a lot more than that. If you really want to make a change, you heard Greg Anderson from Cirrus Coin. Talk to him about his journey. Now, he's not disappointed that it's becoming a security. He's embracing it. But the point is, even with that, it's a security. He still has to undergo a massive journey to get there. So it's pretty exciting for us to have a firsthand look at this. And this kind of ties in with everything we've been saying all along here during the KoreSummit event. Education, 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 come prepared. So when you either reach us, which we're going to be more than happy to help you, to guide you to all these members in our ecosystem, it is an ecosystem of people working together. Now, isn't that ironic that when you heard the CEOs, they said that once you engage with this, what are you building? You're building your own community, ecosystem to a community. That's right, because these partners that are going to be there through that journey, which it could be 6 months, a year, depending how long it takes to do your race, they're going to help you build that community as well with your newfound ambassadors or gladiators or equity punks or worthies, whatever it may be. You're going to need that. So now we're going to lead into an exciting part of the day. So it's been a great day. Elliot led a phenomenal panel with the broker dealers, and I brought him back again because his energy is phenomenal. And more importantly, he loves the transition we're going through. We're going through a journey, and we're transitioning into different things. But during those transitions doesn't mean that we start pushing away regulations. We start working with them at first, and then we start changing them. So now we're going to have this great discussion about digital securities and secondary market. So we have some great speakers here today to actually engage in that discussion. We have the very first secondary market for Regulation 8+, Rialto Markets. So Sherry, the CEO, and Joel Steinmetz is the co-founder, and we also have Lee Saba from the team. And then, of course, we wanted you to meet two of our leading brains in the CoreConnex team, Dr. Karan Garimella, our Chief Scientist and Chief Technology Officer. And we're really excited. It's been a long time, so I don't get to see him often, but Edwin Lee from our Dubai office. So that's right, CoreConnex is global, and this regulation is being talked about everywhere, whether it's digital security secondary market. And Elliot Chun is going to lead you on this afternoon. So enjoy it, have fun, and I'll be talking to you guys soon.
Yeah, Oscar, thanks. And, round of applause to Sarah and you, plus Commissioner Peirce. That was awesome. I mean, I think I speak for everybody is when you listen to Commissioner Peirce, she gets it. It makes sense the way she talks about it, the way she thinks about it. And, you think about all of us here on this line, we think about financial markets and we think about innovation, and we've all positioned ourselves to be here in this stages of our career. And it's just great to have support and advocacy from someone like Commissioner Peirce. So I speak for all of us to say we're honored to follow her up. We're going to go quickly around the horn here. 1 sentence introduction on yourself, and then 1 sentence reaction to the conversation you just heard with Sarah and Commissioner Peirce. Lee, we'll start with you.
Great. Hey, thanks, Elliot. So Lee Saba, head of market structure at Rialto Markets. I've been there for about 1.5 years now, maybe just a little bit under. The previous 18 years I spent at Wellington Management, responsible for their global multi-asset class electronic trading infrastructure. And I also moonlight as the co-chair of the Fixed Trading Community, which is a global nonprofit standards organization. I think, one of the things that resonated with me with that conversation is, like you said, Elliot, I think, there's 2 types of people in this world, right? And an old boss used to hammer this into my head, especially around hiring folks, but there's people that get it and there's people that don't get it. Hire the people that get it. So, I think she's thinking exactly in the right space. And, and I think her being open about, some of the challenges, of regulating, this market is apparent, and it's glad to see, how they're working with us.
Dr. Kiran.
Hi there, Kiran Garimella. I'm the Chief Scientist and CTO for CoreConnex. And, I've been in the financial services space in IT technology, artificial intelligence and machine learning for several years. And I came to CoreConnex from a variety of executive roles as a VP for business process management at Software AG and a global CIO with General Electric in their healthcare equipment finance division. It's been a very exciting journey for me personally with the whole distributed ledgers and blockchain. And the thing that really struck in my mind with Commissioner Peirce's comments is that calling her a crypto mom is way too limiting. She's probably more like, capital markets mom. And it's amazing that, it is so difficult for a regulator to fulfill the spirit of regulation and protecting investors with the right things at the same time, allow innovation in technology and fintech. And I think she's doing an awesome job, as are many others within the SEC, I'm sure. So really excited to see how all this evolves.
A+ commit crypto mom. Yeah, awesome stuff. Joel.
Sure. Joel Steinmetz, COO and co-founder of Rialto Markets. Rialto works with companies to help them in both capital formation and secondary trading of private securities. Previously at places, my career started at Instinet, worked at Citi, Citadel, et cetera, always getting involved in finding technology solutions towards everything in and around trading. What struck me really most about what Commissioner Peirce said is really the last two comments she had, one on the 75 million and the one on the crypto stuff. Basically what she's saying is from 75 million perspective, what that will do is open up the Reg A market to a different audience. And we know as a company, we've built, the Rialto team has built about 8 ATSs. We're on our 8th. So we know that building that network in order to get those ATSs is not just getting a lot of people, it's getting a lot of diversity within that, the people that come in. So if you have retail investors and some institutional investors, and you have different types that come in, it makes for a better audience. Recognizing that going from 50 to 75 to 100 changes the audience. It doesn't just increase it, it actually changes the quality of that audience was a crucial factor. And the second component about recognizing that digital securities can actually incorporate within them the structures necessary to abide by whatever rules are placed allows you to expand that from 50 million to 75 or 100 million and still maintain a strict structure to make sure that there are protections that we all want for all investors, institutional, retail, accredited, non-accredited. And the combination of those two, I think, gave her a very deep understanding of what actually is needed going forward.
Yeah, and Joel, how many panels get to talk about the combination of digital assets and Reg A plus? I mean, there just aren't that many out there. We're fortunate enough to be talking about it today. Finally, Edwin.
Yeah, thank you, Elliot. Yes, it was very encouraging to hear Commissioner Peirce speak about bringing DeFi in there and being very open. I mean, being internationally here in Dubai, a lot of people here think the SEC is very stifling and not very forward-looking, and it's fantastic, encouraging to hear that what she was there for, and encouraging to see how they're trying to enact certain regulations to make it work, and increasing even Reg A plus limits to be even higher. My background is I'm a director of KoreConnex for the MENA region, Middle East, North Africa. Spent over 2 decades in the private equity fundraising, fund structuring, capital markets arena for quite a long time, and encouraged by what's happening with digital securities and what KoreConnex is be able to do in removing or reducing a lot of friction in this space.
Yeah, excellent. And when I think about the comments that Commissioner Peirce made, 2 things pop out. How to get capital to small businesses. It just rings out loud and clear that we really need to amend the flow of capital down to the people that need it most, which are the small businesses. And then second, the real-time development of digital assets. I think there's an expectation in the markets that everything should be set. And in fourth quarter of 2020, we're just not there yet. And so the fascinating part about what Oscar and the KoreConnex team, Edwin and Kiran, have been focusing on, this stuff is all happening in real time. So while there will be mistakes, we're going to end up improving, and we're going to get this thing right. And I think that's a lot about what this topic is today, which is, and I'm speaking fast, we only have 15 minutes, so we're a little bit pressed on time, but this combination of digital securities and secondary markets. What does that mean, and what are those kind of implications? And for those that don't know, last week, kind of Jay Clayton, who chairs the SEC, he made comments around quote unquote, seeing all things being tokenized. That's a big statement, but What does that mean? Lee, take us through a little bit of definitions of kind of traditional functions as we think about new meanings of it: digital securities, liquidity, custody.
Sure. Yeah. No, I mean, the way that I think about, tokenization and the way that when I first came into, I guess the DLT, the digital security realm, a lot changes, right? I mean, this is like dog years. It's moving so fast, right? 1 year is about like 7 years, but where we're heading right now is, at least from a Rialto perspective, and the way that I see it is, trying to merge the best of the existing technologies, again, around trading, around liquidity, things that are tried and true in the marketplace already, and merging them with the best of the new technologies, like DLT, like blockchain, and I'll even throw in some of the emerging regulations, right? Like, Reg A is, it's about 10 years old now, but it's been around, and it's now really starting to get adoption. And how do we, challenge the marketplace now to do that? So, again, I think I see, our role as being the bridge, right, to the old, from the old world to the new world, having understood where we came from, and having an eye on the future tech, and really making a pragmatic marketplace with the rules that we have today.
Yeah, and Jake Gallagher just joined. Jake, I'll get to you in 1 sec for an intro. Edwin and Kieran, Lee said the word bridge, right? Which I think is very important where KoreConnex is sitting. How do you think about yourselves and where you play in this transitioning from the old to the new?
All right, so I'll go first. This whole notion that technology innovation in fintech has to throw everything out, all of the existing stuff, doesn't really cut any ice with all the serious investors and players in this ecosystem. So the whole intent of the so-called older legacy platforms and technologies they've been very well thought out for many decades. And there's so many issues that they all deal with, and the scale and the protections that are built into all these things, they have been well thought out. So those should not be going away. So the whole bridge is really about leveraging the latest technologies. And in that, I would throw, along with DLT, also a lot of the machine learning, the data analytics, all that wonderful stuff, that we have today, the cryptography, the consensus mechanisms, and so on, to build a beautiful bridge, not only between the old and the new, but also between multi-jurisdictional, loosely coupled participants throughout the planet, right? So, I mean, that is really going to be pretty revolutionary.
I would add that part of me joining and being part of KoreConnex, and I've known Oscar and Jason for a long time now, and it's probably one of the first companies that understood private capital markets. And from last year's webinar to this year's summit, we talked about, even today, a community and team effort. And it's probably the first company that really pulled in the right players to be involved in the community to actually help private companies through its journey when it's trying to raise capital. And as we use technology to do that, again, we talk about bridge, and then KoreConnex being a center of that and putting the bridges between all the different players that needs to be helping an issuer be successful.
Yeah, and it's, so we're using very familiar functionality, but we're applying 2020 technologies to improve it as we seek to build the foundation of a new capital markets, right? And that all, what's part of that new capital markets? It's that digital security aspect of what the digital security is. We heard crypto earlier. I like the term digital security because crypto doesn't necessarily mean what we want to intend digital security to mean, right? Joel, when you think about digital securities and the benefits that they can have as it relates to other stuff in the process, i.e. secondary markets and liquidity. Talk a little bit about your perspective there.
Yeah, so digital securities is, we agree, it's the right term. It's very different than what people think about when they hear the word crypto. From a digital securities perspective, we just look at it and say, let's get to the private placement market. Rather than start trying to, put a square peg in a round hole and trying to fit something that maybe doesn't work, let's look at the private security, the individual issuer that's coming out, trying to figure out ways to raise capital, ways to have that capital be traded by a variety of players, not just their own investors, but others as well, and then determine whether the proper way to do this is through digital security. Digital securities, by definition, gives some advantage. What we need to start looking at, everyone from regulations to business, is not necessarily at the terms we're using, but what we're trying to accomplish with those things. So when we talk about clearing and settlement and custody and words like that, ultimately we're trying to accomplish a goal. It's not necessarily to get to a point of exactly what happened in the past. We have to look at what happened in the past and say, that's a great concept. How do we apply new technologies to improve upon those concepts? And if digital securities can get us to a point where we can transfer funds back and forth easier, or transfer holdings back and forth easier, or use the blockchain and figure out exactly where it goes all the way back to its beginning, then we've accomplished the goals that we need to do. And that, I think, is the key component of it, is finding a way to accomplish the goals at the end of the day.
Yeah, and as we talk about this old function versus new function, as you say, Joel, people use the words interchangeably, but they're not using them to necessarily talk about the actual function. And I think we get confused, it gets muddled when we blend traditional securities with digital securities. And Jake, bringing you in here, as you think about that kind of transition, start off with a quick intro on yourself, but then lead into your thoughts on where kind of digital securities plus secondary trading looks like as we move into 2021.
Yeah, no, absolutely. So my name is Jake Gallagher. I'm Director of Business Development at North Capital Private Securities. We've been a broker dealer in the space for the past 6 to 7 years. We've worked a lot, mainly on the primary issuance market. And to Elliott's point, we've started getting into the secondary transactions and really into the goal of creating more access, but also liquidity and transparency for secondary trading of private securities. Where I think the market is now is really in its infancy, especially with Reg A plus. But I think by having firms like North Capital and Rialto, and there's several other firms that are out there, by having these conversations and working together, we can ultimately create really an ecosystem that's going to make this market thrive. And we don't see it, at least here at North Capital, we don't see it as really a winner takes all. It's more of, if we can have multiple market participants working together to ultimately, to Joel's point, work towards and achieve that goal of, creating that more access, more liquidity and transparency for the secondary trading.
Yeah, and I want to throw another word in there, which is accountability. I think more than anything, the promise of the DLT, that is the foundation behind this new digital asset market that is being built, is the accountability piece. And that people, you can have bad actors, but to the extent that we're able to make sure that that market participants are accountable for how they are participating in the markets, right? And I think that's something that has been missing, but something that we're getting better at.
Absolutely. Yeah, I completely agree. And I think the blockchain, it really, to your point, increases that accountability and the transparency in terms of record keeping and making sure, keeping things in track. So 100% agree.
There was a comment. Go ahead, Joel.
sorry, that's one of the major points that Jake is making is, we're at the infancy. In a previous panel, you asked, what quarter we're in or what inning we're in, or, and Oscar used the term journey. So I'm going to give Oscar a shout out and go with the term journey. We've really just pulled out of the driveway. We haven't even started on the journey yet. And the reason for that is because, as Jake is saying, in order to build this marketplace, there need to be a lot of multiple players to come into this marketplace. And that's what I think KoreConnex is doing as well. It's sort of getting everyone to play within the space. A topic that was brought up right from the start, David Weil brought it up, Oscar brought it up in a later one, and it's been mentioned throughout, is the fact that you don't have a market without a marketplace, right? You need to start getting other things around it. Right now we have stores. If you want to go buy something, you can go buy it, but we have to create the research around it and the trading systems around it and a lot of other things in order to create a real marketplace. And that's the expansion of what exists and what has happened in all markets. The New York Stock Exchange started out as a very restrictive, exclusive marketplace that had hardly any liquidity. And then it grew and grew further and it opened itself up. We have to start doing that, and we can accelerate it, as Lee said, in dog years, and get that done a lot quicker than it had been in the past.
And I'm going to steal one of your guys' comments, but I think it was absolutely fantastic, which is a line that markets weren't built to be trading markets. They were built to be investing markets. Was that you, Lee, or was that you, Joel? Or who was that? That was Joel. I mean,
I can't take credit for it.
I mean, that's an amazing line. I know we got 2 minutes, Oscar. That's an amazing line. And I just wanted to go around the horn one more time. What is the biggest thing in one sentence? What's the biggest thing impeding the progress that all of us are here on the ground floor building this foundation? What's stopping it from being built? Edwin, start with you.
What's stopping? I think more people, issuers, knowing about Reg A plus, and I mean even from an international point of view, because you have to follow international regulations to raise money. I think if more regulators come on and see what Reg A plus is doing for America, I think that's, for me, from an international point of view, would be what's impeding.
Yeah, I would say I don't see anything stopping it. I think we actually have our tools out right now, and we're building it as we speak. So, I think it's just a matter of time, and I think that window's shrinking. So, we're on it right now, and I don't see any blockers. We've got the guidance, and we've got the tools, and we've got the partners like KoreConnex, and let's go.
Yeah, let's go, Jake.
Yeah, I would also say I don't know if there's necessarily any one thing stopping it. I would say it's really the process of normalization, right? You just have to get the market participants and not the investors, every part of that chain. You've got to get them more familiar with the process and it becoming more normalized in the market as a whole.
Joel?
Just following up on what Lee and Jake said, I don't think there's anything blocking it. All the tools are out there. But we haven't put them all together yet. That's the blockers, making sure we put all those pieces together so there's a very smooth and easy experience for issuers, investors, and traders.
Karan.
Well, I don't think there's anything stopping it. In fact, technology definitely is not a showstopper in any of this. As I tell most people, everybody who asks me, I can do whatever you guys want, except that we all have to be compliant and people need to know what's the right way to do these processes. So it's not showstoppers, and we are in very early stages right now. So it'll be a very exciting journey.
Yeah, and I think the number one thing that's impeding this progress is good examples for us to be able to point to, wins for the industry. Being able to say, did you see this group? Did you see that group? Did you see that they did it the right way? And they built the path, that journey that everyone else can follow and learn from and improve on. And the more and more that we have those examples, it's going to arm all of us on this call and everyone that's been participating to really be able to go out and say, look, what we're talking about, it's real, it's here, the velocity is picking up, get on the train. Oscar, back to you. Thanks, everyone. And please reach out. Everyone on these calls are very approachable. Everyone's a pretty good person, except Oscar when he gets talking. So please do reach out and be proactive.
Thank you for that.
Thank you.
And I just want to say this. I mean, you asked a very important question. What is the impediment? What is holding everything back if all the pieces are there? And my observation is this. All the pieces are there. But what people think, just because they're pieces, they can just come together. No. The missing part is you have to start with one, and you have to appreciate what they're saying when they say compliant. Compliant for a broker-dealer is not the same as compliance for a lawyer or an IRA custodian or an escrow provider or a bank or any of that. So we need to start paying attention to what everybody else's requirement, and ultimately never forgetting two things. We always want to make it as simple as possible for the investors / shareholders and the companies who want to take advantage of this. If we can put them at the forefront and understand that, because everybody's so quick to bring technology, I've solved the problem. Okay, you're a great island, a pod. That's great. As you all said it, there've been, and Jake said it too, there've been many that have been making announcements on secondary. So the question is, why didn't it go anywhere? Why didn't it? Because it takes a whole ecosystem to understand and appreciate each other. And then that's one. Step two, have a thorough discussion about what it takes to make the transaction happen. And listen, what do they need? Everybody here needs something to meet your regulatory obligations. And then come to a consensus. What an interesting word. Consensus, to come to an agreement on how that will occur so we can put this in a very seamless way. So I'm excited we finally have that. And Jake, I apologize. I owe you big. It was a little boo-boo on my end, okay?
Not a problem at all. It happens to the best of us.
I love the new brand PPX. It's great. It's two secondary markets. The discussions are going to get better and better. And I think Elliot nailed it. We need to see the evidence. We need to see a company going from A, B, C, D, all the way to Z, so we can point at it. And then when people ask, there it is. So thank you so much, guys, for a great panel this afternoon, bringing that enlightenment to everyone. Thank you.
Thank you.
A+ crypto mom.
Oh, that was great. Yeah, the crypto mom. Thank you. All right, everyone. So as we move on to the next part of our event today, it's exciting. I mean, look, the things that we've learned the last few years in this space has been quite interesting. I mean, listening to Yoel, to Lee, and Jake, and Elliot, and obviously our colleagues, Edwin and Dr. Karan, have been very interesting, because there is something here that I believe has been severely overlooked in many cases when it comes to, obviously being engaged. And it's not listening to those things that you need. You just think of it as like putting on your socks, or brushing your hair or brushing your teeth. You don't think about it anymore. You buy Colgate, you buy something and it works. And you assume that it's just there and it'll do it for you. But what you don't really understand is, how does it work? Why do we need it? And we're maturing. The industry is maturing. So we heard terms like escrow. We hear terms like KYC, ID, suitability. And obviously the broker dealers are taking care of that. And why is that important there? And how does that affect escrow? And why is escrow so important? And more importantly, with the payment providers like ACH, EFT, credit card, wire, crypto, and then IRA, the $9+ trillion sector, the holy grail, as everybody calls it. But yet in 10 years that I keep hearing about it, Bill and I have had lots of good chats about this, it's still not there. And I really, I'm bringing this conversation piece as it's ending on the other side. It's coming to you guys. And that, Elliot asked a very important question. If all the pieces are there, what's the missing ingredient? And I said, I firmly believe that nobody's listening. They're not listening. Some of the participants in the ecosystem don't listen to each other's requirements to make sure that, as an IRA, I met my requirements as an escrow. And this panel that's going to be led by my co-founder, Jason Futko. And of course, he's got two great panelists with him. Bill Humphrey, the president and CEO and one of the co-founders of New Direction Trust and IRA custodian. And of course, Mr. Robert Weiss from Wilmington Trust to discuss these very points that we started. And they're important for all of the companies and CEOs ready to do this. You got to listen, because, I keep telling everybody, it is no longer a right, it is a privilege. So you have to understand what that privilege requires. Jason, the floor is yours. Have some fun.
Thank you, Oscar.
Oh, I forgot to tell you, some of your guests asked me that you needed to do a lap dance. So that's all I was told to tell you.
I think we're wrong forum. I think it's great that Oscar jumped in and took half the presentation over, but I know it's compliance. It's everybody's favorite topic. At least I assume that's why it keeps everybody up at night. I'm going to probably shoot right in because he's already kind of given you guys a bit of an intro. I'll start with myself. I'm the co-founder, CFO of KoreConnex. Been in the financial services sector for 20 plus years, working from corporate finance to banking and the like. So, I've had a pretty broad exposure to everything from compliance to the private markets and the way they operate. So, which is why we've sort of gathered here to sort of share this knowledge and bring these experts together to help share this information with all those people that want to have access to it. So I'm not going to, belabor it too much. I'm going to jump in. I'm going to start with a question to both of you. And as I jump in with a question, maybe give a little bit more detail of your background. So Rob, I guess, Oscar framed it a little bit. What is escrow and what role does it play in the Reg A plus process? And then when we jump over to Bill, what is IRA and why would somebody want to use their IRA to invest in Reg A plus?
Sure, thank you very much, and it's a pleasure to be joining everyone today. Thank you to all of you who have stayed with the program all afternoon. I know it's been great. I'm Rob Weiss. I'm Managing Director at Wilmington Trust in the Global Capital Markets Group, and my responsibilities are for our escrow, trust, and paying agent services. And we've had the pleasure of working with a number of folks who have been in the conference this afternoon, Rialto and Toro. We have been doing subscription escrow work in the context of capital raises for many years now. I work very closely with a colleague of mine, Boris Traeger, and together this is a very important space for us at Wilmington Trust. So what is an escrow? It's not a bank account. And I think a lot of people just assume it's a bank account. No one goes to sleep thinking about escrows. It's when they're needed that people focus on them. So what is an escrow? An escrow really is a controlled account that we open on the trust platform of our bank, which provides some exceptional credit guarantees or credit comfort for our clients because the assets are generally segregated from other assets of the bank. And the funds in the escrow account can only be used for a very specific business purpose. And they can only be dispersed by us as escrow agent when we are directed to do so. So it's not a checking account, it's not a savings account, it's a very specific controlled account that has exceptional credit protection. Funds are liquid, they're readily accessible when we receive that direction. And it's an important aspect of many arrangements that we've seen in both the Reg D, Reg A space, as well as M&A in general. So a very important non-sexy component of what has to happen.
Go ahead, Bill. I think you're muted. There we go.
I'm unmuted now. At the button. So as Oscar was saying, we are a custodian for IRAs and other tax sheltered accounts like health savings accounts and some 401ks. But the IRA it represents a lot of money that people have set aside. And importantly, they've set it aside for the future, which makes it an ideal investor or investment money for something that has a long-term horizon, such as a Reg A offering and maybe you want to invest in a variety of them gives you a great opportunity. But I think that the challenge that we have found in our 17 plus years is that people have been brainwashed, intentionally or not, that an IRA cannot invest in anything that's not on the list already. And that list historically has included just securities that are blessed by the SEC. So our challenge, number one challenge is education. Like Oscar said, we want to teach people that this is their money and they can invest in whatever they decide is going to be a good investment for them, including all of the stuff that we've heard about today. The IRA is just another investor. He's just never known that those funds could go into this investment that he's heard about. So we're trying to move the investment idea from personal money to all the money that an investor controls. And usually there's a lot more of it on the retirement tax sheltered side than there is in their pocket. At least that's true for me. My pocket seems to leak, whereas my IRA doesn't leak quite as much.
Fair enough. Fair enough. I mean, you gave us a bit of a broad picture of escrow there, Rob. Is there anything from a mechanics point of view that people should understand?
Yeah, absolutely. So let me chat a little bit about how the escrow fits into the Reg A process. And as I mentioned, you know, these are important pieces, whether it's a Reg B offering or a Reg A offering. Essentially, having an escrow not only provides what is often a regulatorily required solution, private placements, it's almost always required, but it's something that provides tremendous comfort to investors. And in this space, that's a very important thing. We're dealing with hundreds, if not thousands, some of whom might be tapping their IRA to invest in a new or emerging company. And so having a well-capitalized escrow agent that has experience, that has focus, that is a team that's committed to this and knows how to do it and how to stay through the process is really important. So you could think that the escrow has both a regulatory purpose and a marketing purpose because it gives individual investors a lot of comfort that the money is going somewhere safe before it goes to the entity raising the funds. We try to get involved as early as we can because that helps the issuing company structure the escrow and structure the transaction. Sometimes the investment bank or the placement entity is engaged, but usually the agreement is between us and the issuing entity, even if the banker brings us together. And we work with the issuer to go through the mechanics of the escrow. In some cases, there is a minimum capital threshold that's required to trigger a successful raise. And those pose unique issues and aspects with respect to the escrow, because if that threshold isn't hit, escrow agent also needs to have the capability to very quickly then return capital to the investors. But generally speaking, in a lot of Reg A, we don't see the min-max thresholds. And so really getting the escrow agent involved early on, structuring the deal so that we know where the sources of money is coming from, knowing that we have the capability to not only quickly disperse to the issuing entity, but again, if there was a minimum threshold that wasn't hit, that we can then also pay out to all the different, those are all critical components of what we do.
Okay, Rob, just as a note, a couple people are having issue hearing you. So if you could speak up a little bit or turn up your mic, that might be helpful.
Sure.
Bill, just from an IRA perspective, are there, you know, how does investing through your IRA work? Are there different types of IRA that are you know, make Reg A plus investments more feasible?
Well, the big challenge, Jason, I think, is the idea that people don't know that they can do it. So they have to ask the question first. And the second thing is that when they have their IRA with one of the big brokerage companies, the brokerage companies don't necessarily want to deal with a small offering or deal with paperwork that isn't already automated and then the NYSE or wherever, because it makes it more complicated, and that's just not their business. So with an independent custodian like New Direction, you can tell us to invest in whatever it is that you decide. And usually there's paperwork involved, and that is often not automated yet, although we're all working on it to get it to be a one-stop shop to fly through with 3 clicks like it is to buy shares of IBM. But currently there's a little more effort involved in the investor side to make that transaction actually happen. And so what we do is we execute the transactions that are presented to us. We have the ability to execute pretty much any transaction that you find. We're just not going to give you a list to say, here, pick from this. We say, go out into the world, find all the Reg A offerings that you're interested in, and your IRA money can go and make an investment in that. The IRA owns it, the IRA gets the benefit, hopefully lots and lots of appreciation, maybe even dividends and payouts along the way sometimes, but that all comes back to your IRA, just like it would if you were investing in shares of IBM.
Right. So would you say, I mean, you mentioned that, you know, people understanding they can do it seems to be the challenge. Is that what you would say is the biggest challenge in getting this adopted by the masses, or are there other components that are sort of holding you back?
I think that the knowledge that you can do it, and then the process of how you do it, because like I said, it's not 3 clicks. It's some extra clicks and some extra filling in of forms that maybe in the past your broker would have presented to you, just sign here on the bottom, and they're thinking about it. But in this world, people have to take charge of it, but it is their retirement money and they should take charge of it. So once they figure out that they can do it and what the limits that the IRS imposes, which are really hardly any, you can go and invest freely in whatever you choose, and hopefully you invest in something that you understand, and you're likely to do better when you invest in something that you can see issues with it and decide to invest or not.
Right, right. And that's been one of the great advantages of Reg A Plus is, you know, you've got a handful of investors that have sat on the sidelines for years, not being able to invest in private companies or effectively not invest, at least until they go public, but where they have great knowledge of the industry. So it gives them the opportunity to get involved in something they understand. So
our typical investor comes in, they've been doing something for 30 years. And like one of our main things is real estate. People invest in real estate. They've never even considered that they could do more of it. Or somebody has got a new invention and they've seen how it's going to affect the industry. They can invest in companies that are going to benefit from that. So it's really empowering to tell somebody that your brain can actually play a big part in the decision-making for this world of investing.
For sure, and real estate's been one of those industries that has taken off with crowdfunding in general since the start, because people have understood it. People that are in that sector get it, and having access to, you know, large commercial real estate projects, for instance, is something they probably didn't have before. So, you know, it does simplify that process. In terms of timing and requirements for escrow, Rob, I know you mentioned, you know, it should be done early. What are the kind of tips for companies that need to get set up, need to have their escrow set up? Is it, you know, one of the first things they should do? Obviously, talking to their lawyer is the first thing, but, you know, is it an early on in the process? Does it take a long time? You know, what are the requirements there?
Sure, that's a great question. Can you hear me a little bit better now?
Yeah.
Okay, great. So that's a very good question. And we're used to, in most of the capital markets transactions that we support, coming late in the game, right? So ideally, we're able to come in a little bit earlier, help with questions, help to structure the transactions. But one of the keys to being a successful and effective escrow agent is to be able to turn quickly. So generally speaking, you know, we might learn of a need days or the same week that someone wants to initiate its raise. And so the key to that is that we've got forms of agreements, template forms, that we're able to provide to issuers that pretty much lay out whatever is required. It just needs to capture the specifics of this particular, but it captures all that's generally required of the issuer. And the key is also, in addition to that template agreement, that we need probably about 48 hours to do KYC, the know your customer requirements, on the issuer. We don't need to do that on the investors. We need to do that on the issuer. And so we can typically get those things done within a few days if need be. It's always ideal, again, to have more time. It's always ideal to be able to be involved earlier on to help the issuer with questions so they're not scrambling last minute. But we can generally get these things done quickly, same week, if need be. And that's where the experience, the templates, the focus comes into play.
So you raised a good point. KYC is obviously a huge component of compliance in general, whether it's the investor or the company. When you say KYC on the company, do you mean the officers, the directors, both? Does it make a difference if the broker dealer is involved and they're taking care of some of that KYC and ID and AML?
Sure, absolutely. No, it's a great question. And KYC is one of those gifts from our regulators that, you know, we've worked hard to minimize the effect on our clients. And so we have a very streamlined process. Generally, the KYC that we're required to do is for the parties to the agreement. So essentially, if we're entering a two-party agreement with the issuer, the KYC is solely on the issuer, basic information, name of the entity, taxpayer ID, address. We require one or two documents that provide some kind of proof that the business exists and is real. There's a laundry list of 30 things that that will satisfy, plus or minus 30 things that will satisfy that requirement. And then if there is a beneficial owner that has a stake of more than 25% in the company, there'll be some generic questions, again, name, address, social security number for those entities. And we also, lastly, ask for some information on what we call the controlling party. So we leave that to the issuer to determine, but if there's a key board member or the CFO or someone who will have very specific control of the escrow, we generally like to get some basic information on them. We lay all of this out up front because the worst thing that can happen is you get to the closing table and you've got, you know, a bank, an escrow agent that says, well, gee, you know, we needed this. And so right up front, we'll list the requirements, we'll be very specific with what they are. We'll handhold if there are questions on it, and we'll make sure it's done cleanly. With respect to the investors, because this is important, generally speaking, the broker-dealer is doing KYC on the people who are engaging in the raise. It's very important for us as a bank to understand the source of funds. So as long as we've got the KYC that I just outlined on the issuer and a very good understanding of where the money's coming from, and then in the worst case scenario, if for some reason down the road we need from a compliance perspective to understand, you know, Rob Weiss, who invested in this issue, we know that we can go to the broker dealer and they'll provide to us the KYC information that they gathered to approve that investor. So the key is to keep it streamlined, but to make sure that the required information is, you know, we lay it out up front, we get it, and we have access to what we might need from an investor perspective later on during the term of the issue.
So working with a broker dealer seems to be quite important in the process.
It is, absolutely so. Because even if they are not a party to the escrow agreement and just the, you know, the entity raising the capital is, working with a broker dealer who has engaged in this, who understands, who is doing the proper due diligence is critical to success.
Right. And Bill, does the broker dealer impact the IRA process at all?
Yes and no. I think the biggest feature we see in having broker dealers involved is just what Rob said. They've seen it, they understand it, they can communicate it to more customers. So the exposure of an investment will be a lot broader. And the broker dealers already worked with that customer, so they probably can steer them into an investment that's more suitable to them. From the other side, when we're looking at KYC, we're mainly looking at our customer to make sure we know who they are, because we leave all the decision making to them. So they can benefit from extra KYC done by their broker dealer that we're not going to require, but it's much to the benefit of the investor to have somebody else on their team that is looking out for that kind of stuff that the investor might not realize that they should be looking for on their own. And it opens the door to smaller dollar investments, particularly with Reg A, because like you were saying, there are commercial investments that have lots and lots of money, and each slice is 100 or 200. But our typical client has 100 or 200 total, and they don't want to put all that into one. So now they can spread it with their broker dealer's help amongst a bunch of smaller investments and diversify in an appropriate way for them. And of course, we're not going to tell them to do it. It's all up to them, but this gives them opportunities that they honestly didn't have just a few years ago.
Right, right. And Rob, what if people were to try to take away something from the escrow, what is the risk that you're mitigating by providing the service?
Absolutely, it's a great question. The risk that we're mitigating is that, if you're a retail investor and you're investing through your IRA or through any other mechanism, this might be one of many opportunities that you're looking at. In a lot of cases, the companies that are engaged in the Reg A process, they're not necessarily the companies who have long historic track records of performance. Doesn't mean they're not great entities, but having an escrow agent in the midst of the capital raise process, gives the investors comfort that, A, should there be, a fail for whatever reason, they'll be able to easily receive their funds back. And B, even if there's not a fail, it legitimizes the process, and that, they have comfort that the raise will be conducted efficiently and effectively and according to the requirements. And then and only then will the escrow agent release the funds to the issuing entity. So it's really a safety net for the investor, provides them with a comfort level. And as I said, in some private placements, it's absolutely required that there be an escrow agent. But if not, again, it's a security aspect, and it's good for for both the banker as well as the issuer, because a lot of times, we've seen situations where, and not necessarily in the Reg A space, but in many commercial situations where escrows are required, in the past, you'd see bankers or you'd see attorneys say, hey, we'll just hold the funds and we'll stick them in a bank account. Or, the broker dealer might decide, hey, we'll hold the funds. Well, most of these entities aren't capitalized as well as we are, nor are they expert in, again, this very non-sexy yet very important control aspect of the transaction. And so it's an important function, and it should be played by an entity that has expertise in conducting it. The devil's in the details in these things. And so, we've done so many of these that it should lend comfort to investors and issuers to have someone this knowledgeable in the process engaged.
Right. So quick last question, I think, for Bill. Most people consider the process of investing through their IRA to be a bit of a root canal experience. How are you working to mitigate that and improve the process and sort of get through the KYC piece efficiently?
Well, I'm afraid it is true that that's where we come from, as Oscar continually reminds me. But we are crawling out of the swamp of everything being via fax, via paper. And one of the things with self-directed investing is they're all snowflakes. So we gather info from different places and move money from different places. But with CoreConX, they're trying to gather a lot of that in one place so that we have access to it all at once. So we gather all the info up front, we can execute the transaction in the back. It may still be work on our point or from our side, but we're not going to make it as hard for the investor because we're just going to get what we need. We know exactly what it is, put it in, fund the investment as soon as the money is over. So maybe just a quick trip to the dentist to pick up toothpaste rather than the root canal.
All right, great. I appreciate that. And thanks to you both for your genius insights into this. Compliance is something that generally scares a lot of people. So if they understand when to engage people and how to simplify the process, it certainly helps them sleep at night. I see Oscar in the next panel jumping on. Are there any questions, Oscar, that people had?
No. I mean, the only component of compliance, or to Robert Wise and to Bill Humphrey, yes, that these are industries that have been there for many, many decades operationally, and this is a new entrance. And case in point, Bill Humphrey's firm has, I believe they're taking a strong leadership position to listen to the audience. And what are they listening to? It's not so much about what we want as CoreConX or anybody else. They're listening to the people who want to invest. And they're saying this, and you described it, it's like a root canal. Andrew Korn once told me that his experience doing an IRA would be one that he would never do again. How do we change that? And the good thing is that we have people like Bill and Robert that we're all listening to that, and we all want to be proactively wanting to do that. So a great panel, guys. Great bringing insight into it. Hopefully for everybody listening in, it's, even though to you may not see this is the stuff that they need to do to make sure that your offering is fully compliant. You now can appreciate why they ask so much information from you when they're getting set up, because there's a lot of risk factors. They have their own regulators that have nothing to do with you. None. I've learned that. I mean, I learned with the banks that SEC is one regulator. You guys got other regulators to deal with. And Bill, same. So this is about learning, understanding, bringing the pieces together. So thank you so much, guys. You did a great job. Thank you.
Thanks, Oscar. Jason?
If anyone couldn't hear anything that I spoke about and would like more information, please just let me know. Thank you.
Perfect. And that is a great part. Obviously, all our speakers are featured on our website at www.KoreSummit.io. Click on speakers. You can search for them. Their contact details will be there. If you don't find it there, we will make sure that you get it as soon as possible. So we're now coming down to the last panel of the day. It's been an exciting journey. One would think that we're done. We're not. And this is for me, I'm very passionate. I'm getting involved with these two mavericks here, but I'm passionate about this particular panel more than, I love them all, but this is the one that I see the most. This is the one that I think we've overlooked. We've overlooked, not as an industry. We haven't really put it as part of the plan for companies. They are now, thanks to Eric and Andrew and many others. So what are we talking about? We are now going to be talking about shareholder management, shareholder communication, or better yet, should we be using the word shareholder? In some cases, we're hearing the words like, community builders or brand ambassadors. We have companies like Brewdog Breweries who call them equity punks. We have others that call them legionnaires, worthies. We're calling them the gladiators. And I wanted you guys to meet Maximus. Yes, Maximus, the ultimate gladiator in Roman times, but I'm not sure if he's going to wake up for me right now, but as soon as I find him, I'll bring him to you. But the discussion is really around these two exciting topics that are intertwined with each other. Managing whatever you may want to call them, and then communicating them is the same. They're tied in, and more importantly, you need professionals when you haven't done it before as to what it is that you communicate with everyone. I'll give some examples of that. So today I'm joined by two panelists. If you haven't met them before, Andrew Korn, founder, CEO of E5M, and of course, Eric Fischgrand, again, CEO and co-founder or founder, sorry, of Fish Tank PR. So obviously we're talking to people that you've heard throughout the day. They have experience with Regulation A. I'm bringing this information back to the industry because we're hearing it from the other side. We have a very fortunate part at KoreConnex is that we're listening to all the different audiences, and we're listening, we're taking notes, and we're hearing what they're saying. And we also know that so much great work it gets done on one end. So here's the most common feedback we get from shareholders afterwards. I heard so much from the company when we were raising the money. After they got the money, it's like they went, died. Where do they go? So we're going to start with there. So let's start with the shareholder communications component of it, and then we'll move into the management of it. So obviously, Eric, from being a PR, has your firm been engaged on the post-transaction element of a company where you're guiding them, providing them tips and guidance on what should be messaged out to the holders and creating a plan for it?
Yeah, absolutely. Those are the engagements that we certainly enjoy working on. I think just to take a quick step back, my agency Fish Tank works with works on a number of equity crowdfunding deals, and we really have since they became prevalent in 2015, 2016. The majority of our clients are not relegated solely to equity crowdfunding, and so we're used to clients who are doing private raises or who are listing on major exchanges, NASDAQ and New York Stock Exchange, or of course doing equity crowdfunding, which is what we're here to talk about. So we're always looking at a long-term vision. So yes, it's very important to execute properly an equity crowdfunding campaign, and I'm sure everyone is relatively exhausted from hearing about all the positive parts of that today, the challenges and the positive parts. But I do think it's very important to have a plan afterwards, because if you think that individuals are going to invest hundreds or thousands or tens of thousands or hundreds of thousands of dollars, which has happened, and then just sort of expect returns in 3 or 4 or 5 years, and that you'll just be silently at work, then you're mistaken. They need to see consistent and continuous corporate communications. What does that mean? It means continued press releases. It means shareholder newsletters. It means blog posts. It means continuing to speak to journalists about your business, not about raising capital, but about your business. How are you moving your business forward, right? Like, I don't want to hear a company talk about raising money all the time versus talking about their business, because it means that they might not have a very active business plan, or might not have the right business development people, or like a revenue producing model. So it's extremely important. We work with a lot of companies that are leading up to and then executing an offering, and we do try to make the point very clear that your investors, to your words, Oscar, they're not going to go away. They expect continued communication, and I think that's what the role of myself and my firm and other firms in the space and individuals in the space are doing right now.
That's great. And obviously, Andrew, your firm is not a PR firm, but you work with PR firms. So how does that combination work if you're trying to be there during the race of companies, and then knowing what we know now, that the amount of marketing communication continues? So it doesn't stop. In fact, it needs to continue for a period of time. And I think Eric said it best. I don't want to hear that you're just raising money. I don't want you to come out of the closet and say, I need money again. And then for the whole 2 years, you disappeared, or you only send out quarterly statements, which meant nothing to this crowd. So how do you strategize towards that with them?
So the key word, so let's start with my firm and my prior firm have been involved in investor relations forever. And that's essentially what a lot of this turns into. And I think the key word that Eric used is the word plan. So you need a plan of how you're going to communicate, and then you need a strategy, then you need the specific tactics and execute. And if it sounds like a bunch of work, it is a bunch of work, but hopefully it doesn't feel like work. we call it equity crowdfunding. When does that crowd turn into a mob? And they turn into a mob when you don't communicate and you don't do things right. When we onboard a new client, one of the things we ask, what is the basic promise you're making to shareholders? And part of that is that they're along for some of the journey. When you're raising the money, it's, hey, we got a new milestone met. So let's get over to Eric's team and let's get that out to the press. And let's go over to Andy's team. Let's get that on the offering page and let's get an update out to prospects, etc. So you don't have to be quite as diligent, but you need to be very diligent in the way of communicating. And let's say it only is quarterly, then it is, here's the milestones we've met that we told you about. Here's the ones we haven't met that we've told you about. Here's what we're doing to meet them. Here's where we are financially, and communicate to them. My recommendation is like you're a public company, and you can do it more often than quarterly. I think the off-calendar communications are really healthy. You've used the word a bunch of times today, community. The more they feel like they're part of the journey and still part of the community, the more they actually are. And if you want them as advocates and influencers for you, all of these things are contributors to it. So it's that plan, strategy, tactics, execute, and have a firm like Fish Tank and some other fine firms out there to make sure that it's being done. And one last thing, and I'll turn it back to you, is people will say to me, wait, the math you just gave me, we're raising 15 million. You believe the median's going to be $2,000 each. How many thousand investors is that? And all the time I'll laugh and say, you damn well better get yourself a really good transfer agent, because you're going to need things distributed, and it's not just money and shares. So
yeah, and we'll talk about the management, because that's never been part of. But I'm gonna throw a snag in here, because I come from the public markets as well. Myself, Jason Futko, we spent quite a bit of time in that area, over a decade. And I got to tell you, what I saw it just stunned me. Being an entrepreneur of a technology company, always having to grind ourselves to get to the next capital raise. These guys would go to their brokers, ask for their $5 million. They wouldn't even know who the shareholders are. They didn't care. Take the thing public, list it, and one day they're gold, the next thing they're plutonium, silver, and money just washes away. And what I saw, there was a cottage industry called investor relations. And I got to see this industry. It still exists, by the way, and I'm sure it maybe not so prevalent. It's huge, and for public companies. And I find it very distasteful. There are two sides. There's where you can hire an Eric Fish Tank inside your company, or it's a member of your team. He is being rewarded like every other member in your team, not so much to drive your price from a nickel to 50 cents, or for 50 cents to $1, but to truly be a community builder. When I look at BrewDog and I look at Legion M and many others, they're not the only two. In particular, in the private world, I see that they're seeing their shareholders more than just shareholders. And you said it right, community. And I think it requires a new form of industry coming in. And if anybody's listening out there, we need this. Companies are not prepared for this. They do not have this individual. If you have the investor relations skill, great, that you understand the legalities. But where it's different here is this. When Eric Fish Tank investing in CoreConnex, which I know he will, and Andrew Korn, which I know he has, and they sit on my cap table, I can't walk away from it. I cannot pretend that they're not there. I cannot pretend that they don't exist. I can't say, oh, they're hiding under a shelf. No, in private world, we see exactly the holder, whether it's an individual, an entity, an IRA, under trust, it doesn't matter. You see it. It's real time on your cap table. And with a platform providing that, it's there. So that relationship is so important. And you need somebody who can guide you and work with Eric, Firm, and Andrew. But I'm just not sure if I would want to call it IR. I've been really I've been struggling with this for a while. In fact, we had a feature in our platform named IR. We renamed it because I was getting, I was getting to the point that I don't want to mislead anyone that this is like publicly listed world. And that was maybe like anything else, we're entering a new industry where I used the word ambassadors. I know, Andrew, you said maybe that's not appropriate in this case. It's true. So that would be my only comment to this. But this by no means does it mean that you don't need the professionals. You just need to understand that the relationship, I believe, with a company is so different, and the holders, and it can be so empowering, and you cannot just stop the minute you finish raising your capital. That's the biggest mistake I've seen. So what I'm seeing now, that's exactly, they go, Eric, I don't need you anymore. It's, in fact, I would go, what are you doing? You need Eric more than ever. I don't need you anymore, Andrew. I don't need you to keep, the messaging may be different, but I still need you, that consistency, right? They're expecting it. All of a sudden it disappears, and it's sort of like, what happened to my investment? Is the company still there? So, I mean, imagine when shareholders are asking, is the company still there? That's a scary question to be asking after you've invested with it.
It's very scary. And frankly, my firm leaves its retainer the moment the money is raised, where Eric should be forever. Very frankly, and then we're brought in for, as mercenaries to help perform very specific communications and build certain things as they need to get built. But when you look at the dispersion of types of issuers, and then also dispersion of types of investors, there is the investor that never wants to hear from you, and they just want to check when they're going to get a check. And it depends. Are they expecting monthly yield, quarterly yield? Are they going to get a dividend? Or, gee, I got an option on tech firms, and one day I'm going to get a very big check, or never, or they're going to go out. But the more you can engage them, and the more they are still part of your community, the better off you're going to be. And that's something that, again, with a good plan, is executable. I don't believe a private company needs to bring someone in-house when you can outsource that for far less money to a good firm like Eric's. I did an interview a couple of weeks ago on what hedge funds are doing during coronavirus. And the good ones are figuring out the way people want to be communicated to, and then communicating to them that way. In the case of a Reg A, and you've got a transfer agent, you already know how they want to be communicated to through the transfer agent. And then also, then how will someone like Eric or someone like our firm then package things to go out to them? And that I'd love to toss over to Eric of, what are the ways that that is kind of done?
Yeah, and obviously thank you both, and I think that one thing that Andy touched on right away, and that Oscar elaborated on, is community. And I think that one thing that people get so focused on is, again, the messaging for raising capital, investor acquisition, and then they don't always think beyond that, or even during a capital raise. They're so focused on getting new eyeballs and new traffic, which obviously is important on their offering and on their website. Sometimes your community, your current investors, can be your best source of continued interest. We've participated in campaigns where the entire crux of it is an email campaign asking them to forward to one friend. Show one friend this video of me doing some like online TV, or show one friend this Forbes article, or show one friend this email. We've hit yet another milestone. Share it with someone. You can apply that same thinking to social media as well, right? Like, yes, it's important to get new eyeballs, and you're following the brand on LinkedIn or Twitter or in a Facebook page. One of you mentioned right away the BrewDog offering and the punks, right? Like, that's a perfect description for how you're able to like really create some brand identity and brand ambassadors. And I'm seeing more and more issuers coming into the space, and they understand that, yes, like, I can raise capital successfully using equity crowdfunding, but also I can really create some brand affinity, for ourselves and some customers, right? And a lot of my clients at Fish Tank are very technology or healthcare or emerging industries focused. But however, I've seen like the brewery, BrewDog, obviously that's a good example. I don't know if anyone remembers a few years ago on Start Engine, there was the like surfboard golf cart thing where if anyone's paying attention, I love the way that was marketed. We didn't do that. I thought it was great. There was a lot of engagement. I actually have no idea what happened to that offering, so I should be careful before talking about the marketing of it. But the way that they built their community, I thought was a really good idea. And I've seen that with companies that are more like, more biotech, more technical, more corporate in nature, and it can still be very effective because when people are confident in the company they invested in, they feel good about an investment. They do the same thing they do with traditional equities. They tell friends, they tell family. So I think the community building, which is really what I wanted to add to what both of you said, is just incredibly effective. And Andy's, you have so much experience in the middle of in the middle of an equity crowdfunding campaign. There we go, late in the day. If you want to add any of the ways that you're able to do it from your side, I think that would be helpful as well, since so much of what we do is press and organic content driven.
Sure. Well, first you should pour one of these because there's nothing like 12-year-old scotch at 6:30 at night on the East Coast. So it is well past 5. So Eric and I are actually working on a client where we're looking and building into the cost per acquisition per investor a downloading of their app. So how do you make that app go viral? And that is part of what he and I are working on for the prep of that offering. But once they have 4,000 to 8,000 investors, how are they going to turn them into ambassadors and get them to get someone who they live with and a friend and a colleague, kind of those 1, 2, 3 to also download the app? So, that's part of, and it's an interesting thing when, you talk about budgeting, it's what does it cost to acquire someone new to download your app? And how is that built into that budget? So that is a very typical thing. So there are webcasts, there are podcasts, there are vlogs, and it's all the normal things you would do for PR. It's just you are not forgetting your audience of the people who own a nice chunk of your company and who will help get you to where you are at that moment in time. So
it's a great tie into what I wanted to give you another thing to think about, which is, so I invested in BrewDog. BrewDog treats me well, calls me an equity pawn. I am weekly engaged, daily engaged. They give me all the tools. In fact, I'm so happy I go everywhere and I get more people to invest. Then I invested in another Reg A plus company, and now it's gone quiet. And so we're now, what is important for everybody to know, for the audience, is to, when you raise money, the likelihood that that investor has invested in another offering through the same path is very high. It's around 40% that that individual will invest. And if it's in an online platform, it's like 80, 90% that you'll be getting. And there's an expectation. So if one does it, the holder is expecting it. And the more reason, I keep coming back to this because it's the one thing that I think is lacking. I don't know if people are missing it. I don't think they're missing it anymore. And you're right, it has so many different impacts on growing your business, forgetting that you don't call them shareholders. I remember when I first started as an entrepreneur, you thought of as a shareholder and you go, ugh, you get the money, but it shouldn't be that way, right? I got 48 great shareholders today in our company. Now, I love them to death because they believed in us. If I could get them to go to LinkedIn and tell somebody that they invested 150,000, it'd be great because you know how quickly it would be but you can't. But it's amazing how this investor who only put in $100 would go out there, Facebook, LinkedIn, and Twitter, Instagram, every social channel, and let everybody know that they own a share and they only invested $100. amazing impact, same type of investor, and you'll get more out of it. So that nurturing, that strategy that goes in, I think it needs to be as thought out as it is when the capital raise is being done, and people need to budget for it. Budget for it, meaning maybe you need to hire somebody in on a part-time basis. Or maybe you need to work with an outside party and somebody in-house, because it does require, you need to answer questions daily. And obviously external parties can't do that for the company. So, this is where I'm seeing it from. I do see the great ones, and this is where we're at today. There's this. And the ones that are finally, giving them feedback, the next question they're asking, Oscar, who's qualified for that role? And initially it will be people like yourself, Eric, and Andrew, to do that. But I think we need to kind of understand that as the industry evolves, we can't be there for everybody. We need to start empowering and teaching this, just like investor relations was created in the industry. It became something out of nothing. And I'm not sure what we'll call it, but for now, we identified that on a post-transaction, somebody's got to build that community to help the both of you, because what are the likelihood that that company will use the regulation again?
Right, so if you have communications or you have a social media manager, they need to be trained to be able to deal with your shareholders. Because if you see on Facebook or on Twitter or something else like that something didn't go right, or someone can't find information or whatever it is, they need to be trained to be all over it, and quickly and professionally and thoroughly, and also potentially to elevate it as well. So that might be a first line of defense. But frankly, if you have your plan set up and you're doing regular communications, then probably nothing will get out of hand. And it's funny, when I think of the crowdfunding, if you go, oh, everything went wrong, then okay, now it's a mob. Or, you have crowdfunding, now it's a community. And, obviously it is more than worth it to keep them as a community, because you don't know what dividends you're going to receive from that. Customers, referrals, advocates, next raise. It just goes on and on and on. There's just no downside to it.
100% agreement. And I don't want to, one of the things that I learned in the public world was people did it because you had to. Do you guys remember when Enron collapsed, right? Everybody had to practice good governance. Where were the board of directors? So everybody's about governance, and you would talk to CEOs and board, yeah, we have to do this. And this is not a have to. This is, you need to want to do it. It changes your dynamic completely, because to Andrew's point, or Eric, the mob or the community will go out there and not only go on social media, there is another place they can go and make a difference. And I'm going to give you the bad now. That is, they can go to the service provider that you use to process that investment and get that investment back. Oh yes, or they can go to the SEC and file a complaint. So I don't want it to be that. It would be horrible if the SEC came up with a rule, as they do for others, for disclosures. Let's do it voluntarily. And that's my, when you've been given a gift, embrace it, but don't spit on it, and understand what you're getting into. So, so for the next 5 minutes, Eric, I'm going to come back to you, obviously, because you work in the public side and the privates now. So if you were to bring, now that we're getting companies, we're giving them the A to Z almost, what kind of tips would you give them? We know what you're going to do in the PR at the beginning. What are you going to tell them to do, continue to do as their journey, that they should be prepared for in their budget plan? Because this is an important element. Budgeting for the Reg A and then budgeting for your business ongoing has to be part of your projections. And most of them are missing that.
Great. So I guess to answer the first part of the question, and to touch on, Andy talked a little bit about the mob and versus the community. Great description, great analogy. I think that a lot of people get very excited when they're about to launch an offering. And because of that, they go, we're going to put out press releases. We're going to be on Facebook, Instagram, Twitter, LinkedIn. We're going to have blog posts. We're going to do media outreach. And then some of those they might continue to do. They'll keep their LinkedIn active and their Twitter active. Maybe they'll keep a PR firm on to keep them in the media. But if your website gets outdated, if your blog falls far behind, if you leave 2 of your social media channels quiet for long periods of time, it's going to reflect poorly on the company. People are going to find out. There are companies out there that they've also gone through a rebrand or they've pivoted their business model, and their website doesn't reflect the proper branding or the proper description of what they do. I think that can be, I have actually told people before, potential clients before in conversation, when they come to me and they say they want to do everything, we'll recommend, like, let's do a few things really well and then build on that, because you just don't want to, you don't want to come in, from my perspective, very expensive, because we're doing every single service possible, speaking opportunities, social media relations, constant press releases, monthly shareholder newsletters. Your business might take off, which is a terrific thing, but if you don't have the time to keep up with all of that demand, then those communication points fall apart. So my first sort of imparting piece of, I don't want to say wisdom because I don't ever associate that word with myself, but would certainly be to open yourself up and do a few things well, versus opening yourself up and then having too many boxes to check off. The second thing that I would say, especially to your second question, Oscar, about post offering, have some sort of content calendar, whether it's press releases, corporate updates, the public, especially your investors, they want to know what you're doing. You can't just, back to my original point, and yours as well, Oscar and Andy, you can't just successfully raise money and then stop telling your story. You've got to tell the business story. And I think that's where good media relations firms can really provide value, which is like, okay, let's discuss how we're going to get 6 to 8 announcements out during the year that demonstrate our corporate trajectory, maybe milestones, technological achievements, partnerships, obviously any sort of commercial revenue, executive appointments. Continue to tell the story about your company's growth, and I think that's really going to resonate with your shareholders. So the last piece is just have an idea of not just the announcements you're going to make leading up to the offering, but how you're going to continue on from there.
Yeah. Part of what happens, I think, is the nature of the company and how it changes. You're fairly early stage when you're doing a Reg A, even if you're raising $20 million. And I'm just going to use the software analogy. You start off, you're very founder centric, you're very development centric, you're very technology centric. And then you move, you've raised your money, and now you're going to get very product centric. And it'll be, what can we do to improve it? We're going to incrementally, we're going to have a release date every 2 weeks, every month, whatever it is. And then you eventually move to customer centric. The problem is you need to move to customer centric faster when you have all these shareholders, or at least that mindset, which is why you can outsource it. And I just love what Eric said about do a few things really well rather than trying to do all of it, because it takes an awful lot of energy to move a company through the cycle I just described.
Agreed. This is a topic so dear to me, and it's not half an hour, it's just never enough, because there's the tactical elements, there's how to do it, and there's the planning. I know you just touched on it really quickly there, Eric, the content calendaring, and then of course inside of it is, what are those content pieces, news release, blogs and all that. But that is a lot of work. I remember when I reached out to you, I said, I need this out there, and you go, Oscar, you got to slow down a bit, you got to get this done. And then eventually, and I like any other CEO, we're always hot, we got this, and we think it's got to get out there now, and obviously for different reasons. But I think the message here for everybody in this particular panel was that the same importance that you put on and the budgeting that you put in to do your Reg A, you need to review your projections that you're putting towards going forward, that you include this element as part of your ongoing business. And if you need assistance with that, there's people like Eric and Andrew who have done it before for others, and how that will work to make sure that you are prepared for it, because it will catch you by surprise. It will. We know that already. We see it firsthand. Why? Because most companies use our platform to manage most of their shareholders, whether it's 30,000, 60,000, 100,000, it doesn't matter the volume, but ultimately it's a tool. You still need to have the content that Eric or Andrew help you create. So gentlemen, that was, it's a great way to kind of finish off the day for all of us. And because it's been an unbelievable journey doing a Reg A. If you think, 8 hours was long, try to imagine people like Greg Anderson, who's 2.5 years into his, or people like Ryan Bettercord, Allegiant Works, who's thought he was going live in November, then in December, January. So don't feel tired. We just get your energy back on. I want to thank everyone today for an amazing, for all the people that attended. Obviously, we recorded these sessions for you so you could watch them. They will be available only at first to all those who registered. We had over 3,600 registrations, so obviously we will get to you. If you have any questions, you can go to www.KoreSummit.io. We will be coming back. We're going to look towards your feedback, how we can make it better. The committee members right here, Eric Fishtang, Andrew Korn, my co-founder, Jason Futko, and then of course, Dr. Karen Garimella. Unfortunately, Sarah Hanks had to step away. She is already in demand as always. But I want to thank you all. Thank you so much for a phenomenal day. Have a great journey. We wish you all the best. We welcome you into our community, our ecosystem to help you get through this. We will be seeing you soon. Our next Core Summit is in the new year, 2021. Stay tuned. It'll be a lot more fun. So thank you, everyone. Have a great week.
Thank you, everyone.
Thank you, guys.
Thank you.
Take care.
Appreciate it.
Bye-bye. All right, thank you. This is the ending of KoreConnex. We thanked ourselves, Corinne, Jason. This is another Core Summit that we put together. This gives us an opportunity we haven't been able to recap with everyone, but boy, what a day, listening to everybody speak. Every single speaker gives you a little bit more than you did. And obviously, I can't imagine what everybody else was doing by taking notes. Most people didn't realize this, but we are on YouTube Live. We still have people out there listening in. Look, for everybody else, the day is done. We want to make sure that that you have great partners there to help you. As you heard from some of the CEOs today, they understand that working with people that know the space and know how to make that journey for you go as smoothly as possible is critical. And our journey at KoreConnex is just beginning. It is for us the same way as it is for every one of you going through that process of doing a Regulation A. So, and for us, our community is you. You are the community for our company. You're the community for what we're going to be doing. You are our gladiators. You are the ones that are going to be on the front lines, which you are every single day. So thank you so much, everyone. Looking forward to 2021. We are going to have another amazing event. This will be our 3rd year in a row of having these Core Summits. It'll be great to have you again, all of us, and more speakers. We'll have to rethink the agenda, and because with COVID-19, it looks like we'll still be doing it online, right?
Yeah, probably.
Right. So to reach us, if you want to meet the KoreConnex team, we're really easy to find. www.KoreConnex, KoreConnex.com. Till 2021, as we say, goodbye.
Thank you.
Thank you.